Hi guys. So first of all, I'm happy to announce that from our institutes, rest of CA and CMA, we are going to release all CA Inter 8 subjects marathon for the coming May 2023 exams. So please watch this introduction without any failure because I am going to give you certain inputs before you proceed watching this marathon. Okay. Now, just a minute. Now, for all the 8 subjects we are going to upload, and I'm also going to give you the faculty details and resources that you need to use parallelly while you're watching this marathon. Now, first of all, relating to group 1, paper 1, paper 2, paper 3 and paper 4, and group 2, paper 5, paper 6, paper 7 and paper 8. Okay. By the way, I am doing this video, this introduction part, I am recording it on, March 1st week, 2023. Okay, so paper 1 is accounting, paper 2 is law, costing and taxation and advanced accounts, and of course audit, which is handled by myself, and EAS and SM and FM and economics. Okay, so these are the subjects that we are having. Kindly watch this introduction. We wanted to provide you all 8 subjects marathon under one roof. Okay, so completely in English. The marathons are going to be completely in English. Okay, this whatever you're watching, this introduction will be there in every subject related marathon which we have uploaded. Now, so accounts, the subject is being handled by our expert faculty, Satyaraju sir. So where we are going to upload for approximately 18 to 20 hours of marathon in 2 parts. Okay, one part will be of 11.5 to 12 hours and 8 hours. Sir, by when I will be uploading these videos? By when you will be getting all these marathons? Already, if you observe, paper 6 audit marathon is already uploaded. Like if you open our YouTube channel, okay, if you open our YouTube channel, By Ram Harsha. So if you come to the playlist, so here already audit revision May 2023 is already uploaded, part 1 and part 2. Now what else is pending? Remaining subjects are pending. Now here we will create a playlist, okay, separate playlist exclusively May 2023 CA Inter revision or CA Inter marathon, something like this. We will create a playlist which you will find from 8th March onwards. Okay, so I will create a playlist here, and inside that you will find all the subjects marathon which we gradually upload in the coming 10-15 days. Okay, so anyhow, by the time you started watching those subjects, this introduction will be outdated for you. Okay, now throughout this marathon we are using certain materials. Okay, we will use certain materials as basis for teaching in these marathons. Now one more important clarification that I want to cover is for paper 2 company law. Especially in paper 2 we have other laws and company law. In company law we have got certain amendments. Paper 4 taxation we have huge number of amendments, and remaining all other subjects there were no amendments. Absolutely, even in audit there were no amendments. Only in company law and taxation there were many amendments. And you know what? In the marathon that we are going to upload, in the beginning itself, now my introduction you're watching, right? Immediately after my introduction, amendment video will be there. Whatever amendment is that amendment video will be there, especially in case you are watching the law marathon. Getting it? So look, this is an introduction to the marathon video. You continue watching, it will be a marathon of the respective subject. Suppose you are watching right now law marathon. So after my introduction, immediately law amendments video will be there. And after watching that amendments, then watch the actual marathon. Getting it? Now I'll guide you. Please listen to this carefully without skipping this introduction part. And by the way, you will find timestamps in the below video description. You will find timestamps like what chapter at what time we are discussing. When amendments are being discussed, all the timestamps were given clearly, including the introduction is 00 timestamp, nothing but. Okay. Now, suppose if you look at law. So this is an amendment material which is applicable for May 23, which is prepared by our faculty team member, D.V. Subramaniam sir. So he prepared this material. So we have clearly given, what is the amendment? Amendment number 1. There is an increase in limits for small company. Amendment number 2. Rectification of name. There is a reduction in time limit. Amendment number 3. So some another amendment. Amendment number 4, some returns related. Amendment number 5, this is a newly inserted provision. Okay. And in amendment number 6, some registration of charges. Amendment number 7, amendment number 8. Like this, we have created an amendments material. Now this is for law. This is for law. Now, if you look at, so this is a general introduction which I am giving. Now, where you can download this material, where you can download, just a minute. Now, if you open Google Play Store, Sreshta for CA CMA, there is an application. In Google Play Store, there is an app called Sreshta for CA and CMA. You just download that application. Once you download and log in, you will find an application like this. You see bottom, store, charts, profile. Now there is a home option, right? Home. Okay. Or even you can go to store. Better go to store. Follow the procedure, whatever I tell you, so that you can download the materials, amendment materials, marathon related, whatever materials we have used. Suppose you go here. There is something called here, both the group subscription model. There is something called both the group subscription model. What I ask you is, this procedure I'm explaining you right now is regarding how to download the material which we used in the marathon. Now go to the content. Okay, if you come bottom, here bottom at last, there is a file called May 23, November 23 study materials. And inside that there is something called group 1 study material. Inside that if you see, paper 3 costing, paper 4 if you observe, paper 4A if you observe, main material if you observe. See, main material we have, for income tax we have 2 modules, paper 4A, one module 1, paper 4A, module 2, and amendments material. For paper 4A, amendments material for May 23 was given for you. Just download that. Here it will not open because it is screen shared, right? So it will not open. You can download here. Same way, you can come to the company law, paper 2, and you open paper 2A company law. The first file is then a paper 2A company law. Ignore that. That accidental again will delete. Okay. Paper 2A module 1 we have. Paper 2A module 2 also we have. Paper 2A amendments for May 23. Whatever the file I have showed you right now. Getting it? So you will find all the resources here. All the resources inside this. Same way, group 2 study material. Suppose you see paper 6. We have given you all the CA Inter main material and smart notes. This colored smart notes is what we have used throughout CA Inter audit marathon. So that's it. So what are the few instructions which you need to follow for sure in order to get maximum output, in order to get maximum benefit? What are the important instructions that you must follow while watching these marathons? The first and foremost thing, please watch the class at standard speed only. What is standard speed? Playback speed. In YouTube, you are watching this marathon, right? There is something called playback speed, watching at 1.2, 1.5, 1.8, 2 times speed. Please maintain 1x speed only. 90% of the students don't recognize the standard speed power. If you watch the lectures at standard speed, what is the impact? You will understand much more strongly. Remember, when you're listening to the class, the objective is not to listen. The objective is to understand, to analyze, to digest. Getting it? If you listen to the class at standard speed, you capture the content so in depth. If you listen to the class at higher playback speed, what happens is, you just listen to the words and you just move on to the next content. But you know what? Your brain will not process it. What is important is, whatever we are listening, the brain should process it. Only then we can emotionally connect. Only then we can feel it. Best example, you listen to any song at a higher playback speed. Just take any song. Just increase the playback speed and you try to listen. Your mind will not accept. You're listening to the word, you're listening to the tune, but at a higher rate. What is happening is you will not connect with the song. You will listen to the song, but you'll not connect. Getting it? You'll not get that feel, connection. Exactly. Very simple. I know why you're watching at higher speed. The reason why you're watching at higher speed is to save your time. But you know what? If you watch at higher speed, what exactly happens is you will not get emotional connection with the subject. You will not get that command on the subject. Your brain will not process it faster. Very simple. If at all we can finish 12 hours content in 8 hours, we would have used 8 hours technique only, right? Why we spent 12 hours? I know, sir, 12 hours content, if we watch at 1.5 times speed, we can finish in 8 hours, sir. We can save 4 hours time. Forget about your time, man. If at all our time was also precious, right? If at all we could finish a content within 8 hours by rapidly, explaining the things, why the hell we take 12 hours? As simple as such. We spent 12 hours without our knowledge. We spent 20 hours on marathon without our knowledge, based on whatever we feel to explain. Understand? And some of the students may say we are fast learners. Even though you are a fast learner, just listen to the song at higher speed. If you are a fast learner, you will understand the tune, everything, emotion, everything. Okay, so it's not about fast learner, intelligent, brilliance, nothing. If at all something is given at a particular video, especially, see, you know why many students feel face-to-face classes effective? Because there you don't have the option to increase the speed. Why student feel face-to-face class is effective? Because he will connect to the subject very easily, because he is watching the lecture at standard speed. Same apply to online also, same apply to YouTube video also. There is no different principle for watching YouTube video. Don't apply shortcuts. Don't try to finish faster. Getting it? Give the time whatever is needed. So this is one important instruction too. Now some students know, while watching this marathon, whatever PDF we have used, right, for the subject, they'll be asking these doubts. Sir, should we take printout of this? No need. You're watching this marathon for revision purpose. Enough. If at all you are already our Shrestha student, subscription or regular student, you might have already placed order for books and that is already there with you. So what are the things? Like first thing I told you, we are uploading for all the 8 subjects. Okay. Our Shrestha team, which is very well renowned, like everybody knows how our Shrestha team classes are. Getting it? Believe me, you are going to enjoy the classes in a completely different level. You are going to get. And by the way, one more important clarification. Now, whatever marathon lecture we uploaded right now, right? Whatever you are going to watch, right? These were recorded for November 22 exams. These we have not recorded freshly for May 23. Please understand. These were recorded for November 22. Amendments we newly recorded, and that video also we have added. Sir, for May 23 you can record freshly. No, not required. Why? Institute itself has not given a new material. So whatever same material was there for November 22, the same material is applicable. No changes at all. Same way, the lectures were also same, which is applicable. No changes at all. Getting it? Wherever there is a change, we have uploaded amendments also as part of the marathon. And one more important clarification for paper 4 taxation. Okay, amendments videos were all put together. GST, income tax, all put together comes around close to 10 to 12 hours. So what we are doing, for taxation alone, amendments video will be separately given in addition to the marathon. So if you're watching our income tax and GST marathon, you are supposed to watch our amendments as well. Getting it? That's it. So these are the clarifications which I want to give. So I spoke about what instructions care you have to take, and I spoke about all the 8 subjects related marathon that we are going to upload, and I spoke about where you can find this, all the marathons. I know you might be watching this video, but you don't know about where you will find. Just open By Ram Harsha, the channel where you're watching, open playlist. You will find in the playlist CA Inter May 23 revisions or something like that. You will find a playlist. So inside that you will find all the 8 subjects gradually. And I'm recording this video on 7th March 2023. And I will be uploading all the 8 subjects marathon in the next 15 days. Okay, every day, every alternative day, we will be uploading one subject. Okay, so take care. Have a nice time. Please continue watching without any failure. Bye.
Good morning, all of you. Yes, here is our first concept, time value of money. You see, this is the basis for all chapters actually, time value of money, because without understanding the formulas and concepts in time value of money, we cannot understand the other chapters. So let us go for the first chapter, time value of money. You know the meaning of time value of money, right? The worth of a rupee received today is different from the worth of a rupee to be received in future, which means the money that we are receiving today is different from the money which we are receiving in the future. What do you say? Because of several factors. Especially the most important factors are inflation and risk. We are not ready to face inflation and we are not ready to take any kind of risk. So because of that reason, everybody will prefer today's money rather than the future money. What do you say? So in case if you are ready to accept the future money, you'll expect some compensation because you're going to face inflation and you're going to face risk. So since you're going to face inflation and risk, further you'll expect some compensation, which is known as what? The interest. So such interest can be calculated in different ways. Okay. And also the term time value of money means the value of money changes with time. The value of money changes with time. So today's money is different from future money. Today's money is different from future money. So we have to calculate this value of money at different points of time. We don't go for past, always will focus on future and today's money only. Is it clear? So as part of that, we need to understand several concepts like future value, present value, future value of annuity, present value of annuity, present value of perpetuity, and present value of growing perpetuity. So let me focus on the first area, future value. Future value means simply converting present value into future value. Conversion of present value into future value is nothing but what? Future value. So, which is also known as compounding. For converting present value to future value, we should multiply your present value with a factor called compounding factor 1 plus r whole to the power of n. So immediately after multiplying 1 plus r whole to the power of n with present value, we'll get future value. This will add some interest component. And if you want to know the compound interest which is included in the future value, please remove the principal portion from it. So present value into 1 plus r whole to the power of n is your future value, which is loaded with two components. One is your principal, other one is interest. If you remove principal from it, then we'll get what? The compound interest. The shortcut formula will be present value into 1 plus r whole to the power of n minus 1, right? This is a formula for compound interest. You can look at the formula here, compound interest, which is related to your future value. What do you say? See, this is regarding future value. What is the meaning of future value? Conversion of present value to future value. It is simply known as what? Compounding. Are you adding interest or you're deducting interest? You're adding interest. For adding interest on compounding basis, what we have to do? Simply multiply your present value with 1 plus r whole to the power of n. The term 1 plus r whole to the power of n will always add interest to your present value to get future value. Is it clear? Yes. The next one is conversion of future value into present value means discounting. What it means? Discounting. So our next concept is present value. My dear students, converting future value to present value means you're removing interest portion from future value. You're deducting interest portion from future value. How I can deduct interest portion from future value? Simply by discounting the future value at your desired rate of interest. Is it clear? So how I can discount the future value? Multiply your future value with 1 by 1 plus r whole to the power of n. This is known as discounting factor. This will remove interest portion from your future value to get what? The present value. So simply I can say one thing. Whenever you want to add interest, multiply your present value with 1 plus r whole to the power of n. Whenever you want to deduct interest, multiply your future value with 1 by 1 plus r whole to the power of n. Okay. So simply if you look at the formula here, present value is equal to future value into 1 by 1 plus r whole to the power of n. So by multiplying future value with 1 by 1 plus r whole to the power of n, we are going to deduct interest from the future value to get the principal portion today. And this there exists another formula for this. Present value is equal to future value into PVF r comma n. Instead of using this mathematical formula, I can refer this factor in the table itself. Okay. So which table, sir? I have to refer, which is known as present value factor table. Even for future value factor also, I can use the future value factor table. For 1 plus r whole to the power of n, I can use the factor table called future value factor table. Okay. This is regarding present value. Now we understood two concepts: conversion of present value to future value, conversion of future value to present value. Yes. The next area is future value of annuity. Yeah, if you can see the future value formula here, future value is equal to present value into 1 plus r whole to the power of n, and this 1 plus r whole to the power of n can be referred in the table called future value factor table. Yes. And you know, where r is what? Interest rate per period, n is number of periods, p is present value or principal amount. This is not principal, this principal amount, right? Okay. And 1 plus r whole to the power of n is compounding factor, 1 by 1 plus r whole to the power of n is discounting factor. Now the next concept is annuity. Annuity is a concept which will say what? We are going to receive future equal amounts. Future equal amounts. So if you convert such future equal amounts into present value, then that is known as present value of annuity. If you convert such future equal amounts into future value, then that is known as future value of annuity. What do you say? Yes. Let me show you simply. You see, we are going to receive some equal payments for the next 4 years, like periodic payments. If you are going to receive equal numbers in the future, and if you convert these future equal numbers into future value, which is a compounding case, right? Am I converting present values into future value or future values into present value? Present values into future value. So then this particular sum is known as what? Future value of annuity. What is future value of annuity? Conversion of multiple equal amounts into terminal year is known as what? Future value of annuity. We have a formula for this. For calculating the future value of annuity, we have a formula. Future value of annuity is equal to, look at the formula, capital R into 1 plus r whole to the power of n minus 1 by r. This one is a mathematical formula. My dear students, here capital R is a periodic payment. Capital R is a periodic payment. Look at this, where R is equal to periodic payment. And you know the terms, small r, interest rate per period, n is number of periods. You know that, right? So capital R into, this factor 1 plus r whole to the power of n minus 1 by r is known as future value of annuity factor, which is known as what? Future value of annuity factor. So what is the formula for future value of annuity? Capital R into 1 plus r whole to the power of n minus 1 by r. That's mathematical based formula. The second formula is capital R into future value of annuity factor r comma n. Instead of using this mathematical factor, you can refer it in the table. Okay. The table name is future value of annuity factor table. Yes. See, this is known as ordinary annuity. We have another annuity called annuity due, future value of annuity due. So what is this annuity due? In general annuity, in ordinary annuity, periodic payments occurs at the end of each year. Whereas in case of annuity due, periodic payments occurs at the beginning of each year. If periodic payments occurs at the beginning of each year, then you should not use the first formula. You have to use the second formula. So what is the second formula? Simple. For your regular formula, multiply 1 plus r. That's what you need to remember. Is it clear? So what is the formula for future value of annuity due if payments occurs at the beginning of each year? Capital R into 1 plus r whole to the power of n minus 1 by r into 1 plus r. You just need to multiply one factor called 1 plus r. That's it. Okay. So that will give you future value of annuity due. So what is the difference between first one and second one? In case of first one, payments occurs at the end of each year for annuity. In case of second one, payments occurs at the beginning of each year. That is what the only difference. But in both the cases, I'm converting all the values into future value. Are you getting my point? Yes, this is regarding future value of annuity. In the similar way, instead of converting these future equal amounts, periodic payments, into future value, if I convert all the equal amounts into present value, if I convert all the equal values into present value, then that is known as present value of annuity. See, here I am talking about annuity only, and I am talking about periodic payments which are equal only. See, only when your periodic payments are equal, then that is known as annuity, right or wrong? See, instead of converting such future equal values into terminal year, if you convert such future equal values into present value, then that is known as what? Present value of annuity. We have a formula for this present value of annuity. Look at the formula. Capital R into 1 minus 1 plus R whole to the power of minus n. Please change it. 1 minus 1 plus R whole to the power of minus n divided by R. 1 minus 1 plus R whole to the power of minus n divided by R. Or R. I mean the second formula. Capital R into PVAF R comma n. This particular mathematical formula 1 minus 1 plus R whole to the power of minus n by R represents present value of annuity factor. That will convert all the equal values into present value terms. Is it clear? Are you converting multiple equal amounts or multiple unequal amounts? Multiple equal amounts for a definite period. For a definite period. Are you getting? Yes. And that will give you present value of annuity. Yes, you know that R is periodic payment, and every term you know that, right? Nothing else. So with this we understood the concept of annuity, future value of annuity, and then what? Can I go for the next area? Yes, the next area is present value of perpetuity. My dear students, you know, if I convert multiple equal values for a definite period into present value, then that is known as present value of annuity. In case of annuity, the number of years are definite. Say 10 years or 15 years or 20 years. But in case of perpetuity, I am going to convert indefinite period future equal values into present value. That means I am not going to take a 5 years term or 10 years term or 20 years term. I am going to take 1 to indefinite period term. So if I convert 1 to indefinite period cash flows into present value terms, 1, 2, 3, up to how many years? Indefinite period. Here the cash flows occurs at the end of each year, and those are equal actually. Those are equal. If I convert indefinite period future cash flows, indefinite period future equal cash flows into a present value, which is known as present value of perpetuity. What was that? Remember one thing, in case of present value of perpetuity, the cash flows are always equal. The cash flows are always equal. Okay. Now, look at the formula for this present value of perpetuity. C by R, a simple formula. This is a simplified formula after deriving a big equation. Is it clear? Right. Now, look at the formula C by R, where C is cash inflows per period, cash flows per period. And then what R is? This is not capital R, this is small r. R is what? Discount rate, which is also known as investors' expected rate of return. Which is also known as what? Investors' expected rate of return. What is the meaning of present value of perpetuity? Conversion of indefinite period equal cash flows into present value. That's what present value of perpetuity. What is the difference between perpetuity and annuity? Annuity is all about equal values of definite period. Perpetuity is all about equal values of indefinite period. Are you getting my point? Yes. Now look at the next perpetuity. It is present value of growing perpetuity. Nothing new, dear students. Here also we are talking about indefinite period, but instead of taking equal cash flows, we are going to take growing cash flows. We are going to take growing cash flows. The cash flows are not equal here. Cash flows are not equal here. Here the cash flows are growing. And these cash flows will follow constant growth rate. Say, if your first year cash flow is 100, the second year cash flow follows 10% growth. The second year cash flow will be 110. The third year cash flow will be 121. That means every year you have to add 10% growth rate. And this growth rate is constant from first year ending to indefinite period. In that case, I'm not going to receive equal cash flows. In fact, I'm going to receive indefinite period growing cash flows. And such cash flows will follow constant growth rate. Then how I can discount such indefinite period growing cash flows? By using the concept, by using the formula called present value of growing perpetuity. Formula please. C1 by R minus Z. What is the C1 by R minus Z? Where C1 is cash flows, cash inflows at the end of period 1. Generally it is year 1. Okay. And then R is discount rate and G is growth rate. Understood? Yes. This is regarding present value of growing perpetuity. What is the formula? C1 by R minus G. We got, now we understood two formulas. present value of perpetuity and present value of growing perpetuity. This is also one of the formula. Effective rate of interest. When the compounding frequency is changing, like generally you can follow compounding frequency of every year. That means you can go for compounding for every year, or you can go for compounding for every half year, or every quarter, or every month, or every day. Like that you can go for compounding of your money for n number of periods. Is it clear? See, this is a formula which is applicable when we are following multiple times compounding in a year. Multiple times compounding in a year. Okay. In case if you are doing compounding for every year, then we don't need to apply this formula called effective rate of interest. Straight away we can answer this rate of interest actually. But the point is, in case if we follow the effective rate, in case if we follow the compounding frequency for every half year, or every month, or every quarter, or every day, then we have to apply this formula called effective rate of interest. You know the concept of compounding, right? Periodically we have to calculate interest, and that interest becomes a principal component for the next period, right? If I go over the compounding frequency of 1 year, every year I'll calculate interest, and that interest portion for 1 year will be added to the principal portion of your principal portion. And then for calculating interest for second period, I'll use the principal of first year and the interest of first year. Both the numbers should be considered, right or wrong? So interest on interest will be calculated for every year. And that's what compounding frequency for every year. In case if I follow compounding frequency for every month, then what I'll do? For every 1 month, I'll calculate interest, and that interest will be added to the principal. Then principal plus interest. On principal plus interest, I'll calculate interest for second month. Is it clear? In this way, I'll follow the compounding frequency. So in case if your compounding frequency changes, then please apply the formula called effective rate of interest. What is the formula? 1 plus R by M whole to the power of M minus 1, where R is interest rate per annum, and then M is number of times compounding in a year. So what is this number of times compounding in a year? Simple. In case if you are doing compounding on half yearly basis, then you are doing how many times compounding in a year? 2 times. Then M is equal to 2. If you are following 4 times compounding, that is quarterly compounding, then that will be, then in that case M is equal to 4. What do you say? Like that. In case if you are following monthly compounding, M is equal to 12. Yes. So tell me the formulas please. What is the formula for future value? Present value into 1 plus R whole to the power of N, or present value, or present value into future value factor R comma N, right? Then tell me the formula for present value. Future value into 1 by 1 plus R whole to the power of N, or present value is equal to future value into present value factor R comma N, right? What is the formula for future value of annuity? Ordinary annuity. Capital R into 1 plus R whole to the power of N minus 1 by R, or capital R into future value of annuity factor R comma N. What is the formula for future value of annuity due? Capital R into 1 plus R whole to the power of N minus 1 by R into 1 plus R. What is the formula for present value of annuity? Capital R into 1 minus 1 plus R whole to the power of minus N by R. Yes. Or capital R into present value of annuity factor R comma N. Present value of perpetuity C by R. Present value of growing perpetuity C1 by R minus Z. Effective rate of interest 1 plus R by M whole to the power of M minus 1. With this, we have completed time value of money. Okay. We are moving to the next chapter, cost of capital. You know what is the meaning of cost of capital? Cost of capital means calculating per annum cost to your capital. Per annum cost of your capital. A capital doesn't mean only equity share capital. A capital means every long-term source, equity share capital, reserves and surplus, preference share capital, long-term debt like debentures, loans from banks or financial institutions. For every source, I have to calculate the cost. And this cost is calculated by considering so many factors. Okay, after adjusting so many factors, we have to calculate this cost of capital. And this cost should be calculated at the beginning of each year. And this cost should be calculated in percentage terms. Is it clear? It is calculated for 1 year period. At the beginning of each year, it should be calculated, and it should be calculated in percentage terms. After considering so many factors, by adjusting so many factors, we have to calculate this cost of capital. You know, the objective of this chapter is to calculate the cost of the entire capital, but our capital includes so many sources. So your first objective is to calculate cost of individual sources. Is it clear? Yes. Now it's a simple definition. Cost of capital. It is a minimum rate of return earned on investments. At least you have to earn minimum. At least you have to earn this much return on your capital investments in the projects. And this can be used as a discount rate used in evaluating desirability of investment projects. Yes, you know, for calculating NPV, we have to use what cost of capital as the appropriate discount rate. And for calculating profitability index and investment decisions, we have to use the discount rate called cost of capital, because this is a minimum desired rate of return of all the long-term investors. And that much return you have to earn from your projects generally, right or wrong? Hello? Yes, yes. You know, this is the importance of cost of capital for taking capital busting decisions and your capital structure decisions, evaluation of final performance. And evaluation of final performance means you have to compare your cost of capital with rate of return, internal rate of return or actual rate of return, and other financial decisions. We should use this cost of capital as a basis. You know, what are the sources here? Equity share capital, preference share capital, long-term debt. Which cost you have to pay for equity share capital? Equity dividend. Which cost you have to pay for preference share capital? Preference dividend. And for debt holders, you should pay interest. So for calculating equity cost, I'm using one term called cost of equity. And for preference, cost of preference. And for debt, cost of debt. If I take the average of all these three sources, I'll get cost of capital, which is technically the weighted average cost of capital, because I cannot use the simple average for calculating the cost of capital. Am I right or wrong? So please tell me, what is the objective of this chapter? Calculating the cost of capital, which is technically known as weighted average cost of capital, also known as overall cost of capital. How I can calculate overall cost of capital? By calculating the cost of individual sources, cost of equity, cost of preference, cost of debt. Am I right? You know, if I say cost of equity, I should also consider cost of reserves and surplus. What do you say? And here debt means every debt source like bank loans, debentures, redeemable or redeemable bonds. Every debt source should be considered here only long-term debt, and you should not consider short-term debt. Now, and look at this sentence. Cost of capital is also known as investors' expected rate of return. Which investors? All the long-term investors. Am I right? All the long-term investors should be considered here. Now my first objective is cost of debentures. You know, debentures are classified into two types: irredeemable debentures, redeemable debentures. Say, in case if you are not redeeming the debentures in the entire life, then that such debentures are irredeemable debentures. For irredeemable debentures, life is not applicable, right? Forever you don't repay the principal. Coming to redeemable debentures, for redeemable debentures, there will be a specific life, say 10 years or 15 years. After that specific life, you can repay the principal portion of the debentures. In case if you're repaying such principal portion in installments, then that is a case of repayment in installments. So we have three cases here: irredeemable debentures, redeemable debentures in case of lump sum repayment, redeemable debentures in case of installment repayment. Okay. Now, you see, for calculating cost of irredeemable debentures, we are going to use one shortcut formula. I'll explain that. And for calculating redeemable debentures in case of lump sum repayment, we are going to use shortcut method or IRR method. And for installments, we have only one method. We cannot use any kind of formula. We have to use IRR method only. What do you say? Yes. You see, whenever you're calculating cost of any financial asset or financial instrument, you should check whether such financial instrument is a fresh issue or an existing instrument. Why? Because for fresh issue, the cost computation is different. And then for the existing instrument, you have to calculate cost computation separately. So the cost computation for fresh instrument is different from the cost computation of existing instrument. Are you getting? So whenever you're calculating cost of any instrument, you should check whether such instrument is fresh issue instrument or existing instrument. So we have to calculate cost of debentures in two cases: in case of fresh issue and in case of existing instrument. Yes. Okay. I'll explain this part. Please go for the debentures part. Yes. Here is your irredeemable debentures. Here is your irredeemable debentures. Look at the irredeemable debentures, my dear students. In case of fresh issue, what is the formula for cost of debentures KD? I into 1 minus T divided by NP, where I is interest, T is tax rate, and NP is net profits. The question, so why you are multiplying I into 1 minus T? Because I have to deduct tax saving on interest. In fact, the regular formula is what? I minus I into T, where I is my interest cost. I into T is my tax saving on interest. The benefit should be deducted from interest cost whenever I am calculating cost of debt. Am I right or wrong? Yes, that's why we have to deduct tax saving on interest from interest. So the true formula is I minus I into T by NP. So we will take the common term I out of it, then I'll get what? I into 1 minus T divided by NP. This cost of debt KD is also known as after tax cost of debt, which means the cost of debt after deducting tax saving. Is it clear? Yes. This is for fresh issue. In case of existing instrument, since this instrument is an existing instrument, we cannot get any net process. We cannot get any net process. Then I should consider the market price. What do you say? You see, I'll show you. Say, the first year, I've issued some debentures and I'll get some net process, right? At the end of the first year, I'm going to pay interest and I can also enjoy tax saving. So for calculating cost of debt at the beginning of first year, what I'm going to use? I into 1 minus T by NP. Am I right? But after 1 year, this particular debenture instrument, this particular debenture instrument becomes an existing instrument. So for second year, it's an existing instrument. I don't get any kind of net process. There will be a price for that particular debenture in the stock market. Please consider that price for calculating cost of debt. No change in I interest, because interest rate is always fixed. Interest amount is always fixed. And also you can enjoy the same tax saving. So I into 1 minus T remains same. But the denominator term is going to be changed to market price. And please don't consider net process. Please consider market price. Because I'm calculating second year beginning cost of debt. Is it clear? Yes. Look at the formula. KD is equal to I into 1 minus T by MP. Where I is interest, T is tax rate, MP means current market price of debentures. Got it? Yes. This is regarding irredeemable debentures in case of fresh issue and in case of existing instrument. Coming to redeemable debentures. Look at the redeemable debentures. For redeemable debentures, we have a life. That means such debentures will carry some life, say 10 years or 15 years. After such life, we are going to redeem such debentures. Even for redeemable debentures in case of lump sum redemption, cost of debenture should be calculated in two cases. In case of fresh issue and in case of existing instrument. We are going to use shortcut formula first of all. Then I'll go for the next method called IRR method or YTM method. Yes, look at the fresh issue. What is the shortcut formula? I into 1 minus T plus RV minus NP by N whole divided by RV plus NP by 2. This is for fresh issue. And in case of existing instrument, I into 1 minus T plus RV minus NP by N whole divided by RV plus, this is not NP, this is MP. Okay. RV minus MP by N whole divided by RV plus MP divided by 2. What do you say? Yes. Now, look at the terms where I is interest, T is tax rate. You know such terms, right? The new terms are what? RV and N only. RV is the redemption value. How much value you are redeeming? And then what? N is number of years. See, whenever you are writing redemption value, please be careful. Such redemption can be made at premium or it can be made at face value. In the absence of information, I should always assume redemption should be made at face value only. In case if you have an information like redemption should be made at premium, then please consider such premium. So please observe the information of the problem and follow accordingly. Is it clear? Yes. And N is life of debentures or number of years. Yes. We need to understand one important term called net process in both the formulas, both the set of formulas. Net process. How I can calculate net process? For face value, if I am issuing debentures at premium, then add premium. If I am issuing debentures at discount, then deduct discount. Then I'll get what? Issue price. From that, please deduct your issue expenses. What are the issue expenses? At the time of issue, I may incur some expenses like flotation cost, brokerage, underwriter's commission, right? Deduct it. Then you'll get what? Net proceeds. Then you'll get net proceeds. Is it clear? Yes. This is regarding cost of redeemable debentures with the help of a shortcut formula. Instead of this shortcut formula, I can go for YTM method, which is also known as IRR method. Okay, yield to maturity. So what to do? Step to determine cost of debt. Steps to determine cost of debt. Look at the steps here. First of all, you have to identify the cash flows associated with your debentures issue or for existing debentures. Here, cash flows. 0, 1 to n, n. Define the cash flows related to debentures issue. See, in initial year, 0 year, you'll get net proceeds, right? In case of fresh issue. In case if it is an existing instrument, please consider current market price in case of existing debt. NP or MP. And then 1 to n, please consider I into 1 minus t. That's the cash flow. And at the end of nth year, we'll go for redemption. Then the value will be redemption value. Please accept one thing. Consider this 0 year net process as an outflow and remaining 2 are your inflows. Okay. Consider 0 period net process as an outflow and 1 to n years interest into 1 minus tax rate and nth year ending redemption value as an the 0 year net process as an outflow and 1 to n years and nth year ending redemption value as an inflow. Is it clear? Hello all of you. Yes. And by taking these cash flows, I have to calculate cost of debt. What to do in step 2? Calculate NPVs of cash flows as identified above using 2 discount rates in such a way that you should get NPV is equal to 0. The discount rate at which NPV is equal to 0 is nothing but IRR, and that IRR becomes your cost of debt. Since I don't know the cost of debt, since I don't know the IRR rate, I should go with the guess rates. Generally, I should start with 10% discount rate, and then I'll go for the next guess rate 15%. Then I'll go for the next guess rate 20% until I get 0 NPV. In case if I get positive NPV at 15%, and in case if I get negative NPV at 20%, my IRR lies in between 15 and 20. Then I should use a method called interpolation for calculating IRR. What is the formula for IRR? In that case, L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. Right or wrong? Please accept this formula, multiply it. L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. This is a formula for calculating IRR when this IRR lies in between 2 discount rates. So that particular IRR becomes your cost of debt. This formula is and this method is applicable only when we are following YTM. Sir, what to do in the examination? Can I follow shortcut formula or I should follow YTM method? You know, when there is no information in the problem, then you can follow shortcut formula. In case if the problem is very specific about application of YTM method, then you have to calculate cost of debt accordingly only. Is it clear? Are you getting? So only if it is asked specifically in the examination, then follow YTM method. Otherwise, shortcut formula. Is it clear? Yes. This is regarding cost of debt, cost of redeemable debt, cost of redeemable debt in case of lump sum redemption. In case of lump sum redemption. Yes. You know, my dear students, I need to explain one important definition, value of a financial asset. What was that? Value of a financial asset. You know, value of financial asset or value of any asset. What is the definition? It is the present value of future cash inflows discounted at investor's expected rate of return. That is what the definition of value of an asset. What is the definition of value of an asset? Present value of future cash inflows discounted at investor's expected rate of return. Whenever you want to calculate value of any asset, define the future cash flows. Know the investor's expected rate of return. Then discount such cash flows at investor's expected rate of return. Then you'll get value of an asset. You know, for debentures, the future cash flows are interest cash flows. And redemption value in case if such debentures are redeemable debentures. And discount such cash flows, interest and redemption value at the investor's expected rate of return. Who is the investor here? Debenture holder. What is his expectation? Interest rate. and discount such interest future cash flows at his expected rate of return, expected interest rate, then to get what? The value of debenture. Is it clear? In the similar way, you can calculate value of bond. In the similar way, you can calculate value of preference share. In the similar way, you can calculate value of equity share. So wherever you are applying the value of an asset, then immediately please follow this definition. Define the future cash flows and know about the investor's expected rate of return and discount such cash flows. Then you'll get what? The value of the asset today. Are you calculating value of asset today or in the future? Today only. Are you getting? This is present value of an asset. This is present value of an asset. Which asset? Debenture, bonds, preference shares, equity shares. For any financial asset, follow this definition only. Is it clear? Yes. Yeah, the general cash flows. In case of irredeemable financial asset, what I am going to get? Interest or dividend. In case of redeemable financial asset, I'll get interest or dividend plus redemption value. I know that, right? Yes. What is the expected rate of return of debt holders? KD. What is the expected rate of return of preference shareholders? KP. What is the expected return of equity shareholders? KE. And those are the general expected rate of returns of the respective investors. And those rates should be used as a discount rate for calculating the value of the respective financial assets like debentures, bonds, preference shares and equity shares. Got it? Yes. You know, the value that you're getting after discounting the future cash flows is technically known as fair market price or fair value. Fair market value or fair market price. What do you say? Fair market value or fair market price. Then what to do? Generally, after calculating fair market price means the price at which the financial assets should be bought and sold. Should be bought and sold. Say for example, I have calculated the fair market price of a debenture and I got 105 as a fair market price. 105 as a fair market price. Actually, the same debenture is available in the market at 102. I am ready to offer 105. This is a fair price I can offer, right? But the same debenture is available at 102 in the market. Am I ready to buy this debenture or not? Yes. I can buy this debenture because I am ready to offer 105 higher price, whereas the debenture is available at lower price. What do you say? When it is available at lower price, can I buy this debenture? Yes, obviously. The same logic is applicable to preference shares and equity shares. In case if the fair value of one of the equity share is 1000 rupees, whereas the same share is available in the market at 950 rupees. You are ready to offer 1000 rupees for that particular company share, FMP, fair market price, whereas the actual market price in the stock market is 950 only. That means the share is available at lower price. Can you buy it? Yes, you can buy it. So what is the conclusion? In case if your FMP is greater than AMP, that means what it indicates, your AMP is lower, right? Hello? Your actual market price is lower. When your actual market price is lower, can you buy that financial instrument or not? Yes. In case if your FMP is less than AMP, what to do? You don't buy this particular debenture or financial asset. Hello? Generally, the comparison can be like this. I can write like this. AMP is less than FMP or AMP is greater than FMP. Now, understand that. Your AMP is less than FMP. That means the actual market price of debenture is available at lower price. Will you buy that debenture or not? In case if the same AMP is available at higher price, will you go for higher price? No. Are you getting? Yes. So tell me the definition of fair value or fair market price of any financial asset. It is a present value of future cash inflows discounted at investors' expected rate of return. Got it? Yes. Now go for the next source. Cost of convertible debentures. Cost of convertible debentures. So what is this cost of convertible debentures? It is just like redeemable debentures, but instead of redeeming the debentures in cash, we are going to issue certain number of shares. Okay. So here, look at the point here. First of all, you should understand what is the meaning of convertible debentures. Convertible debentures means debentures will be converted into certain number of shares after the life of the debentures. Say for example, The life of debentures is 10 years. Generally, what you will do? At the end of 10 years, you will repay the principal portion of the debentures, right? Redemption value. Instead of repaying the debentures, you can issue certain number of shares as promised by you at the time of issue of debentures. Say, for example, at the time of issue of debentures, you have promised the investors to convert such debentures into certain number of shares. Say, for example, each debenture is supposed to be converted into 10 number of shares. How many number of shares? 10 number of shares. Then after 10 years, are you going to redeem the debentures in cash form or in stock form? Stock form. That means you are going to convert such debentures into equity shares. That means the redemption value is not cash, it is shares. That means the redemption value will be 10 shares. The point is, you have to calculate the value of these 10 shares after 10 years. That's what the point. So for that, I should consider the nth year ending market price, that is 10th year ending market price, MP10. How I can calculate MP10, sir? Simply know your market price today for shares, for your company shares. Then that is known as MP0, right? MP0 is the current market price per share, current market price of equity shares today. If you add growth, if you add the applicable growth rate for that particular company share, whole to the power of n, then you will get MP10. Here, MP10 means MP0 into 1 plus c whole to the power of 10. So, consider the growth rate and apply this growth rate to your MP0 to get what? MP10. Say, for example, RV is equal to, how many shares you are issuing? How many shares you are issuing for each debenture? 10 shares. And for each share, the value is 12.5. How much you'll get? 125. You know, the market price of each share is 12.5. After how many years? 10 years. How much value the debenture holder will get? 125. 125 value of shares is going to receive, right? Instead of receiving the principal portion of 100 rupees. Is he happy or not? Yes, obviously. So, my dear students, accept one thing. In case of redeemable debentures, we will repay the principal in the form of cash. Whereas in case of convertible debentures, we will repay the debentures in the form of stock, shares. And that's why these debentures are known as what? Convertible debentures. So while calculating convertible debentures, the important aspect you need to consider is redemption value, because that redemption value is not a simple cash form. That is in the form of what? Shares. You have to calculate that. That's what your important point is. So look at this. Cost of convertible debentures. I'm using the same formula, nothing new. I into 1 minus C plus RV minus NP by N whole divided by RV plus NP divided by 2. You know, where RV is redemption value. How I can get redemption value? Number of shares for each debt. You know, each debt means each debenture. Number of shares for each debenture. Number of shares for each debenture into MPN. MPN means market price per share at the end of nth year. It is based on the life of redeemable convertible debentures. Okay. Now, how many shares you are issuing for each debenture into what is the share price at the end of nth year? So, MPN is equal to, how I can get MPN? MP0 into 1 plus Z whole to the power of N. So, if you add the growth rate applicable to your share price, then you will get MPN. So, if you multiply MPN with number of shares, you will get what? Redemption value. Are you getting? Yes. So, if you are able to calculate redemption value, then it is very easy to calculate cost of convertible debentures. Nothing new. The only problem here is calculating the redemption value. You should be very careful with this formula. Redemption value is equal to number of shares for each debenture into MPN, where MPN is equal to MP0 into 1 plus Z whole to the power of N. Here G is nothing but the growth rate applicable to your share price. How your share price is appreciating from one year to another year. Is it clear? Yes. This is regarding cost of convertible debentures. Now look at the cost of preference share capital. It's a simple task. If you know how to calculate cost of debentures, then you can easily calculate cost of preference share capital. Why? Because instead of taking I into 1 minus C, please consider preference dividend. That's it. Nothing new. Okay. See, in case of irredeemable preference shares, I'll use shortcut formula. Redemption lump sum shortcut method or YTM method also. I can use shortcut method or YTM method also. And in case of installments, I am going to use IRR method. For irredeemable preference shares, there will be two cases, fresh issue and existing instrument, right? Fresh issue. What is the formula? KP is equal to preference dividend by NP. What is the formula for cost of irredeemable debentures? I into 1 minus C by NP. Here I am going to use what? PD by NP. Sir, why you are not multiplying PD with 1 minus T? You don't get tax saving on preference dividend, right? That's why we don't multiply preference dividend with 1 minus tax. Whereas for interest, I'll get tax saving. Then that's why I'll apply I into 1 minus T there. Is it clear? So what is the formula for KP? Preference dividend divided by net profits for fresh issue. What about for existing instrument? Preference dividend divided by MP. And nothing new. Okay. For redeemable preference shares, the same formula. Instead of taking I into 1 minus T, I'll substitute PD. Tell me the formula. KP is equal to PD plus RV minus NP by N whole divided by PD plus RV minus NP by N whole divided by RV plus NP divided by 2. For existing instrument, PD plus RV minus NP by N whole divided by RV plus MP divided by 2. Am I right or wrong? The changing terms are NP net, the changing terms are PD, preference dividend. RV redemption value of preference shares. N is life of preference shares. Am I right or wrong? Yes. NP net process, you know that. MP means current market price of preference shares. My dear students, sometimes in the examination problems, you can find one term called dividend distribution tax. That means at the time of distributing preference dividend, the company is supposed to pay what? Dividend distribution tax. That will be part and parcel of your preference dividend cost. So what I have to do? Please add the dividend distribution tax to your preference dividend to calculate the cost of preference shares. You see, dividend distribution tax, company has to pay certain percentage of tax on the amount of dividend distributed, which becomes cost to the company. What I have to do? Dividend plus dividend into tax percentage. That means instead of taking PD, you have to write what? PD into 1 plus DDT. Nothing but dividend into 1 plus DDT. What it indicates? PD into 1 plus DDT, which indicates what? PD plus PD into DDT. Am I adding dividend distribution tax to my preference dividend or not? Yes, I'm adding it. So instead of taking preference dividend, what you have to consider? PD into 1 plus DDT. So that is what the new term you have to substitute whenever we have preference dividend tax rate or dividend distribution tax. The same formula you are going to use. Instead of taking PD, what you have to consider? PD into 1 plus DDT, dividend distribution tax. Got it? Yes, this is regarding cost of preference share capital. Okay. The next source is cost of equity share capital, right? The next source is equity and we have to calculate cost of equity. You know, estimating cost of equity is a difficult task. Why? Because you are estimating the variable future. Estimating cost of debt and cost of preference share capital is an easy task. Why? Because you are estimating the fixed future, right? Because I can easily estimate the interest component and I can easily estimate the fixed preference dividend component. But I cannot easily estimate the future dividends because those numbers are always variable, right? So in that case, we have several approaches to calculate cost of equity. So the first approach is dividend by price approach. Next one is earnings by price approach. And third one is dividend by price plus growth approach, earnings by price plus growth approach, capital asset pricing model. Finally, the last approach is realized yield approach. Okay, these are the approaches we need to understand. The first approach is dividend by price approach. Even for calculating cost of equity, we have to consider whether such instrument is a fresh issue or existing instrument. So in case of fresh issue and in case of existing instrument, in both the cases we have to calculate cost of equity. Am I right? Yes. Right. Yes. The first approach, dividend by price approach. For fresh issue, in this approach, always the future dividends are constant. The dividend per equity share is always constant. So just like preference dividend, you have to calculate cost of equity. For fresh issue, cost of equity KE is equal to DPS by net profits. And for existing instrument, the formula for cost of equity is DPS by MP naught. You see, here dividend per share is always constant. Under this approach, dividend per share is always constant. No growth is applicable. Is it clear, my dear students? Yes, we are considering dividend per share. under dividend by price approach. Just like preference share capital cost computation, instead of taking preference dividend, here we are going to consider dividend per share. And under earnings by price approach, instead of taking DPS, we are going to take EPS. So in dividend by price approach, equity shareholders expectation is DPS, whereas in earnings by price approach, equity shareholders expectation is profits. Simply EPS you have to consider. You have to consider what? EPS instead of DPS. So for fresh issue, the formula for cost of equity is EPS by net process, and for existing instrument it will be EPS by MP naught. No change in the denominator, okay? Always we are taking the same denominator, but instead of taking MP, we are taking MP naught. A specific notation is required for equity share because equity share prices will grow from one year to another year. Okay, this is regarding earnings by price approach. In dividend by price approach and in earnings by price approach, in both the cases, DPS and EPS both are constant and those numbers will never grow. Okay. Now, look at the third approach, which is very important. Often you can find this method in so many problems. Okay. So can I read the third formula? Dividend by price plus growth approach. Under this approach, dividends will follow constant growth rate from first year to indefinite period. So always the growth rate is constant. The dividends will grow from one year to another year. The dividends will grow from one year to another year. So that is the difference between dividend by price approach and dividend by price plus growth approach. In dividend by price approach, always dividends are constant. Whereas in dividend by price plus growth approach, dividends will grow. And that growth rate is constant. Remember that. Even for this method also, we should calculate cost of equity in both the cases, fresh issue and existing instrument. In case of fresh issue, KE is equal to DPS 1 by net process plus growth. And for existing instrument, DPS 1 by MP naught plus Z. So additionally, we should add one term called what? Growth. What do you say? Yes. It's a derived formula actually. It's a derived formula. KE is equal to DPS 1 by MP naught plus Z. That derivation is not required now. So now look at the terms. DPS 1 means expected dividend per share at the end of year 1. And we can arrive that number simply by multiplying DPS naught into 1 plus Z. Remember one thing, my dear students, DPS naught into 1 plus Z means 1 plus Z whole to the power of 1. If you add 1 plus, if you add this first year growth, simply I'll get DPS 1. How I can get this DPS naught into 1 plus Z whole to the power of 1. If you need dividend per share at the end of second year, simply multiply DPS naught into 1 plus Z whole to the power of 2. If you need fifth year ending dividend per share, then you need to do what? DPS naught into 1 plus Z whole to the power of 5. Like that, you can calculate dividend per share at the end of any year simply by multiplying the factor 1 plus Z whole to the power of n. That's a growth factor. Is it clear? Growth factor applicable to DPS. But I need DPS 1 here. That's why we have applied DPS naught into 1 plus Z. Am I right? Yes. And look at the next term, NP net process as usual. MP naught means current market price per share and G is always growth rate. Growth rate means growth applicable to dividends. The growth in dividends is clear? Yes. So we got dividend by price plus growth approach. In case of fresh issue, DPS 1 by NP plus Z. In case of existing instrument, DPS 1 by MP naught plus Z. The same logic is applicable to earnings by price approach. Nowhere in the problems you will find this formula. Just as part of understanding, you just read the formula. For earnings by price plus growth approach, instead of taking DPS 1, please consider EPS 1. EPS 1 by NP plus Z, EPS 1 by MP naught plus Z for fresh issue and for existing instrument. Nowhere you will apply this formula actually. You cannot find this formula in any problem. Always we are going to apply dividend by price plus growth approach. This is very important for the examination. Is it clear? Always, whenever you're reading cost of equity formula, you should always start with dividend by price plus growth approach. Dividend by price plus growth approach. The next approach is capital asset pricing model. See, all of the above approaches are estimation based approaches without considering risk. Whereas this approach, capital asset pricing model, will consider the risk component. Will consider what? The risk component. You know, investors will always expect some return. Equity shareholders will always expect some return based on the risk of the asset, right? And then this capital asset pricing model is developed by Sharp. And this Sharp says risk is classified into two parts. One is systematic risk, other one is unsystematic risk. And Sharpe says, expect premium only for systematic risk and don't expect premium for unsystematic risk. So what is this systematic and unsystematic risk? Unsystematic risk is company specific. Systematic risk arises because of macroeconomic factors which are unavoidable. See, interest rate fluctuations and GDP and then government tax policies. All these are what? Macroeconomic factors, foreign currency rate fluctuations. You cannot avoid these factors. In case if these adverse factors affects one company, these adverse factors will affect almost every company in India. What do you say? So your share price returns, the expected return related to shares will fluctuate because of these macroeconomic factors. And those macroeconomic factors will create some risk called systematic risk. And this systematic risk arises because of external factors which are unavoidable. Is it clear? Whereas unsystematic risk is company specific. It is based on the company's performance and company decisions. If company decisions are good, then you don't face any kind of risk. If the company's decisions are wrong, then, if the company's decisions are bad, then immediately you will face a lot of risk. Is it clear? So, in simple words, unsystematic risk is company specific, whereas systematic risk is market specific. That is applicable to every company in India. So, Mr. Sharpe says, don't expect premium for unsystematic risk because that can be eliminated through well-diversified portfolio, so called as diversifiable risk. This risk is diversifiable risk because if I can invest my money in all the companies in India, then I can avoid this unsystematic risk because my money is diversified, right? The abnormal loss from one security will be adjusted against abnormal gain from other security so that my mean return will be stable. So I'll get the minimum return. I don't face any kind of risk in case if I invest in all the companies in India. That means I can avoid the company specific risk by investing my money, by diversifying my money to all the companies in India. Is it clear? So that unsystematic risk can be eliminated. Diversifiable. Diversifiable means what? Investing in all companies in India. That is that can be avoidable. That can be avoidable. That can be eliminated. So Mr. Sharpe says, don't expect this premium for this unsystematic risk. Expect premium only for systematic risk, which is non-diversifiable. That means because of your decisions, you cannot eliminate interest rate fluctuations in the market. You cannot eliminate foreign currency rate fluctuations in the market. You cannot control government tax policies. You cannot control GDP values. Is it clear? So the macroeconomic factors are not going to be influenced by influenced by one investor's decisions. Is it clear? So one should face compulsorily the non-diversifiable risk, which is known as systematic risk. This is non-diversifiable. Even though you have formed a great portfolio, still you are supposed to face this risk called systematic risk. And the systematic risk is measured with what? Beta. The systematic risk is measured with what? Beta. So Mr. Sharpe says, expect premium only for systematic risk, beta. So basically, the objective of this capital asset pricing model is, for a given level of risk of any asset, how much return I should expect? For a given level of risk, for risk of any asset, how much return I should expect? That's what the question here. You know, Mr. Sharpe says, expect return only for what? Systematic risk, but not for, I'm talking about premium. Is it clear? So, Mr. Sharpe says, this is the formula for required rate of return. You know, this particular formula, RR, required rate of return, is nothing but KE, my dear students. Cost of equity, KE. Yeah, cost of equity, KE. This cost of equity, KE, is not based on estimations. It is based on what? The risk. The risk. Okay. And that too, which risk only? Systematic risk. So such systematic risk is measured with what? Beta. So elaboratedly, simply the formula is RF plus beta into RM minus RF. Is it clear? Yes. Where RF is risk-free rate of return, beta is beta coefficient, RM is rate of return on market portfolio, RM minus RF is market risk premium. There is a huge explanation behind this, but you just need to remember this formula. That's enough for solving the problems. Is it clear? What is the formula for cost of equity, KE? RF plus beta into RM minus RF. Here RF means risk-free rate of return. Risk-free rate of return means the return that can be earned on risk-free instruments, risk-free assets. Sir, what are the best examples for risk-free assets? Indian treasury bills, Government of India bonds, RBI bonds, all these are what? Risk-free instruments. So whatever the return you can earn from these instruments is simply known as risk-free rate of return. If in the examination problem, if you find the sentence like this, Government of India bonds or RBI bonds or Indian treasury bills, then immediately you please identify such instruments as risk-free instruments. The return from such instruments, the interest rate on such instruments becomes your RF. Is it clear? That will be your RF. And what about beta? Beta is a coefficient. Beta is a coefficient. That's a factor that ranges between, that can be more than 1 or that can be less than 1. You can find betas like this, 2, 1.8, 1.5, 0.8, like this. It will be near to 1 always. Is it clear? Yes. RM means return on market portfolio. The market return means the average market return. Generally, Bombay Stock Exchange, from the Bombay Stock Exchange, you will construct a portfolio called Sensex. So Sensex means it will take, nearly 30 companies from Bombay Stock Exchange. By taking top 30 companies from Bombay Stock Exchange, you will construct an index called Sensex. So the fluctuations in Sensex points is nothing but the fluctuations in the market portfolio. So if you take those 30 companies, if you calculate the average return of those 30 companies, then that will be known as RM, return on market portfolio. Are you getting? The return on market portfolio means top 30 companies in BSE. That can be considered as Sensex. Is it clear? So generally RM means the average market return or rate of return on market portfolio. Here market portfolio means which is consisting of top 30 companies in Sensex. In case if you take the Nifty means by taking top 50 companies from NSE, National Stock Exchange, you'll construct Nifty. Either Nifty or Sensex can be considered as a market portfolio for calculating return on market portfolio. Generally in the examination, you can find that term directly, that is RM. What was that? Average market return or return on market portfolio. That means you're taking top 30 companies average return. Okay? Top 30 companies average return. See, rate of return on market portfolio is also known as what? Average market return. And this RM minus, average market return or return on market portfolio. And this RM minus RF is what? Market. Yeah, this is market risk premium, my dear students. This is market risk premium. Market risk premium, or this is also known as average market risk premium. What was that? Average market risk premium. Now you please tell me what is the formula for RM minus RF? Market risk premium or average market risk premium. Please don't get any kind of confusion between these two terms. Average market return, average market risk premium. Both are different. Just by seeing average term, you please don't write RM. Is it clear? Please read the sentence very carefully in the examination problem. If it is average market return, then that is RM. If it is average market risk premium, then that is RM minus RF. Don't by heart the formula. Is it clear? Yes. So this is the way to calculate cost of equity under CAPM. Formula please. RF plus beta into RM minus RF. Yes. The last approach is realized yield approach. So what is this realized yield approach? Realized yield approach will consider the past few years average return. I am going to take the past few years average return. And that return I am going to expect in the future. Realized means what? The return which is realized in the past. The return which is realized in the past. Realized yield means already realized return. Already realized return. So whatever the return already we have realized, the same return you should expect from the share in the future. And that's what realized yield approach. So what is the formula for realized yield approach? Actually, there is no formula for realized yield approach. If I take the past 5 years or 10 years cash flows from a share, by taking such cash flows, I should calculate IRR. And that IRR becomes your cost of equity. So please calculate rate of return that is earned on the share, that is earned from the share from the past few years, like 5 years or 10 years, say 5 years or 10 years. If you take the cash flows, say for example, you have invested 100 rupees and you have received 5 rupees dividend from the past 10 years or past 5 years, and then you'll get at the end of the life, you'll get redemption value also. I mean, simply by selling the share, you'll get the sale process also, right or wrong? Say for example, you're holding this share from the past 5 years, 1, 2, 3, 4, 5. I'm taking equal dividends for just for sake of understanding. You have invested 100 rupees in the share. End of first year, every year you're receiving 5 rupees dividend. And the market price at the end of 5th year, that can be sold for 120 rupees. These are the cash flows. Now, all these 5 rupees dividends for the 5 years and this 120 rupees becomes your cash flow. And this is your investment, right? This is your investment. Consider this 100 rupees as an investment and consider these numbers 5 rupees as a cash flow, and even 120 should be considered as a cash flow. By taking these numbers as cash inflows, please calculate the IRR. What was that? IRR is the discount rate at which present value of all these cash flows should be equal to my investment of 100 rupees. Discount these dividends and discount this MP5 at a rate that should equate the present value of all these cash flows with what? 100 rupees. And that rate becomes a rate of return that is earned on this particular company share. Is it clear? And that itself is your IRR. That itself is your cost of equity. The same return you can expect this from this share in the future. So you can find few problems related to this particular concept in your materials, in your study material. So this is regarding what? Realize yield approach. We have a formula in this regard. This is for calculating holding period rate of return. Just remember this formula actually. This formula cannot be applied for calculating cost of equity under realized yield approach generally. This is a 1 year holding period return. This is a 1 year holding period return. What is this? Say for example, you're holding one company share for 1 year period. You're holding one company share for 1 year period and you have invested 100 rupees today. After 1 year, you're going to receive a dividend of 5 rupees and your share price is increased to 110. Now tell me, how much you have invested? 100. After 1 year, how much dividend you are receiving? And also your share price is 110. How much extra sale process you are getting? The gain, 10 rupees. So the rate of return I want to calculate. Simple. The rate of return is equal to, your investment is 100 today, right? And for that I am receiving dividend of 5 and also a capital gain of 10 rupees. 110 minus 100, right? So it will be 15%. Am I right? And this 15% can be interpreted as a formula. DPS1. Yes. 5 is a DPS1, right? Plus MP1 minus MP0. 110 minus 100 divided by 100 into 100. That gives me what? That 15%. That is rate of return. Rate of return on the company's equity share. Is it clear? Yes. So this is the cost of equity under realized yield approach. I can consider this as a rate of return actually. The rate of return on equity share. This is a holding period return. It is also known as a holding period return. You are holding this share for 1 year. So you will get this return for that particular 1 year period. My dear students, DPS1 by MP0 is dividend yield. MP1 minus MP0 by MP0 is capital gain yield. 5 by 100, 5% is dividend yield. 10 by 100 is 10%, that is capital gain yield. So your rate of return on equity share is classified into two parts, dividend yield and capital gain yield. What is the formula for dividend yield? DPS1 by MP0. What is the formula for capital gain yield? MP1 minus MP0 divided by MP0. Is it clear? Yes. Tell me the formula for rate of return, holding period rate of return. DPS1 plus MP1 minus MP0 whole divided by MP0 into 100. Got it? Dividend yield formula DPS1 by MP0. Capital gain yield formula MP1 minus MP0 divided by MP0. Let us revise all the formulas under cost of equity approach. Under different approaches for calculating cost of equity. Now tell me the formula for cost of equity under dividend by price approach. Fresh issue DPS by NP. Existing instrument DPS by MP0. Earnings by price approach. EPS by NP. Existing instrument. EPS by MP naught. Dividend by price plus growth approach. Fresh issue. DPS 1 by NP plus Z. Existing instrument. DPS 1 by MP naught plus Z. Yes. Earnings by price plus growth approach. Fresh issue. EPS 1 by NP plus Z. Existing instrument. EPS 1 by MP naught plus Z. Capital asset pricing model. Risk is classified into two parts. Systematic risk and unsystematic risk. Systematic risk is non-diversifiable risk. Unsystematic risk is diversifiable risk. So expect premium only for systematic risk, which is measured with beta. Formula for cost of equity under CAPM, which is based risk-based. Which risk? Systematic risk. Formula RF plus beta into RM minus RF, where RF is the risk-free rate of return that can be earned on what? The risk-free asset. Generally, the examples of risk-free assets are Government of India bonds and RBI bonds and Indian Treasury bills. And then what? Beta is a systematic risk, which is beta coefficient. RM means average market return or return on market portfolio. RM minus RF means market risk premium, also known as average market risk premium. Realized yield approach means the rate of return that can be earned from the past few years. And generally, we will apply IRR method for calculating cost of equity. Realized yield approach means the rate of return that is earned in the past, right? Now, please tell me the holding period rate of return formula. DPS 1 plus MP1 minus MP0 divided by MP0 into 100. With this, cost of equity KE formulas were completed, right? Yes. The next source is cost of retained earnings. Retained earnings belongs to equity shareholders, right? Whatever the return which is expected by equity shareholders on equity, the same return they'll expect from retained earnings in general. So what is the regular formula for cost of retained earnings? Cost of existing equity. Cost of existing equity. What is the formula for cost of retained earnings? KE. Cost of existing equity. So this is the regular formula. In case if you don't have any information regarding opportunity cost, flotation costs, personal taxes. If you have an information regarding opportunity cost, flotation cost, savings and personal tax, then automatically the formulas will change. When opportunity cost exists, please don't use the previous formula cost of retained earnings here. Please change your formula. If there is an opportunity cost of equity shareholders was given in the problem, then immediately KR is equal to K into 1 minus TP minus brokerage rate. This is a formula you need to apply. Where K is opportunity cost of equity shareholders, TP is personal tax rate, and from that you have to deduct brokerage rate. You just need to remember this formula when the opportunity cost exists in the problem. Is it clear? When personal tax rate and flotation cost exists, in case if the flotation cost is given in the problem, then you should apply this formula. KR is equal to KE into 1 minus TP into 1 minus flotation cost rate. Is it clear? Yes. See, this is what the cost of retained earnings in case if we have opportunity cost along with brokerage rate, if we have personal tax rate along with flotation cost. Yes, please repeat it again. What is the formula for cost of retained earnings KR? Cost of retained earnings KR is equal to cost of existing equity KE. In the absence of information about brokerage rate, personal tax rates and flotation cost. In case if opportunity cost exists and brokerage rate is available, then the formula will be KR is equal to K into 1 minus TP minus brokerage rate. If personal tax rate, flotation cost exists, then the formula will be KR is equal to KE into 1 minus TP into 1 minus F. Where F is what? Flotation cost rate. TP is personal tax rate. Got it? This is regarding cost of retained earnings. Rights issue. Rights issue means issuing shares to your existing equity shareholders in a certain proportion, right? So, generally, after issuing rights issue, after going for rights issue, your share price is going to be diluted. Why? Because the rights issue is generally made at a nominal price. Otherwise, the existing equity shareholders never subscribes the company's equity shares, right or wrong? See, there is a lot of difference between bonus issue and rights issue. Bonus issue means issuing equity shares at free of cost, whereas rights issue means issuing shares at a price which is a nominal price, which is generally lower than the current market price. Is it clear? So that particular issue price or the price at which the shareholders can be subscribed is simply known as subscription price. What was that? Subscription price. In the examination, they might have asked you to calculate X rights share price. What was that? That means after rights issue, what is the share price? That's what they can ask you. Okay. So what is the formula for X rights share price? This is P. Theoretical market price of shares when X rights are sold. Nothing but after rights issue, what could be the market price? What is the market price? That's what they're asking you. See, this P is known as X rights share price. That means the share price after rights issue. Is it clear? The formula is Mn plus SR divided by N plus R. M means market price of shares when cum rights are sold. Nothing but this is market price per share before rights issue. Capital M means what? Market price per share before rights issue. N is number of existing equity shares. So this M into N means the current market value of equity. The current market value of equity. Simply speaking. And now S into R. What is this S into R? The subscription price per share. That means the rate at which the right shareholders can be subscribed these shares. So the subscription price per share. Generally the subscription share price is generally less than what? The regular share price, the current market price per share. What do you say? Otherwise they don't subscribe this instrument. Into R. R means what? Number of shares, number of right shares. How many shares you are issuing for each equity shareholders? For example, if equity shareholders are having 2 shares, if you are issuing 1 share, then how many right shares are issuing for every 2 shares held by the existing equity shareholders? 1. For example, if there are 1000 equity shares outstanding in the company, how many right shares are going to be issued? 500 shares. If there are 1 lakh shares outstanding in the company, then how many right shares are going to be issued? 50,000. Are you getting? So, S into R. S means what? The subscription price per share. R means number of right shares. Mn plus SR means existing market value of equity plus number of new shares to be issued into subscription price. This is the extra wealth to be added. This is the extra wealth, extra value of equity to be added at a nominal price. The total value, the Mn plus SR represents the total market value of equity after rights issue. The total market value of equity after rights issue divided by N plus R. N is number of shares outstanding. Current number of shares outstanding. R is what? Number of right shares. So, the denominator term N plus R represents what? Number of shares outstanding after rights issue. So, total market value of equity after rights issue divided by number of shares outstanding after rights issue gives you what? Market price per share after rights issue, which is known as what? Theoretical market price of shares when X rights are sold. X rights are sold means what? X rights are sold means nothing but after rights. X rights means what? There is no rights issue. The rights are not applicable after this issue. What do you say? So X rights are sold means what? The complete rights issue is over. When the rights issue is over, then automatically the price becomes X rights market price. What was that? X rights market price. Nothing but the market price per share after rights issue. Now what is the formula for market price per share after rights issue? Mn plus SR divided by N plus R. Got it? And there is a formula for value of right. The rights, generally the shareholders can do few things. Either they can ignore this rights issue, or they can subscribe this rights issue, or they can sell their rights to outside investors. Is it clear? And at what price they are selling, that's their discretion. Generally, we have to calculate such rights, the value of rights. If you are holding some number of shares in the company, in case if the company is issuing right shares, you can sell your rights to other investors. You can renounce your rights to other investors. They can subscribe the rights issue. For that, you will expect some compensation. That's what the value of right. What is the formula for value of right? Cum right share price minus X right share price. Say for example, before rights issue it is 120, and after rights issue the share price is 100. Then it will be 20 rupees. This is what the value of right per share. Is it clear? This is what the value of right per share. So we got the formula for rights issue. With this, all the sources cost computation is completed. Then, this effective rate of interest rate method, this is not important actually. You don't have any problems related to this concept, effective interest rate method actually. You can read this part in the study material, which is not required, because even in the problems also you cannot find this method. Now look at the weighted average cost of capital. This is what the average computation of cost. This is what the objective of this chapter, determination of cost of capital, right? What is the objective of this chapter? Determination of cost of capital, determining the cost of capital. So already we understood how to calculate cost of every source. Cost of debt, cost of preference, cost of equity, cost of reserves. Now we are able to calculate the cost of all the sources, which is an average cost, also known as weighted average cost of capital, also known as overall cost of capital. Am I right? Yes. It is the average cost of capital of firms' existing operations, also called as composite or average or overall cost of capital. It can be computed by using two types of weights. One is market value weights, other one is what? If you take the balance sheet figures as a basis, then those values are book values. If you take the market figures as a basis, then those are market value weights. Are you getting? Yes, in case of book value weights, please consider balance sheet figures. How I can take these figures? Simple. Consider the balance sheet figures like equity share capital, reserves and surplus, preference share capital, debentures, bank loans, everything. Every number should be taken from what? The balance sheet. Is it clear? If you take the numbers from the balance sheet, and if you can calculate the weights, then such weights are known as what? Book value weights. And please consider reserves and surplus as one of the source. Please consider reserves and surplus as one of the source, because we are taking book values. We are taking book values. So in book value weights, we have to consider reserves and surplus as one of the source. You know what is the meaning of book value of equity? Book value of assets minus outside liabilities. Other way, total assets minus outside liabilities. Also known as what? Equity share capital plus reserves and surplus. Equity share capital plus reserves and surplus is nothing but book value of equity. Okay, this is regarding book value of equity. My dear students, in book value of equity, in book value weights, we should consider reserves and surplus as one of the source. Remember this point, okay? We should consider reserves and surplus as one of the source. All other sources are obviously taken, okay? Market value weights. In case of market value weights, please don't touch your balance sheet, but I need number of units with respect to each source. And such units must be multiplied with market price of each source. How I can get market value of each source? Market value of each source is equal to number of units into market price per unit. See, my dear students, if you want to calculate market value of debentures, the formula is number of debentures into market price per debenture. If you want to calculate market value of bonds, number of bonds into market price per bond. Number of preference shares into market price per preference share gives you market value of preference share capital. Number of equity shares into market price per equity share gives you market value of equity. Tell me what is the formula for market value of equity? Number of equity shares into market price per share. The market value of preference share capital, number of preference shares into market price per preference share. Market value of debentures, number of debentures into market price per debenture. Number of bonds into market price per bond. Are you getting my point? You don't need to calculate market price. That will be available in the problem itself. Is it clear? Yes. Now, my dear students, one of the important key point you should remember is in market value weights, we'll literally ignore what? Reserves and surplus. We'll literally ignore what? Reserves and surplus. Reserves and surplus is not one of your source for calculating market value weights. Please ignore such source. There is an exceptional situation. There is an alternative computation. I'll explain it later. First of all, remember these points. In case of book value weights, reserves and surplus is one of the source. In case of market value weights, reserves and surplus should be ignored. Is it clear? Yes. So how I can calculate weighted average cost of capital? You know, KE into PE plus KP into PP plus KD into PD plus KR into PR. What it means? You know, KE, KP, KD, KR are what? Costs. What about PE, PP, PD, PR? Proportion of equity, proportion of preference share capital, proportion of debt, proportion of reserves and surplus. Those proportions are your weights. Those proportions are your weights. Weights of each source should be multiplied with the cost of the respective sources, and sum up all those figures, the weights which are multiplied with cost, the sum will be your overall cost of capital, which is known as weighted average cost of capital. Generally, we don't use this equation. We're going to use the statement, right? I'll show you the statement. Here is the statement, my dear students. Calculation of weighted average cost of capital. This is a way to calculate weighted average cost of capital. What are those columns? Sources, source, amount rupees, proportion, cost of capital, proportion to cost of capital. Write every source clearly. Equity share capital, reserves and surplus, preference share capital, long-term debt. Write all the amounts. 1, 2, 3, 4. Add all the numbers. 1 plus 2 plus 3 plus 4. The amount should be added. You'll get the total. 1 by your total gives you what? Proportion of equity share capital. 2 by total gives you proportion of reserves and surplus. Proportion of preference share capital. Proportion of long-term debt. Should be multiplied with the respective sources cost. KE, KR, KP, KD. Then you'll get the numbers, the products, proportion to cost of capital. And this sum is known as what? Overall cost of capital. This overall cost of capital represents the cost of capital of your total fund. The average cost of capital on your total fund is nothing but cost of capital. You can compare this total number with what? The cost of capital. If for example, if your total is 100 crores and your cost of capital is 25%, which means annually the company is incurring 25% on uses of 100 crores money in the business. Is it clear? It has to earn at least 25% return from the business in order to satisfy the investors. Is it clear? Yes. This is regarding weighted average cost of capital, my dear students. See, dear students, if I calculate the average cost of capital of my total capital of the company, then that is WACC. In case, if I am raising some additional fund through different sources, say I am raising 10 lakh money through equity, preference and debt. 4 lakhs through equity, 4 lakhs through preference, 2 lakhs through debt. I am raising this 10 lakhs money additionally. Already I am having an existing capital structure. Are you getting? So for such 10 lakhs, I am raising 3 sources, equity, preference and debt. That means I have to calculate cost of such 10 lakhs separately. Is it that 10 lakhs is an existing capital or additional capital? If I calculate cost of capital on such additional 10 lakh capital, then that is known as weighted marginal cost of capital. What is that? So what is this marginal cost of capital? Marginal cost of capital means the additional cost of capital on additional fund. The additional cost of capital on additional fund. Here the additional fund is 10 lakhs. Please calculate the average cost of this additional fund, because I have to calculate cost of new equity, cost of new preference share capital and cost of new debt, and take the weighted average of all those 3 sources. Then that is not your weighted average cost of capital. That is weighted marginal cost of capital. That is nothing but what? Additional cost of additional fund. Is it clear to all of you? Generally, weighted marginal cost of capital is required to be calculated to evaluate the new projects. Why? Because I am raising such 10 lakhs additional fund to invest in a new project which requires 10 lakhs. So from the new project, I don't expect the existing capital return. I should expect the additional capital return. Why? Because I'm investing additional capital only in the new business, right or wrong? So for that reason, for evaluating new projects, generally we are going to calculate the additional cost of additional capital, which is technically known as WMCC, weighted marginal cost of capital. Such additional cost of capital should be used for calculating the NPV of that particular new project. Is it clear? Yes. So we'll consider marginal weights. That means additional sources weights. The weighted average cost of new or incremental capital. Incremental means additional capital. It is known as what? Marginal cost of capital. Now we understood all the concepts. Then we can go for 1 or 2 problems just for the sake of conceptual application. Then we'll move to the next chapter. Is it clear? Yes. See, dear students, here is the problem. Problem number 1. Calculate the weighted average cost of capital using the following data by using book value weights and market value weights. The capital structure of the company is as follows. Debentures 5 lakhs, preference shares 5 lakhs, equity shares 10 lakhs, total 20 lakhs. Their respective face values. The market prices of these securities are 105 debentures, 110 preference shares, 24 equity shares. Additional information. 100 rupees per debenture redeemable at par, 10% coupon rate, 4% flotation cost, 10 years maturity. 100 rupees preference shares redeemable at par 5% coupon rate, 2% flotation cost and 10 years maturity. Equity shares has 4 rupees flotation cost and market price of 20 rupees per share. The next year expected dividend is 1 rupee with an annual growth rate of 5%. The firm has practice of paying all earnings in the form of dividend. Corporate tax rate is 30%. Use a ITM method to calculate cost of debentures and preference shares. Have you observed one thing here? They are very specific about calculating cost of debentures and preference shares. We cannot use shortcut formula. We must use YTM method. Remember that, okay? That's the biggest task actually. First of all, for calculating weighted average cost of capital, we have to calculate cost of individual sources, cost of debentures, cost of preference shares, cost of equity shares. And they have started with cost of equity. Formula, DPS 1 by P naught minus. This is not F. Okay. Fine. Actually, the flotation cost must be deducted. Any information regarding flotation cost? Yes. Yeah, it's a case of fresh issue, right? Hello. 4 rupees flotation cost was given in the problem. What is the issue price? 24. How much is your issue expenditure? 4. Net process will be 24 minus 4. How much? 20. The denominator is net process actually. DPS 1 is 1 plus growth 5%. 1 by 20 plus 5%. How much it is? 10%, right? Hello. See, this is a case of DPS 1 by net process plus G. I know DPS 1 and G. And this net process is nothing but 24 minus 4. Because flotation cost must be deducted from issue price, right? How much is your issue price? Is it the face value or market price? Always equity shares issue price is market price. Your issue price of equity share should be equal to market price. You cannot issue the equity shares at the face value. If you issue the equity shares at face value, that will affect the interest of existing equity shareholders. What do you say? So because of that reason, always the issue price of equity shares is equal to market price, but not face value. Yes. Cost of debt. I cannot use shortcut formula. I must use the YTM method because the problem is very specific, right? First of all, I have to calculate few points here. Current market price minus flotation cost should be equal to I into 1 minus T present value of vanity factor R comma 10 plus RV into present value of vanity factor R comma 10. You know what it means? This is what the cash outflow in year 0, right? These are your inflows, right? I into 1 minus T and then what? RV. This is nothing but present value of cash inflows are equal to present value of cash outflows. IRR is the discount rate at which present value of cash inflows are equal to present value of cash outflows. I into 1 minus T is cash inflow and the redemption value is also a cash inflow, right? So use this discount rate. Do you know the discount rate here? You don't know the discount rate. When you don't know the discount rate, we should follow what? The guess rates. The guess rates. Okay. Generally, we need to define cash flows like this. Look at the format here once. Then you can understand what I'm telling you. See, here is the format for cost of debt using present value method or YTM method. Observe the cash flows pattern once. See your material, my dear students. Please look at the material and observe those 3 steps for calculating cost of debt. Okay. I hope you have gone through that. Can I go for the problem? Yes. You see, instead of defining the cash flows, they have given you the equation directly. Straight away. This is what NP, net profits, 104, 105 is the issue price, right? Market price minus flotation cost. How much is the flotation cost for debentures? 4%. So issue price is 105. On that, you have to pay 4% flotation cost. 105 into 4%. How much it is? Okay, deduct it. 100.8. That is the 0 period outflow. Cash outflow. And for that, we are going to receive future inflows. Future inflows means what? Interest into 1 minus tax rate and 100 is the redemption value. From investor's point of view, you are calculating this actually. The same cost should be considered for the company. Okay. So 10 into 1 minus 0.3. Interest into 1 minus tax rate should be multiplied with present value of annuity factor at IRR rate. I don't know the discount rate. That's why I have written R instead of the percentage. And the redemption value should be discounted at the same rate. And this is again R. So RHSI term represents present value of inflows, cash inflows, and LHSI term represents present value of cash outflows. The rate at which present value of cash inflows are equal to present value of cash outflows is nothing but IRR, right? So I don't know the discount rates. Here is the discount rates. Calculation of NPV at discount rates of 5% and so the first guess rate is 5% and the second guess rate is 7%. Sir, I don't know these discount rates. How I can apply these rates? Instead of taking these rates, you can straight away start with 10%. You'll get negative NPV. Then go with the next guess rate. How much? 5%. There you'll get positive number. What do you say? Then your first guess rate will be 5%. The second guess rate will be 10%. If you go with the interpolation between 5 and 10, you'll get IRR. You can go like that also. Is it clear? In case, if the same problem is given in the examination, they'll definitely going to give you the discount rates. They don't test you to take your own guess rates. Definitely they're going to give you the guess rates. You don't worry about it. You don't bother about it. Is it clear? Now, in the study material, they have taken 5% and 7%. Instead of that, you can take 5 and 10. No issue. Is it clear? At 5% discount rate, look at the inflows and outflows. This is 100.8 outflow, right? 7 is interest after deducting tax saving. 10 into 1 minus 0.3, 7. 100 is the redemption value. So those cash flows were discounted at 5% and we got positive NPV. And again discounted at 7%, we got negative NPV. Between these two numbers, we have done interpolation. IRR is equal to L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. L1 is lowest guess rate, L2 is highest guess rate, and by substituting the numbers, I got how much percentage? 6.89%. I'm not going for the calculations again. That will kill your time, right? Yes, you can do it. Yes, this is a way to calculate cost of debt. In the similar way, you can calculate cost of preference share capital. You see, 110 minus 110 into 2% should be equal to the preference dividend. We don't apply tax rate here. And then the redemption value. Yes, this time they have taken two discount rates, 3 and 5. Sir, how I can know these discount rates? You can apply any other rate, but ultimately you should consider the difference between positive and negative. Is it clear? Don't take 25% because you don't pay 25% preference dividend. What do you say? Yes, generally it ranges between 5 to 15% mostly. Okay, I hope you understood. Now look at the rates. In the examination, they're going to give you the guess rates. You don't worry about it. Now the first guess rate is 3% and the second guess rate is 5%. You know, 1 or 7.8 is my outflow in year 0. And 5 is a preference dividend from 1 to 10 years. Redemption value is 100. And by discounting these cash flows at 3%, I got positive. And at 5% discounting, I got negative. By using interpolation, we got IRR of how much percentage? 4.08%. This is cost of preference share capital. Are you understanding it? Yes. Nothing new. This is regarding cost of preference share capital. Which method we are using? YTM method. In case if the problem is not specific about YTM method, then you have to apply shortcut method. You don't bother about it. Definitely you can apply shortcut method. Is it clear? Only if the problem is very specific about the method of calculating cost of debt or cost of preference shares, and then you have to follow accordingly. Now my job is to calculate cost of weighted average cost of capital by using book value weights and by using market value weights. You know the format, right? Source, amount rupees, weights means proportion. Proportion into weight gives me what? Sorry, proportion to cost of capital gives me what? Weighted average cost of capital. Source, amount rupees, proportion, cost of capital, proportion to cost of capital. What are the sources? 10% debentures, 5% preference shares, equity shares. The amounts were given directly in the problem itself. You know the numbers which were given in the problem are always book values. Are you getting? Yes, those are the book values and these are the proportions. 5 by 20, 0.25, 5 by 20, 0.25, 10 by 20, 0.5. Already we have calculated costs of every source. Multiply those costs with the respective weights to get the weighted average cost of capital. 0.007743 is nothing but 7.74%. This is regarding weighted average cost of capital by using book value weights, right? Now you have to calculate weighted average cost of capital by using market value weights. Sir, how I can calculate market value weights? Calculate the number of units. You know how many number of debentures are there? 5 lakhs by 100, right? 5,000 debentures. How many number of preference shares are there? 5,000. How many number of equity shares are there? 10 lakhs by 10, 1 lakh. So those debentures and preference shares and equity shares should be multiplied with respect to market prices. 105, 110, 24. We got some values, right? Those values are book values or market values. And by using those market values, please calculate the proportions. If you multiply these proportions with respect to sources cost, you will get cost of capital, WACC, by using which weights? Market value weights. Are you getting my point? Now, my dear students, remember one thing here. Whenever you're calculating weighted average cost of capital by using book value weights or market value weights, the costs are always same. Based on weights, your costs of individual sources will never change. Either in market value weights or in book value weights, in both the cases, I'll use the same rates. Have you observed it? 0.0689, 0.0689, 0.0408, 0.0408 and 0.10, right? The same rates I have used. No change in the costs of the respective sources. Only the weights are changing. Is it clear? Don't change the cost whenever you're calculating weighted average cost of capital based on book value weights and market value weights. Only change the weights, not the cost. Cost of each source will change based on the instrument nature, whether it is a fresh issue or existing instrument. The cost of the respective source will never change, whether you're considering book value weights or market value weights. Book value weights or market value weights are no way related to what? The costs of the respective sources. Are you getting my point? Yes. Remember this important point, my dear students. Yes. And also sometimes in the in your study material, you can find one important point. Even in market value weights also, they might consider one important point, that is reserves and surplus. I have told you reserves and surplus should not be considered in market value weights, right? But the point is, sometimes even reserves and surplus will be considered in market value weights. Not the book values they are going to take. They don't take the reserves and surplus which is given in your book values. Instead of that, they'll bifurcate the market value of equity between equity share capital and reserves and surplus in the ratio of book value of equity share capital and reserves and surplus. So simply, even in market value weights, sometimes we may consider reserves and surplus, but I don't take reserves and surplus which is given in the books of accounts, which is given in the books. I'll take the reserves and surplus related to market value of equity. How I can take? Simple. The market value of equity will be split up. That should be split up into equity share capital and reserves and surplus in the ratio of book value of equity share capital and reserves and surplus. So I don't get book values. I'll get what? Market value of equity only. But that is split. That is bifurcated into two numbers. One is equity share capital. Other one is what? Reserves and surplus. Are you getting? In that way also, you can solve the problem. That's an alternative computation. You can find it in your study material. 1 or 2 problems are solved like that. Is it clear? Yes. With this, the chapter cost of capital is completed. Okay. Right. The next chapter is capital structure. You know, dear students, this capital structure indicates the structure of capital, the mix of capital, the composition of capital, and the proportions which we are using while raising the capital. So in which proportion we are raising every source. So the all of such proportions combination is simply known as what? The capital structure. So the objective of this chapter is defining the optimum capital structure in such a way that we should maximize the wealth of the equity shareholders. Wealth of the equity shareholders is nothing but market price per share maximization. So the ultimate target is to maximize the market price per share. This capital structure is all about financing decision. Which decision? You know, your financing decision will decide the capital structure. Yes. Maximizing the value of firm and minimizing the overall cost of capital. The ultimate target is to identify the optimum capital structure where your value of the firm should be maximized and the overall cost of capital should be minimized. Yes. Composition or mix or proportion of each source in the capital. You know, we have several sources like equity, debt, and also preference share capital, right? For every source, there are some features. Equity is the costliest source with no risk, but it dilutes control, right? Because more number of equity shareholders will enter into the company, it will dilute the control. It will dilute the control of existing equity shareholders. Whereas debt is the cheapest source, but it leads to high risk to the equity shareholders, but it will never dilute the control of existing equity shareholders. Wealth maximization. You know what is the meaning of wealth maximization? Wealth maximization is nothing but ultimately I should maximize the value per share. What is the formula for value per share? Market value of equity divided by number of equity shares. That is what the value per equity share or market value per equity share. What is the formula for market value per equity share? Market value of, this is market value. Market value of equity divided by number of equity shares. That gives you what? Value per share. See, this is nothing but MPS. You know, this market price per share can be calculated by using so many methods. We have several methods to calculate market price per share. We can use dividend growth model, or we can use earnings based models, or we can use a Walter model, Gordon model, Modiglian and Miller model. Like that, we can use so many models. Like there are so many models in the market to calculate value per share. So, but one of such model is P ratio based model. Throughout this chapter, we are going to use this P ratio based model only for calculating market price per share. How I can get the market price per share? First of all, know your formula PE ratio. PE ratio, P by E ratio. What is the meaning of P by E ratio? It is a ratio of price to earnings. Which price, sir? Market price per share. Which earnings, sir? Earnings per equity share. So MPS by EPS is a formula for PE ratio. What is the formula for PE ratio? Where P is price, E is earnings per share. P means market price per share, E means earnings per share. MPS by EPS is a formula. Is it clear? From this, can you calculate MPS? Yes. MPS is equal to EPS into P ratio. We got it right? Yes. So, the target is we have to fix such a capital structure which will maximize my market price per share. Ultimately, I should maximize the market price per share. So I have to identify alternative capital structures and I should choose the alternative capital structure where my market price per share is maximum. What do you say? Are you getting? Yes. Now, for all alternative capital structures, the sales, variable and fixed costs. The sales, variable costs and fixed costs are always constant. Yes. Look at the sentence here. For all alternative capital structures, the sales, variable costs, fixed costs are always constant. Why? Because your capital structure never changes your sales, never changes your variable costs and fixed costs. Your cost structure and revenue items never dependent on your capital structure. Your capital structure will change your interest payment, preference dividend payment and number of equity shares. So till EBIT, always your numbers are constant for any level of alternative capital structure. Is it clear? So EBIT remains constant. Always EBIT is always constant. What varies is interest on debt, dividend, and then what number of shares. Best alternative is means the alternative with higher market price per share. So what is the meaning of alternative here? Alternative capital structure. Alternative capital structure. See, look at the capital structures here. Alternative 1, alternative 2, alternative 3. I'll come to these points later. Okay. I'll explain these points again. Calculation of MPS under different alternative capital structures. This is what the format to calculate market price per share. First of all, know your EBIT. Accept one thing, for any alternative capital structure, EBIT is same. Throughout this chapter, for all the alternative capital structures, EBIT is always constant. Am I right or wrong? So EBIT is constant here. Less interest. It will change from one alternative to another alternative capital structure. Alternatives means The same total fund I'm going to use, but the proportions will change. In one alternative, I'm going to use more debt, whereas in other alternative, I'm going to use less debt. And for other alternative, I'm going to use no debt. Is it clear? Yes. Less interest, EBT less income tax, EAT minus preference dividend, earnings available to equity shareholders, which is supposed to be divided with number of equity shares to get EPS, and then that should be multiplied with PE ratio to get what? Market price per share. What is the formula for market price per share? EPS into PE ratio. Am I right or wrong? Yes. You know, this market price per share should always be maximum. Such capital structure which will maximize the market price per share is known as optimum capital structure. The alternative with higher MPS is optimal capital structure. Got it? Yes. As part of calculating this market price per share, you have to consider a few points here. Debt is inversely proportional to PE ratio. If debt is more, your PE ratio will be low. You don't need to calculate it. You can find it in your problems also. Always when debt is more, you can observe one thing. PE ratio will reduce. Is it clear? Because that creates a lot of risk. The PE ratio gradually reduces. And there is a direct relationship between MPS and PE ratio. More PE ratio, more MPS. What do you say? Why? Because MPS is equal to EPS into PE ratio. If PE ratio is more, MPS will be more. MPS is dependent on two factors. Earnings per share, which is multiplied with PE ratio. If the PE ratio is more, I'll get more market price per share, right? If EPS is more, I'll get more market price per share subject to PE ratio also. Is it clear? Now, the return on investment. Do you know the formula for return on investment? Return on investment means the return on your total capital. Write the total capital under denominator set, which is known as capital employed. And write the income of long-term investors in numerator, EBIT. EBIT is a profit which belongs to debt holders, preference shareholders, equity shareholders, all. EBIT is long-term investors profit divided by long-term investors capital is known as capital employed. So what is the formula for capital employed? Capital employed means all the long-term sources total. Equity share capital plus reserves and surplus plus preference share capital plus long-term debt, right? So if I add all the long-term sources, I'll get capital employed. Then if you multiply this capital employed with return on investment, I'll get what? EBIT. So that is what the next formula, EBIT is equal to capital employed into return on investment. This return on investment is technically known as return on capital employed. Return on capital employed means the rate of return that can be earned by the company by using long-term fund in the business. Is it clear? Yes, this is a before tax return. This is a before tax return. Whose return it is? Long-term investors return. So by using ROI or ROCE, return on capital employed, if you know the total capital employed, you can easily calculate EBIT. What is the formula for EBIT? Capital employed into ROI. Is it clear? Sometimes in the problems, they don't give you EBIT directly. Instead of that, they'll give you capital employed and they'll give you return on investment. You please multiply return on investment with capital employed to get what? EBIT. Is it clear? Yes. And this is a way to calculate MPS. Ultimate target of this chapter is to identifying the optimum capital structure where my market price per share is maximum. Please calculate market price per share for all the alternative capital structures where your MPS is maximum. Is it clear? Choose the alternative capital structure where your MPS is maximum. This is what the first concept. Now I'm going for the next concept, EBIT indifference point or EPS equivalency point. My dear students, generally for different alternative capital structures, I'll get different EPS. Am I right? Hello. Will you get same EPS for all the alternative capital structures? No. EPS will differ from one alternative capital structure to another alternative capital structure. You may get less alternative capital structure, less EPS for first alternative capital structure and more EPS for second alternative capital structure. But the point is, EBIT indifference point or EPS equivalency point. The term itself is saying what? EPS equivalency. That means you'll get same EPS. Equivalent EPS. Same EPS. Point. Point means the EBIT amount. And also known as EBIT indifference point. See, I'll tell you one point. If I take two alternative capital structures, generally for a given level of EBIT, I'll get two different EPS numbers. If I change my EBIT number, I'll get other EPS numbers for two alternative capital structures. But there will be one point at that EBIT level, I'll get same EPS for those two alternative capital structures. The level of EBIT or the amount of EBIT where the EPS of two alternative capital structures are equal is simply known as what? EBIT indifference point or EPS equivalency point. Because at that EBIT level, you'll be indifferent. That means you'll get same EPS. Both the capital structures are same to you because those capital structures are giving you same EPS. Is it clear? Yes. How I can get that EBIT amount? That means how I can calculate EBIT indifference point. See, in the examination, they'll ask you to calculate EBIT indifference point. That means they're asking you to calculate EBIT amount at which EPS of two alternative capital structures are equal. Then in that case, please use this equation. EPS of alternative 1 should be equal to EPS of alternative 2. How I can get EPS of alternative 1? EBIT minus interest EBT into 1 minus tax EAT minus preference dividend EASH divided by number of equity shares EPS of alternative 1 should be equal to the same expression. So what is the expression here? Please repeat it. EBIT minus interest into 1 minus tax minus preference dividend whole divided by number of equity shares of alternative 1 should be equal to the same equation for alternative 2. Substitute all the numbers of alternative 1, interest, tax rate, preference dividend and number of equity shares related to capital structure 1, alternative 1 capital structure. And then again substitute the interest, tax rate, preference dividend and number of equity shares of alternative 2. In both the alternatives, the tax rate is always same. But interest, preference dividend and number of equity shares will change. Am I right or wrong? Yes. Then, you know one thing, please don't try to substitute EBIT because you are trying to calculate EBIT. So EBIT is a variable number here. Then try to calculate EBIT from it by solving this equation. Then that particular EBIT answer is this is your EBIT indifference point or EPS equivalency point. At this EBIT, you'll get same EPS for alternative 1 and alternative 2 capital structures. Am I right? I'm moving to the next area, financial break-even point. So what is this financial break-even point? You know, my dear students, generally, if you calculate EPS for one alternative capital structure, if you calculate earnings available to equity shareholders for one alternative capital structure, then it can be positive. Or you may get high earnings or you may get low earnings. Ultimately, you'll get EASH, right? If I take one alternative capital structure called alternative 1, which is having debt and equity, and I know the EBIT number. If I calculate EASH, I'll get some number that is positive, right? If I change the EBIT, I'm reducing my EBIT. My EASH will decrease, right? And again, I'm decreasing EBIT. EASH will decrease. But there will be one point at that EBIT level, you'll get 0 EASH. That means the earnings available to equity shareholders will get EASH is equal to 0. The equity shareholders earnings becomes 0 at one level of EBIT. And that level of EBIT is known as financial break-even point. Financial break-even point means it is the level of EBIT. It is the amount of EBIT at which the profit of equity shareholders, the earnings of equity shareholders, EASH, profit after tax and preference dividend should be equal to 0. Am I right or wrong? So, simply, financial break-even point means it is a level of EBIT at which EASH is equal to 0. That is what the conceptual background. Now the point is, for calculating financial break-even point, what I have to calculate? You know, they're asking you to calculate EBIT amount at which EASH is equal to 0. Do you know such EBIT level? We don't know. And that EBIT level is known as financial break-even point. For that, we are going to use a formula called EBIT is equal to interest plus preference dividend divided by 1 minus tax rate. This is a derived formula from this equation. Okay. So what is the formula for financial break-even point? EBIT is equal to interest plus preference dividend divided by 1 minus tax rate. Whenever they ask you to calculate EPS, you'll go with the format, right? EBIT minus interest, EBT minus tax, EAT minus preference dividend, minus, I'll get EASH divided by number of equity shares, I'll get EPS, right? Yes, that is the way to calculate EPS. And if they ask you to calculate financial break-even point, in the similar way, for the same capital structure, you please calculate financial break-even point is equal to EBIT is equal to interest plus preference dividend divided by 1 minus tax rate. You please calculate financial break-even point for each capital structure separately. Just like EPS, financial break-even point should be calculated for each capital structure. Whereas for EBIT indifference point, you'll calculate EBIT indifference point not for every capital structure, but for 2 capital structures. Is it clear? If you want to calculate EBIT indifference point, how many capital structures are required? 2. Definitely we need what? 2. A and B, B and C, A and C like that. Okay. Whereas for calculating EPS of a financial break-even point, I need one capital structure. In the examination, they'll ask you to calculate EPS and financial break-even point. What it means? You have to calculate EPS. You have to calculate EPS for every capital structure, but also you have to calculate EBIT, financial break-even point, right? Financial break-even point for every capital structure. Is it clear? If they ask you to calculate EBIT indifference point, what we have to do? We have to calculate separately for A and B, B and C, and then what? A and C. If there are 3 capital structures. If there are only 2 capital structures, A and B, then please calculate EBIT indifference point for A and B only. Is it clear? Yes. Please go through these concepts once. Then we'll go for the next part of this chapter. Capital structure theories. Yes. The second part of this chapter will focus on whether financing decision can affect the value of the firm or not. That's what our discussion is all about. See, some theories said the value of the firm is going to be affected by financing decision, and some theories said the value of the firm remains unaffected by the financing decision. See, those theories said the financing decision is having an impact on value of the firm. Such theories are known as theories of relevance. And those theories which says the financing decisions are irrelevant for value of the firm, and such theories are known as theories of irrelevance. We have to understand both of these theories. Is it clear? Yes. Financing decision means capital structure changes. If you change your financing decision, that means you're changing your capital structure. That means you're changing your debt and equity mix. Because of the change in debt and equity mix, then automatically your value of the firm is going to be affected. And that's what theories of relevance says. Theories of irrelevance says, even though you're changing your debt and equity mix, it won't affect the value of the firm. So, okay, fine. One by one, we have to understand. There are several theories. Net income approach. See, trade-off theory. Trade-off theory is a descriptive theory. It's a descriptive theory. Net income approach, traditional approach, Modigliani and Miller approach, net operating income approach. In Modigliani and Miller approach, we have 2 approaches: without taxes, with taxes. Yes. First of all, let us focus on net income approach. Under net income approach, if you change the debt and equity mix, automatically it changes your cost of capital. That's what NA approach says. NA approach says what? If you change the debt and equity mix, if you change the capital structure, your cost of capital KO will change. If cost of capital KO changes, automatically the value of the firm changes. My dear students, there are a few formulas for understanding this. First of all, I'll tell you such formulas. What is the formula for value of debt? Whenever you want to calculate loan amount, what will you do? Interest divided by KD, right? You'll apply interest divided by interest rate, interest by KD. Then what is the formula for value of equity? Simple, equity shareholders profit, EA ESH. EA ESH divided by KE. This will be a value of equity. And what about the value of the firm? The formula for value of the firm is EBIT divided by KO. This is a way to calculate value of the firm. Value of the firm is also known as value of the firm is equal to firm value means investor's value. That means equity value plus value of equity plus value of debt. Is it clear? You see, now please tell me value of debt, interest by KD, value of equity, EA ESH by KE, value of the firm, EBIT by KO. Value of the firm is equal to value of equity plus value of debt. Now, look at the value of the firm. What is the formula? EBIT by KO, where KO and EBIT are the influencing factors for value of the firm, right? And in these theories, EBIT is always constant. EBIT is always constant. The only changing number is KO. Weighted average cost of capital KO changes because of the changes in capital structure generally. In case if your KO changes because of the changes in debt and equity mix, then automatically your value of the firm changes. In case if your KO is constant because of the changes in debt and equity mix, then your value of the firm remains constant. So if your KO is constant, value of the firm is constant. If your KO is changing, value of the firm will change, right or wrong. KO is going to be influenced by changes in debt and equity mix. Changes in debt and equity mix is nothing but changes in your capital structure. Changes in capital structure arises because of changes in financing decision, right? So if you change your financing decision, it changes your debt and equity mix, it changes your cost of capital, it changes your value of the firm. That means such theory says the change in debt and equity mix will have an impact on the value of the firm, right? The such theory says financing decision is relevant for value of the firm. Financing decision will change your wealth. Is it clear? Yes. In case even though you're changing your debt and equity mix by changing your financing decision, still if your cost of capital KO is constant, then that indicates your value of the firm is always constant because your KO is not dependent on your capital structure changes. Is it clear? Yes. So as part of that, we have to understand this series. I'll tell you a few points here. Net income approach. Under net income approach, KO will change. KD and KE are constant. Under NA approach, KD and KE are constant, whereas KO will change. KD and KE are constant. I'm not defining the graphs here, but KO will change. When KO changes, value of the firm will change, right? What do you say? Yes. See, under this net income approach, these 2 points should be considered. What are those 2 points? KD and KE are constant. KO will change. Now look at the valuation model. First of all, in step number 1, we have to calculate EAESH. How to calculate EAESH? EBIT minus interest, EAESH. And in this series, I don't consider corporate taxes. Is it clear? The taxes are absent always. Okay. EBIT minus interest, EAESH. Step number 2, calculation of value of equity and value of the firm. How I can calculate value of equity and value of the firm? First of all, please calculate value of equity. What is the formula for value of equity? EAESH by KE. Then I'll get value of equity. Please add value of debt to value of equity to get value of the firm. Are you getting my point? Then we'll go for calculation of overall cost of capital KO. Already we have calculated value of the firm. From that you can calculate overall cost of capital KO. What is the formula for cost of capital KO? EBIT by value of the firm. You please tell me what is, how many steps are required for valuation in NA approach? 3 steps. Step number 1, EBIT minus interest, EAESH. Then, you know, EAESH is also known as net income. Net income available to what? Net income available to whom? Equity shareholders. Yes. Calculation of value of equity and value of the firm. Tell me, value of equity is equal to EAESH by KE plus value of debt will get value of the firm. Overall cost of capital KO, EBIT by value of the firm. This is which approach? NA approach. Under NA approach, what are the points we have to remember? KD, KE are constant. KO will change. And this is a valuation model you have to follow. Is it clear? Let me go for the next theory, NOI approach. I'm moving for net operating income approach. You know, under NOI approach, there are some factors you have to accept. Under NOI approach, net operating income approach, KD, KO are constant. KD and KO are constant. KE will increase. KE will increase. So what are the points you have to remember in NOI approach? KD, KO are constant. Under NOI approach, KD, KO are constant. Whereas KE will increase. I'm not telling you the concept clearly. I'm just telling you the few important points in this theory. Is it clear? Yeah, tell me. What are the important points you have to remember under NOI approach? KD, KO are constant. KE will increase. What about NI? KE, KD are constant. KO will change. Right or wrong? So what is the point here? Net operating income approach. You know, under NOI approach, whatever the capital structure you're using, whatever the debt and equity mix you're using, you can increase your debt or you can decrease your debt. But that will never affect your cost of capital KO. KO, right? KO is always constant. I'm using 70% debt, 30% equity. I'm using 50% debt, 50% equity. I'm using 100% equity, 0% debt. In all these 3 capital structures, my KO is constant. That's what NOI approach says. Cost of capital KO is always constant. When KO is constant, value of the firm will be constant, right? I'm not saying that KE is constant. I'm saying that only KO is constant. Is it clear? Yes. In that case, look at the valuation models here. Valuation. Don't look at this packing order theory. Okay. Is it clear? Net operating income approach. What are the what is the valuation model? What are the valuation models here? NA approach valuation model and NOI approach valuation model. Just look at these 3 steps only. Step number 1, EBIT minus interest, EISH. Step 2, the step 1 is same, which is similar to NA approach, right? Step 2, we have to calculation of value of equity and that's it. Calculation of value of equity, that's enough. How I can calculate value of equity? First of all, I have to calculate value of the firm. What is the formula for value of the firm? EBIT by KO. EBIT by KO. From that value of the firm, please deduct value of debt. Then I'll get value of equity. Please tell me how to calculate value of equity. Value of the firm is equal to EBIT by KO minus value of debt. I'll get value of equity. Sir, why you are deducting value of debt? Because value of the firm means value of equity plus value of debt. If you remove debt value from value of the firm, I'll get equity value, right? Yes. Now calculation of cost of equity KE. Already we know the cost of capital KO. Now we have to calculate KE. What is the formula for cost of equity KE? EAESH divided by value of equity. EAESH divided by value of equity. Got it? Yes. Now, repeat it. What are the important points in NY approach? KD and KO are constant. KE will increase. Valuation model. Step 1, EBIT minus interest, EAESH. Step 2, calculation of value of equity. Value of the firm is equal to EBIT by KO minus value of debt, value of equity. Step 3, calculation of cost of equity KE. Cost of equity KE is equal to EAESH divided by value of equity. What do you say? With this, NY approach is over. NY approach is a theory of irrelevance. Why it is known as theory of irrelevance? Because your KO is always constant. Your value of the firm is always constant. Whereas NA approach is a theory of relevance. Why? Because value of the firm is changing. Because KO is changing here, right or wrong? When KO changes, firm value changes. When KO is constant, firm value is constant. Is it clear? KO changes, theory of relevance. KO is constant, theory of irrelevance. That is regarding NA and NOI. Go for the traditional approach. Traditional approach shows optimum capital structure, the level at which the overall cost of capital is minimum and value of the firm is maximum. Are you getting? Traditional approach says what? The importance of traditional approach is KD and KE are constant up to certain level. After that, both KD and KE will increase. KD and KE are constant up to certain level of debt. After that, both KD and KE will change. In the similar way, KO will decrease and KO will increase. So which points I have to remember? Under traditional approach, you have to remember one point. KO will change. KO will change. That's why this is known as theory of relevance. In traditional approach, KO will change. KO will change. That's it. That means when KO changes, firm value changes. So is it a theory of relevance or theory of irrelevance? Sir, how I can calculate value of the firm and value of equity and cost of equity and all? The same methodology which is applicable to net income approach, you have to apply here also. Is it clear? So the valuation models are same for NI approach and traditional approach, but the factors KE, KD will change. The factors KD, KE will change. In NI approach, KD and KE are always constant, right? Whereas in traditional approach, KD, KE will change. Along with what? KO. Along with what? KO. The ultimate objective of traditional approach is identifying the optimum capital structure where the value of the firm is maximum. What is the meaning of optimum capital structure? Optimum means best capital structure. At the best capital structure, my cost of capital should be minimum. The value of the firm should be maximum. Is it clear? Yes. This trade-off theory. Trade-off theory means if you increase the debt equity ratio, that means if you increase the debt, then automatically you can enjoy more tax saving on interest. But at the same time, that leads to bankruptcy. Why? Because if it increases debt portion, there is a huge debt obligation on the company. In case if the firm faces losses, it leads to bankruptcy of the company. Right or wrong? Hello? Yeah, you should balance these 2 points. What are those 2 points? Debt and equity. If you use reasonable debt, then it leads to better benefits related to debt component. You can enjoy some extra income because of uses of debt. Why every company will use debt? Because by using debt, we can get more return. But by paying less interest on debt capital, we'll get more extra margin because of debt capital. That margin will be available to whom? Equity shareholders. So by using debt, I can provide some extra return to the equity shareholders. Say for example, if you use 100 crores worth of debt, I'll get 30% return from the business. I'll pay 10% interest on debt. Extra margin is 30 minus 10. That will be 20% extra margin. 100 crores into 20%, 20 crores is extra profit after paying interest. Such extra profit will be available to whom? Equity shareholders. That will increase the earnings of equity shareholders. That will increase the return of equity shareholders. Am I right? Just because debt is increasing extra income of equity shareholders, please don't use excess debt, because in case if you face losses, it will absorb your equity. So there should be a balance between debt and equity. Such balancing of debt and equity is nothing but what? Trade-off. Trade-off theory. Is it clear? Yes. Risk return trade-off theory. Do you know that? Yes. We understood NI, NOI, traditional approach. Now we can go for Modigliani and Miller approach without taxes. You know, M&M without taxes. M&M, Modigliani and Miller. These two persons will say always the financing decisions are irrelevant for value of the firm. And they have classified the firms into two parts, two types. One is levered firm, other one is unlevered firm. Levered firm is the firm which is using financial leverage, debt. Unlevered firm is a firm which is not using financial leverage, called debt. That means levered firm is a firm with debt and equity. Unlevered firm is a firm without debt. That means only equity. So I can say levered firm is debt plus equity. Unlevered firm means all equity. Am I right or wrong? Yes. So Modigliani and Miller says the value of levered firm and the value of unlevered firm should be equal. In case if those two firm values are not equal, we can bring the values of those two firms into equal values, equilibrium position, by using a process called arbitrage. Is it clear? Yes. So according to him, value of levered firm and value of unlevered firm, both of such firms should be equal. Look at the formula. Proposition 1. Value of levered firm should be equal to value of unlevered firm. LF means levered firm, ULF means unlevered firm. Both the firm values are equal, right? What is the formula for EBIT by KO? What is the formula? Where KO is equal to KE of unlevered firm. All equity firm, KE is nothing but KO of unlevered firm, right? See, for an unlevered firm, are you going to use debt? No. Unlevered firm means with all equity. For an unlevered firm, KE is nothing but KO. Are you accepting this statement? So such KO should be used for both the firms, levered firm, unlevered firm. So what is the formula for value of levered firm and value of unlevered firm? EBIT by KO. What is KO here? KO is equal to KE of all equity firm, KE of unlevered firm. Is it clear? This is proposition 1. In proposition 2, I'm going to calculate cost of equity of levered firm. I'm going to calculate cost of equity of. What is the formula for cost of equity of levered firm? EA ESH divided by value of equity. And we have second formula also. KE of levered firm is equal to KO of unlevered firm plus KO of unlevered firm minus KD into debt by equity. Look at the formula here. What is the formula here? KO of unlevered firm, KO of unlevered firm plus KO of unlevered firm minus KD into debt by equity. Am I right? Yes. Here is the formula. Tell me, what is the formula for cost of equity of levered firm? EA ESH divided by value of equity. Or the second formula, KO of unlevered firm plus KO of unlevered firm minus KD into debt by equity. This is proposition 2. Now tell me what M&M without taxes says. Value of levered firm and value of unlevered firm, both are same. Tell me the formula for value of levered firm and value of unlevered firm. EBIT by KO. Proposition 1. KO is equal to KE of unlevered firm. What is proposition 2? KE of levered firm. Formula EA ESH divided by value of equity. What is the second formula? KO of unlevered firm plus KO of unlevered firm minus KD into debt by equity. Are you getting? You know, in this theory, you should also calculate one more point. Value of equity of levered firm. Value of equity of levered firm is equal to value of levered firm minus value of debt. What is the formula? Value of equity of levered firm is equal to, tell me the formula, value of LF levered firm minus value of debt. Why? Because in levered firm value, there will be two investors value. One is equity holders value, another one is debt holders value. If you remove debt value from firm value, then you'll get what? Value of equity. What about value of equity of unlevered firm? Value of equity of unlevered firm is equal to value of unlevered firm. Why? Because in unlevered firm there won't be any debt, right? Is it clear? Yes. Remember this point also. With this M&M without taxes is completed. Now look at the next theory, M&M with taxes. You know, M&M with taxes. They have introduced corporate taxes. If we consider corporate taxes, value of levered firm will be more than value of unlevered firm. Why? Because levered firm is using debt. On debt, the company will pay interest so that it can enjoy tax saving on interest, and such tax saving will be generated for perpetual years. So such extra benefit on interest on debt, the tax saving on debt, such extra benefit of tax saving on interest in the future will increase the value of the firm. That's why the value of levered firm will be more than value of unlevered firm. That's what M&M with taxes theory says. So M&M theory generally says value of levered and value of unlevered firm are same. But if you introduce taxes, then automatically value of levered firm will be more than value of unlevered firm because of the tax saving on interest which can be enjoyed by levered firm only. Is it clear? Yes. Now look at the valuation model here. Proposition 1. Value of unlevered firm is equal to, you know, for unlevered firm, equity value and firm value both are same, right? What is the formula for value of equity? EA ESH by KE, right? Hello. What is the formula for value of equity? EA ESH divided by KE. That is what the value of equity of unlevered firm. That itself is a value of unlevered firm. Am I right? Why? Because there is no debt here. And also I can use this formula also. EBIT into 1 minus tax rate by KO. This is the formula for value of unlevered firm. You see, value of levered firm. What is the formula for value of levered firm? Value of unlevered firm plus debt into tax rate. This indicates present value of perpetual tax saving on interest. Present value of perpetual tax saving on interest. Are you getting? Debt into tax rate. I don't explain why it is a present value of perpetual tax saving on interest. Why? Because that is purely conceptual. You just remember the formula for towards examination only. Let me talk about this value of levered firm. What is this value of levered firm? Value of unlevered firm plus debt into tax rate. Debt into tax rate indicates what? Present value of perpetual years tax saving on interest. See, I can enjoy tax saving on interest because of the uses of debt, and that can be arrived by adding some extra value called debt into tax rate. Are you getting? Now tell me, proposition 1 says value of unlevered firm is equal to. Do you think that value of unlevered firm and value of levered firm are equal in case if I introduce taxes and M&M theory? No. So what is the value? Value of unlevered firm is equal to EA ESH by KE or EBIT into 1 minus tax rate by KO. And then the value of levered firm is equal to value of unlevered firm plus debt into tax rate. Now look at proposition 2. You have to calculate two factors. First of all, KE of levered firm. You know that EA ESH divided by value of equity. And there is a shortcut formula also. KE of levered firm is equal to KO of unlevered firm plus KO of unlevered firm minus KD into debt by equity into 1 minus tax rate. See, for the previous formula, I'm just multiplying one extra factor called 1 minus T, right? The same formula you have to remember. Additionally, you should multiply 1 minus tax rate. Are you getting my point? And also, please calculate weighted average cost of capital of levered firm in proposition 2. Sir, why you have not calculated overall cost of capital of levered firm in case of previous theory M&M without taxes? Why? Because simple. In M&M without taxes, for both the firms, KO is same, right? Whereas in M&M with taxes, for both the firms, we don't get same KO. What do you say? Why? Because I don't get same values for both the firms. Hello. What is the formula for value of the firm? EBIT by KO, right? Are you applying same KO for levered and unlevered firm in with taxes theory? No. In that case, will you get same KO for both the theories and both the firms? No. So because of this reason, in M&M with taxes theory, for levered firm and for unlevered firm, values are different. Even KO is also different. Is it clear? Even KO is also different. Whereas in M&M without taxes theory, both the firm values are equal. Both the KOs are same. KO is equal to KE of unlevered firm, right? But here you should not apply that formula. So here firm values are different and even KOs are different. KO of unlevered firm is KE. KO of levered firm you have to calculate in proposition 2. Now tell me KO of levered firm formula. Weighted average cost of capital KO of levered firm is equal to EBIT into 1 minus tax rate by value of firm. Which firm? Which firm? Levered firm. I'm talking about levered firm, right? Is it clear? Now tell me, proposition 1, value of unlevered firm is equal to EA/ESH by KE or EB18 into 1 minus tax rate by KO. Value of levered firm, value of unlevered firm plus debt into tax rate. Then proposition 2, KE of levered firm, EA/ESH by value of equity or KO of unlevered firm plus KO of unlevered firm minus KD into debt by equity into 1 minus tax rate. And also I should calculate KO of levered firm formula EB18 into 1 minus tax rate by value of levered firm. Is it clear? Yes. With this, M&M with taxes theory is over. See, this is a theoretical concept, packing order theory, not applicable for problems. You can read it and understand it. That's not an issue. Is it clear? With this, all the theories were over. I can go for arbitrage process and go through all these formulas, go through the formula set. NI, NOI, traditional, M&M without taxes and with taxes. Okay. Yes. The next one is arbitrage process. You know, arbitrage process means shifting from overvalued firm to undervalued firm. You know, there are two firms here, levered and unlevered firm. So there are two situations here, shifting from levered firm to unlevered firm and shifting from unlevered firm to levered firm. Both the cases we have to handle. The first case is when levered firm is overvalued. In case of arbitrage process, always your objective is to shift from overvalued firm to undervalued firm. The first case is when levered firm is overvalued. That means which firm is undervalued? Unlevered firm, right? Hello. Yes, you have to shift your holding from levered firm to unlevered firm. Generally, the investors with small percentage of holding will execute this process. Okay. Generally, promoters don't go for the arbitrage process. Who will execute this process? Small stake shareholders. Is it clear? Yes. Levered firm to unlevered firm. You know, in levered firm, there will be two sources, equity and debt. You're the equity shareholder holding a small percentage of equity, right? Say, for example, if you are holding 10% of equity and you want to shift your holding from levered firm to unlevered firm. By selling equity in levered firm, you cannot invest directly such process in unlevered firm. Why? Because in levered firm, you're enjoying some tax, you're enjoying some extra returns from debt fund, right? You're enjoying leverage benefit in levered firm. Such benefit is not available in unlevered firm. So to enjoy the same benefit, I have to execute one process. That's what arbitrage process. What I have to do? First of all, sell your shares in the levered firm. You'll get net sale process by selling equity in levered firm. Add personal borrowing at the same rate which is borrowed by the company. Okay. So we have to borrow some money. The percentage followed for debt in levered firm. You know, say for example, if levered firm is following 2:1 debt equity ratio, that means 2 rupees debt for every 1 rupee equity. In the same ratio, you have to you have to borrow the money personally. Okay. And add that money to your net sale process, get the total fund. Is it clear? So what to do? Sell your equity in levered firm, get the net sale process, add personal borrowing to that net sale process. How much money you have to borrow? In the same ratio, the levered firm is borrowing the money for its equity. At the same ratio, you have to apply for getting the personal borrowing money. So simply borrow such personal money. Borrow that money and add such process to your net sale process to get the total fund. And such total fund should be invested in unlevered firm. But such money should not be invested fully. Say for example, if you are holding 10% of equity in levered firm, the same 10% of equity you have to buy in unlevered firm. Balance fund becomes a surplus. Is it clear? So what to do? Amount to be invested in unlevered firm. Actually, we are shifting from levered to unlevered firm. The same percentage of holding of equity as in levered firm. How much it is? 10%. So you should buy 10% of equity in unlevered firm. So from this total fund, please deduct 10% of equity in unlevered firm. The balance becomes a surplus fund. Then that fund you can retain it. Is it clear? Hello. By applying this process, you'll get same income in case of levered firm, in case of unlevered firm. As an equity shareholder, as an investor, you'll get same amount of income when you're in levered firm and when you're shifting to unlevered firm. In both the firms, you'll get same income, but with this reduced investment. You know, this surplus fund is nothing but reduction in investment. Reduction in investment. Are you getting? So what to do? Simply, when levered firm is overvalued, when you're shifting from levered firm to unlevered firm, Sell your equity in levered firm. Add personal borrowing in the same ratio of debt and equity which is followed by the levered firm. Get the total process. Don't invest total process in unlevered firm. You have to invest that much money which is required to be invested in unlevered firm. Such money should be equal to the same percentage of investment which you are holding when you are in levered firm. The same percentage of equity you have to buy in unlevered firm. Is it clear? So from your total fund, please deduct the percentage of equity that you are buying in unlevered firm. The balance becomes a surplus. The beauty is you'll get the same income in levered firm and unlevered firm by reducing your investment, and that money is surplus fund. Is it clear? Yes. This is the first case. And in the second case, you are shifting from unlevered firm to levered firm. In this case, unlevered firm is overvalued. Levered firm is undervalued. So the same process you have to apply, but in a different way. So what to do? Simple. Sell your equity in unlevered firm. Whenever you are shifting from levered firm to unlevered firm, you are selling equity. In the similar way, whenever you are shifting from unlevered firm to levered firm, you have to sell your equity in the unlevered firm. In which firm you have to sell your equity? In the overvalued firm. In the overvalued firm. Here, which firm is overvalued? Unlevered firm. Sell your equity in unlevered firm. Get the net sale process. You don't need to borrow any kind of money. Why? Because, see, when you are unlevered firm, when you are in unlevered firm, are you facing any kind of financial risk? No. When you're not facing any financial risk, you don't need to borrow money. If you borrow money, you're adding financial risk. You don't want financial risk. Instead of that, you should eliminate financial risk. In order to eliminate financial risk, I don't invest entire money in levered firm's equity. I'll invest both debt and equity in levered firm's equity and debt. Is it clear? So, after getting net sale process by selling equity in unlevered firm, by using such process, I have to do one thing. In levered firm, I have to invest in equity as well as in debt. In which percentage, sir? The same percentage of holding you're holding in unlevered firm, the same percentage of equity you have to buy in levered firm. So, for example, if you are holding 10% of equity when you are in unlevered firm, the same 10% of equity you have to buy in levered firm. Along with that, you should also buy 10% of debt. Are you getting? Since you are the holder of 10% of equity and also the holder of 10% of debt, so automatically the risk, the financial risk will be nullified. Why? Because when you are the holder of 10% of equity, you are responsible for 10% debt. Since you are buying same 10% debt, so you don't need to face any kind of financial risk because such 10% debt belongs to you only. Is it clear? So, the process is very simple. Sell your equity in unlevered firm. By using such process, invest in debt and equity of levered firm in the same percentage which you are holding when you are in unlevered firm. Is it clear? Yes. The balance becomes a surplus. See, after investing your money in equity and debt of levered firm, you'll get some surplus money. And the surplus money represents reduction in investment. You know, the beauty is, you'll get the same amount of income in levered and unlevered firm. Unlevered and levered firm. Unlevered and levered firm. You're shifting from unlevered to levered firm. In unlevered firm and in levered firm. In both the companies, you'll get same income. But you can reduce your investment. And such reduction in investment is the benefit of arbitrage. Are you getting? See, the process is somewhat different. In case of levered to unlevered, what I'm doing? I'm selling equity, borrowing personally. By getting total fund, I'm investing in the equity of unlevered firm. Are you getting? Whereas when I'm shifting from unlevered to levered, I'm selling equity in unlevered firm. I'm investing the entire money in levered firm's equity and debt in the same percentage which I'm holding in unlevered firm. After investing some money, I'll get some surplus. That will be the reduction of investment. Is it clear? Yes. This is what the arbitrage process is all about. Is it clear? Just go through this process, arbitrage process, then we'll go for the problems. Yes. Please look at the problems. Problem number 1. Ganpati Limited is considering 3 financing plans. The key information is as follows. We want to raise total investment to be raised is 2 lakhs. The total fund is 2 lakhs. There are 3 plans here. A, B, C. Plan A 100% equity, Plan B 50-50 equity and debt, and Plan C 50% equity and 50% preference shares. Cost of debt is 8%. Cost of preference shares is 8%. This is interest rate. This is preference dividend rate. Tax rate is 50%. Equity shares of the face value of each 10 rupees each will be issued at a premium of 10 rupees per share. That means issue price will be 20, right? Hello. The face value is 10 and issue price premium is 10. So issue price will be expected EBIT is 80,000. You are required to determine for each plan earnings per share, financial break-even point, indicate if any of the plans dominate and compute the EBIT range among the plans for indifference. You know, the third point is EBIT indifference point. EBIT indifference point should be calculated between A and B, B and C, and A and C. Is that clear? Yes. Now look at the computation of earnings per share. For how many plans? Three plans A, B, C. Already we have an expected EBIT here, right? How much it is? 80,000. Calculate EPS for that particular EBIT level. Less interest applicable for plan B because we have debt here, right? And how much money you want to raise? 2 lakhs. 50% debt means 1 lakh. 1 lakh into 8%. 8,000 is your interest, right? EBT less income tax 50%, EAT minus preference dividend applicable for plan C. There also you are raising 50%. So 1 lakh into 8% preference dividend 8,000. EA, ESH number of divided by number of equity shares. You know how much is our issue price? 20. So 2 lakhs by 20 for plan A and 1 lakh by 20 for plan B and C. Because I'm raising 1 lakh equity only for plan B and C. So we got number of equity shares 10,000, 5,000, 5,000. EA, ESH by number of equity shares gives me EPS, right? Got it. Now this is regarding EPS computation. And also I have to calculate financial break-even point for all the three plans. You know, my dear students, the financial break-even point means calculating EBIT level where your EA, ESH is equal to 0. How I can get this? EBIT is equal to the formula for financial break-even point. EBIT is equal to interest plus preference dividend divided by 1 minus tax rate, right? Yes. Plan A. We don't have debt and preference share capital. Then automatically financial break-even point will be equal to, what do you say? Yes, you don't need to write this description. You can calculate it. EBIT is equal to 0. Is it clear? Plan B. Under this plan, there is an interest payment of 8,000 and no preference dividend. Hence, the financial break-even point will be 8,000. That's it. Because the second part of the formula is 0. So, I'll get EBIT is equal to 8,000. What is that formula? Interest plus preference dividend divided by 1 minus tax rate, right? For plan B, we don't have a preference share capital. So, 8,000 is your interest. Financial break-even point is 8,000, right? Then plan C, interest is 0. Whereas preference dividend is 8,000. 8,000 by 1 minus 0.5, I'll get 16,000. How much is the financial break-even point for plan C? 16,000. So we got financial break-even points for all the three plans. Plan A 0, plan B 8,000, plan C 16,000. So at these EBIT levels for all the three plans, the earnings available to equity shareholders will be equal to 0. Should be equal to 0. Are you getting? Now also I have to calculate EBIT indifference point between A and B, B and C, A and C. The indifference between two alternative methods of financing is calculated by following the formula. You know that what is the formula? EBIT minus interest into 1 minus tax rate divided by E1. You know, I don't apply this formula. Why? Because we should also deduct what? Preference dividend. What is that formula then? Tell me the formula. EBIT minus interest into 1 minus tax rate minus 1 minus tax rate minus preference dividend divided by number of equity shares should be equal to the same expression, right? Yes. Apply that formula. Indifference point between plan A and B. Indifference point between plan A and B. EBIT minus interest is 0 for plan A into 1 minus 0.5 divided by 10,000 shares is equal to EBIT minus interest for plan B is 8,000 into 1 minus 0.5 no preference dividend divided by number of equity shares 5,000, right? If you solve this equation, I'll get EBIT. How much is your EBIT? 16,000. Cancel these terms. 5,000, 10,000, 2 times, right? 2 into 0.1 minus 0.5. 2, that will be 1. So I'll get EBIT minus 8,000 is equal to 0.5 EBIT. If you solve that, you'll get EBIT is equal to 16,000. You see, if you calculate EPS at the level of EBIT of 16,000 for plan A and plan B, your EPS should be equal, right or wrong? Yes, you can check it. And then again, I have to calculate indifference point between plan A and C. The same equation. I got how much EBIT? 32,000. And also between plan B and C, I have to calculate EBIT indifference point. But unfortunately, I got same numbers under LHS side and RHS side. These two terms will be cancelled, right? When you cancel EBIT, you cannot calculate EBIT. So what it indicates? It's a limitation, and it indicates there is no indifference point between plan B and C. And I should write indifference point between plan B and C doesn't exist. Is it clear? There is no indifference point between plan B and C. Yes. Now look at the EPS numbers. Which plan is having more EPS? Plan B, right? Hello. And also financial break-even point is least for plan B, right? Hello. How much is your financial break-even point for plan B? 8,000. Whereas for plan C, 16,000. That means you need 8,000. You need 8,000 EBIT to get 0 EASS to the equity shareholders. Are you getting? See, equity shareholders will get nil earnings if the EBIT is 8,000. That means they are achieving break-even point with 8,000 EBIT only. In case of plan C, they are achieving EBIT indifference point by earning how much EBIT? 16,000. Which plan is better? Plan B in terms of financial break-even point, right? Sir, I can go for plan A because 0 is the financial break-even point. Even if my EBIT is 0, I'll get EISS is equal to 0. So I'll go with the plan A. No. Why? Because in plan B, I'm getting more EPS, right? I'm getting more EPS. And also, I'm achieving a financial break-even point with lower EBIT level, right or wrong? So in that case, plan B is dominating plan A as well as is plan C. Plan B is dominating plan A in terms of EPS. Plan B is dominating plan C in terms of financial break-even point. So which plan is dominating out of all these three plans? Plan B. So I'll go with the plan B, right? It can be seen that financial plan B dominates plan C since the financial break-even point of the former is only 8,000, but in case the latter is 16,000. Further, EPS of plan B is the highest, right? Yes, that's it. With this, problem number 1 is completed. Good morning. Yes, the second problem, which is related to M&M. The following data relates to two companies belonging to the same risk class. Same risk class means same business risk, not same financial risk. Okay. A Limited expected EBIT, expected net operating income means expected EBIT 18 lakhs. For B Limited also 18 lakhs. 12% at 54 lakhs. Equity capitalization rate for B Limited is 18%. Have you observed one thing? We don't have a debt in B Limited, but we have a debt in A Limited. So A Limited is levered firm, B Limited is unlevered firm. Am I right or wrong? Yes. Now required. Determine the total market value, equity capitalization rate and weighted average cost of capital for each company, assuming no taxes as per M&M approach. You know, they are asking you to calculate all these parameters under M&M without taxes. M&M without taxes. My first task is to calculate market value of levered and unlevered firm, right? Hello. Assuming no taxes as per MM approach. Calculation of value of firm A Limited and B Limited according to MM hypothesis. Market value of B Limited unlevered. What is the formula for market value of unlevered firm? EBIT by KO, right? See, NOI by KE or EBIT by KE or KO. KE, KO both are same. How much is your EBIT? 18 lakhs. Look at the equity capitalization rate, 18%. How much is your value of unlevered firm? 100 lakhs, right? How much? 100 lakhs or 1 crore. And KE of unlevered firm is given, and that can be KO. What about KO of levered firm? This is KO of, look at this. We have to calculate total market value, equity capitalization rate and weighted average cost of capital. Equity capitalization rate means KE, overall cost of capital means KO. This is total value of the firm. So KO, KE, value of the firm. These three factors we have to calculate. This is value of the firm, right? Now this is KE. KE is nothing but, that was given in the problem itself, you know. You don't need to calculate it. Hello. KE of unlevered firm is 18%. What about KO of unlevered firm? KE. KE. Right? Is there any debt here? When there is no debt, KE is nothing but KO for that firm. So for unlevered firm, KO is equal to KE. Am I right or wrong? What are the terms we have to calculate? Value of the firm, KE, KO. Value of the firm we have calculated. KE is given. KO is KE, right? What about levered firm? Value of levered firm is equal to value of unlevered firm plus debt into tax rate. This is absolutely wrong actually. You don't need to apply debt into tax rate. This was given in the study material. Why? Because when we are following M&M without taxes, what is the formula? Value of unlevered firm is value of levered firm is equal to value of unlevered firm. That is equal to 100 lakhs. You don't need to apply this, right? How much is the value? 1 crore, 100 lakhs. We got it. Value of levered firm. So you need to calculate KE, KO. Hello. Look at this valuation here. Please go through this valuation. See, A Limited, B Limited, NOI for both the firms EBIT is how much? Less interest on debt. A Limited 6 lakh 48,000. EAESH, we got it. Divided by K. Yeah, here is your overall capitalization rate. For both the firms, KO is same, right? because we are following M&M without taxes. Value of the firm. For both the firms, EBIT by KO only. Less value of debt. I got market value of equity. For levered firm, market value of equity is how much? 46 lakhs. And for unlevered firm, market value of equity, market value of firm, both are same. Equity capitalization rate means formula. What is the formula for KE? EA ESH divided by value of equity. EA ESH is how much? Just now we have calculated 11 lakh 52,000. What about value of equity? 46 lakhs. Please calculate KE for levered firm. 11 lakh 52,000 divided by 46 lakhs. That is 25.04%, right? What about unlevered firm? EA ESH 18 lakhs divided by 100 lakhs or 1 crore, 18%. See, you can solve this problem in your own way. Is it clear? You don't need to follow this table and all. Is it clear? Yes. Now, weighted average cost of capital, KO. You know, for both the firms, KO is same. You don't need to apply this methodology and all. Why? Because for M&M without taxes theory, KO of both the firms are equal, right? Which is equal to KE of which firm? Unlevered firm. That's what I've written. I mean, that's what they've given. 18%, 18%. This is regarding. Actually, they have calculated weighted average cost of capital unnecessarily. This calculation is not at all required. Why? I know that when I am following M&M without taxes theory, KO of both the firms are equal, right? They've asked you to calculate weighted average cost of capital of levered firm. You don't need to calculate it. Even if you calculate it, you'll get the same answer. See, weighted average cost of capital, they've calculated like this by taking 46 lakhs and 54 lakhs. By taking these proportions, they've multiplied the respective sources cost with the proportions and they got 18% only, right? They just proved it. That's it. Nothing new. Is it clear? This is regarding point number A. Now look at point B. The same valuation, total market value, equity capitalization rate and overall cost, weighted average cost of capital for each company assuming 40% taxes. This time you have to apply M&M with taxes. You should be very careful because value of levered firm is more than value of unlevered firm. You look, you see, first of all, market value of V Limited unlevered. Market value of unlevered firm is equal to formula EB18 into 1 minus tax rate by KO, right? EB80 is 18 lakhs into 1 minus 0.4 divided by how much percentage? 18%. So how much is the market value of unlevered firm? KE of unlevered firm is given, right? Hello? KO of unlevered firm is equal to KE. No issue. This point is over. Now levered firm. Market value of levered firm is equal to value of unlevered firm plus debt into tax rate. Value of unlevered firm 60 lakhs, debt is 54 lakhs into tax rate 40%. I got 81 lakh 60,000. Computation of weighted average cost of capital of B Limited. What is the formula for weighted average cost of capital of B Limited? B Limited is a levered firm, right? Hello? KO of levered firm formula. EB80 into 1 minus tax rate by value of the firm, right? Hello? What is the formula for KO of levered firm? EB80 into 1 minus tax rate by value of levered firm. Look at the formula set and tell me. B Limited is unlevered or levered? Levered firm it is. Yeah, it is A Limited actually. Not B. A Limited is levered firm, right? Hello? Person they have given. Okay. It's not. You have to calculate it actually. First of all, I'm calculating KO of C. For A Limited, we have to calculate KE, KO and value of the firm. This is value of the firm. Are you accepting it? Okay. Look at this. First of all, let us see the solution so that we can go for the alternative computation also. Computation of equity capitalization rate and weighted average cost of capital of A Limited. Because already we have calculated value of A Limited, right? Value of levered firm. EB80 less interest, EBT less tax, EA ESH, right? Total value of firm. How I can, you know, already we have calculated value of the firm. How much is the value of levered firm? Deduct value of debt from it to get value of equity. 27 lakh 60,000. What to do? I have to calculate two factors, KE, KO. What is the formula for KE? EA/ESH by value of equity. Did you remember that? Yes. How much it is? 0.2504. That is 25.04%. What about weighted average cost of capital? Now, they have given you this particular computation for calculating weighted average cost of capital. Instead of that, we can also calculate weighted average cost of capital KO of levered firm is equal to EBIT into 1 minus tax rate by value of levered firm, right? How much is your value of EBIT? How much is your EBIT? 18 lakhs into tax rate, please. 18 lakhs into 1 minus 0.4 divided by value of levered firm. 81 lakh. 60,000. Tell me the answer. 13.23% approximately, right? And they got the same answer. You don't need to apply this table methodology for calculating weighted average cost of capital. You can use this formula simply. Is it clear? So tell me what is the formula for KO of levered firm? EBIT into 1 minus tax rate by value of levered firm. You can use this formula. So by this we have calculated KE, KO and value of the firm. For which firm? Levered firm. Company name A Limited. Is it clear? Yes. With this, we have completed the chapter capital structure. My dear students, in these capital structure theories, you should also remember a few important assumptions. Assumption number 1, business risk and EBIT is always constant unless there is an additional fund is raised. Business risk is always constant and EBIT is always constant. EBIT will never increase overnight. It will always be constant. That's the first point. Second point, any money which is raised to debt should be used to buy back equity. Any money which is raised through equity should be used to repay the debt, so that your total fund is constant. The composition of your fund may change. The debt and equity percentages may change, but your total fund remains constant. Total assets remains constant. Your EBIT remains constant. Are you getting my point? So the technical words are generally, any money by selling equity should be used to redeem the debentures, redeem the debt or repay the debt. Any money which is raised by selling debt should be used to buy back equity or retire the common stock. Is it clear? So this is what the point. That means the money which is raised to new source cannot be used in the business. That should be used to repay your other source called equity or debt, so that your total fund is always constant, but the proportions are changing. Clear? This is what the second point. And the third point is, no personal and corporate taxes exist. No personal and corporate taxes exist. We don't use corporate taxes or personal taxes except for the theory M&M taxes. Is it clear? Yes. These are the points you have to remember while handling these theories. But also, we'll never use preference share capital in these theories. Always we have only two sources. What are those two sources? Debt and asset. With this, the chapter structure is over. Good afternoon, all of you. Yes, the next chapter is investment decisions. You know, investment decisions are concerned with what? Optimum utilization of funds, right? To maximize the wealth of the shareholders. Investment decisions is all about selection of the projects by considering the benefits and costs associated with each project, right? Yes, these investment decisions are very crucial for every company because substantial expenditure is involved here. Huge money is blocked here, right? We'll invest a lot of money and those decisions are irreversible, and these decisions will have a long impact on long-term future, because the future profitability, the long-term future profitability and cash flows are dependent on these decisions. And these decisions are complex decisions because we have to estimate the future cash flows and we have to calculate the cost of capital and we have to evaluate the projects in different perspectives. So these decisions are complex decisions because these decisions are related to future. Yes, you know, there are two parts in this chapter. One is estimation of cash flows and then handling the capital budgeting techniques. What do you say? Yes. Now, my dear students, before selecting any project, first of all, we should define the costs and benefits associated with each project. Here, project means a business. So, related to every business, we should estimate the cash flows. Nothing but benefits and costs. In our discussion, benefits means cash inflows, cost means cash outflows. Is it clear? Yes. We have cash outflows and cash inflows here. See, if I'm taking a 10 years project, what are the possible cash flows? In year 0, I'm going to invest in fixed assets. This is not financial assets, this is fixed assets. I have to invest in fixed assets and then I should invest in working capital. What do you say? See, for running any business, one should invest in fixed assets and also we should invest in working capital. So these two are important components for running any project. So after investment in fixed assets and working capital, we'll get future operating cash inflows. Future operating cash inflows, say if we are taking 10 years life, for all the 10 years, I'm going to get operating cash inflows. And after 10 years, I'll get some terminal cash inflow. Nothing but the fixed assets investment will carry some salvage value, and also whatever the money which is invested in working capital will be realized in full. So finally, this total is your terminal cash inflow, right? Yes. So first of all, whenever you're calculating cash flows, you should consider some important factors. These are the important factors: depreciation, opportunity cost, sunk cost, working capital investment, allocation of overheads, allocation and apportionment of overheads. Okay, allocation or apportionment of any overheads, and additional capital investments. These factors should be considered very carefully. I will focus on every part separately. Opportunity cost means it's a benefit foregone by the company by taking an alternative course of action, right? Yes. This opportunity cost should be considered. Even sunk cost impact we have to consider, and also the working capital investment requirement. Everything we have to consider. I'll come to this point later. First of all, we'll understand how we can define the cash flows. Is it clear? See, your categories of cash flows are initial cash outflows, terminal cash flows, nothing but terminal year cash flows, and then finally interim cash flows. Interim cash flows are nothing but operating cash inflows. What do you say? Yes, operating cash inflows. We have several steps to calculate cash flows here. Estimation of cash flows. First of all, calculation of initial cash outflows. This is your initial cash outflows. Okay. What are the possible initial cash outflows? Investment in fixed assets, investment in working capital. These are the two important components of your cash outflows. In year 0, we should invest in fixed assets and we should invest in working capital. This total is simply known as what? Cash outflow. In step 2, we have to calculate depreciation, my dear students. In step 2, we have to calculate what? Depreciation. This is step 2, calculation of depreciation. Depreciation can be calculated based on SLM or WDV. And in step 3, we have to estimate the operating cash flows. Step 3 is calculation of operating cash inflows. What is step 3? Calculation of operating cash inflows. What are the operating cash inflows here? Look at this. See, how to calculate depreciation either based on SLM or based on WDV, right? How I can estimate the cash flows? Please deduct all of your cash expenses from sales to get PBDT. Sales minus variable cost, contribution minus cash fixed cost. Please deduct depreciation separately. Is it clear? Yes. Sales minus variable cost, contribution minus cash fixed cost. I'll get PBDT. Deduct depreciation from it. Then we'll get PBT less income tax, PAT. Add depreciation. We'll get CFAT. This is what your cash inflow, right? Hello? Yes. See, while deducting expenses, we are deducting depreciation separately. Why? Because depreciation never involves any cash outflow, which is having a separate impact on your cash flows. Generally, you should not deduct depreciation because that is not a cash outflow. Then why we are deducting depreciation? Because I want to get tax saving. When I want to get tax saving, then you should deduct your depreciation before tax and you should add back such depreciation after tax. That's why we have deducted depreciation immediately after PBDT and also we have added back such depreciation immediately after PAT. Are you getting? One more point why we are deducting depreciation is, see, only by deducting depreciation I'll come to know the profit, right? See, only after deducting depreciation I'll get the profit and on that profit only I should apply tax rate. I should not apply income tax rate on PBDT. I should apply tax rate only on PBT. PBT is a taxable profit. I'll get the taxable profit only after deducting revenue expenditure and a part of capital expenditure, which is nothing but depreciation, right? So after getting PBT, we'll have to deduct income tax. Then finally, we'll add back such depreciation because that never involves any cash outflow. Depreciation is a non-cash expenditure. Am I right? Then I'll get CFAD, operating cash inflow, also known as CFAD. And then finally, we'll move on to terminal cash inflow. You know, my dear students, a terminal cash inflow generally includes two parts. One is salvage value, other one is realization of working capital. But while calculating the salvage value, you should consider capital gain tax adjustments. So your gross sale process of your fixed assets should be compared with what? Book value to get capital gain or capital loss. So look at the format here. Gross sale process minus book value. I got capital gain. On that capital gain, I should apply capital gain tax based on your income tax percentage, say 30 or 20%. Then this capital gain tax should be deducted from gross sale process to get what? Net sale process. A minus B means gross sale process minus capital gain tax. This is my final inflow. And to that I should add realization of working capital. Finally, I'll get what? Terminal cash inflow. This is a way to calculate cash flows. Now you please tell me how to calculate cash flows. Step 1, calculation of initial cash outflows. Investment in fixed assets, investment in working capital. Step 2, calculation of depreciation, either on SLM or on WDV basis. Step 3, calculation of operating cash inflows. Sales minus variable cost, contribution minus cash fixed cost, PBDT, minus depreciation, PBT less tax, PAT, add depreciation, CFAT, which is also known as operating cash inflows, right? And calculation of terminal cash inflow, gross sale process minus book value, capital gain. On that I should apply capital gain tax. Such capital gain tax should be deducted from gross sale process to get what? Net sale process. To that you should add what? Realization of working capital to get terminal cash inflow. Is that clear? Yes. This is a way to define cash flows subject to some adjustments. You know how the expenses are going to be deducted. In different ways I'm going to deduct expenses, but also different category of expenses I'm going to deduct. See, all of such items we have to discuss. Is it clear? We have a chart just before this cash flows. Just before this cash flow statement, if you remember, right? See, this is what the chart. How we can treat depreciation and what about the opportunity cost, and then what about the sunk cost and working capital impact and allocation and apportionment of overheads impact and additional capital investment impact. That's what we need to understand, right? Yes. You know, look at the parts U. See, the first part is depreciation. Just now we understood the concept of depreciation, right? It should be deducted just to get tax saving, and also to know the taxable profit we should deduct depreciation just before tax, and that should be added back after PAT, after tax. Nothing but you should add back depreciation to PAT. You know, opportunity cost. See, opportunity cost will have a influence on what? Your decision making. Opportunity cost means the cost of next best alternative. See, since you're sacrificing some future income because of taking one alternative course of action, such sacrificing income should be considered as an opportunity cost. The loss of future income because of a new decision is simply known as what? Opportunity cost. Is it clear? Yes. This opportunity cost should be deducted from sales as an expenditure while calculating CFAT. While calculating what? CFAT. Yes. You know, wait, we have a statement related to that opportunity cost. Problems only we can find that statement. A big chapter. Yes. Okay. My dear students, coming to opportunity cost. This opportunity cost can be given in two forms. It can be given in before tax terms, or it can be given in after tax terms like net of taxes. There is a problem called hospital based problem related to diagnostic machine. In that problem, they have given you opportunity cost, loss of commission, net of taxes, after tax. See, your opportunity cost can be given in the form of before tax terms or in the form of after tax terms. The impact will change based on the nature of your opportunity cost. You see, before tax opportunity cost, should be deducted from sales. It should be deducted from sales. It's a before tax adjustment. Whereas after tax opportunity cost should be deducted from CFAD to get net CFAD. It's an after tax adjustment. If the opportunity cost is given in before tax terms, deducted from sales, it's a before tax deduction. If the opportunity cost is given in after tax terms, then please don't deduct it before tax. Please deduct it after tax. So straight away, please deduct this after tax opportunity cost from what? CFAD to get net CFAD. For better understanding, you can refer a problem called hospital based problem. Hospital is outsourcing some diagnostic works, right? So in that problem, you can get this point actually. Is it clear? So opportunity cost should be deducted for calculating CFAD. If it is before tax, it should be deducted from sales. If it is after tax, it should be deducted from CFAD. Got it right? Working capital. Initial working capital requirement should be treated as cash outflow. And the end of the project, and at the end of the project, it should be released and it should be treated as cash inflow. Right or wrong? So working capital is an initial investment, initial cash outflow, and it's a terminal inflow. It's a terminal inflow at the end of the project period. So it is having an impact on year zero outflow, and it is also having an impact on terminal year cash inflow. So remember one thing, working capital is a 0 period cash outflow, and it's a terminal year cash inflow. Realization of working capital. Is it clear? You have to remember this statement. So, and at the end of the project, it will be released. Its release should be treated as what? Cash inflow. Allocated or apportioned overheads. Allocations and apportionment of overheads are existing overheads, not additional overheads. So, in case if you can find the statement related to allocations or apportionment of overheads, please don't deduct such expenses from sales to get CFAD. Because in investment decisions, will deduct only additional expenses which involves cash outflows. Allocations and apportionment of overheads are not incurred because of your new investment decision. Those expenses, those overheads are existing overhead expenses. Whether you go for the new project or not, it doesn't matter. Still you have to incur such overhead expenses. Such overhead expenditure can be a production overhead or a corporate overhead or an administration overhead. Anywhere, if you find a statement like this, like allocation or apportionment of overheads, allocation or apportionment of corporate overheads, general administration overheads, or production overheads, should be ignored. It should be ignored for calculating what? CFAD. Should be ignored for calculating CFAD. Are you accepting it? Yes. Additional capital investment. You see, whenever you are investing some additional investment in the new project, in the same project, please consider such additional capital investment as an additional cash outflow. Say, for example, I've invested 100 lakhs money in year 0, and also I'm going to invest 12 lakh 50,000 money at the end of third year. Is it a capital investment or not? Is it not an outflow? Yes, it is an outflow. Please consider that additional capital investment as an outflow, and convert such additional investment into present value terms while calculating step number 1. Is it clear? So your initial cash outflow should include additional capital investment only after doing discounting. Is it clear? Yes. So additional capital investment is also an investment. That is also a cash outflow. So you should consider such item. Is it clear? Yes. Once go through this parts, cash flows defining, and then these treatments and all. Let's go through this. Yes, basic principles for measuring project cash flows. Now, block of assets and depreciation, section 32. You can follow block of assets concept also based on the problem. Tax shield or benefit from depreciation is considered while calculating cash flows from the project. Yes, we should consider tax saving on depreciation, obviously. By deducting depreciation, obviously we are going to get what? Tax saving. Am I right or wrong? The treatment of depreciation is based on the concept of block of assets, which means a group of assets falling within a particular class of assets in respect of which depreciation is charged at same rate. The treatment of tax depends on fact whether the block of assets consists of one asset or several assets. You should follow strictly the provisions of Income Tax Act, nothing but section 32, while calculating depreciation under block of assets concept. Okay. Exclusion of financing cost principle. My dear students, you should not deduct interest and preference dividend and equity dividend payments while calculating CFAT. We should not deduct any finance costs. That means interest on debt should not be deducted, preference dividend should not be deducted, and equity dividend should not be deducted while calculating what? CFAT. You see, the interest on long-term debt is ignored while computing what? Profits and taxes, nothing but CFAT. The expected dividends are deemed irrelevant in cash flows analysis. Nothing but they're directly saying you what? Please ignore payment of interest, payment of preference dividend, and payment of equity dividend while arriving what? CFAT. There is a reason behind it. Why? Because those CFATs are going to be discounted at cost of capital, right? Such cost of capital includes interest, preference dividend, and equity dividend. So through discounting, you can recover your costs on your long-term sources. You don't need to deduct again separately interest, preference dividend, and equity dividend from your sales to get CFAT. Why? Because we are calculating CFAT which are available to long-term investors only, right? So because of this reason, the finance cost is generally excluded. The finance cost means the cost on finance. You know what are the financing options for you? Equity, preference, and debt. So related to all those three financing options, please don't deduct any finance cost like equity dividend, preference dividend, and interest while arriving what? CFAT. Is it clear? That's what exclusion of financing cost principle, okay? Because that is going to be covered through discounting the future cash flow side. Cost of capital, I'll explain it when we are discussing about NPV concept. Is it clear? Post-tax principle concept. Whenever we are evaluating any project, you please consider after-tax cash flows. After-tax cash flows and after-tax profits. Never ever consider before-tax cash flows. Is it clear? Why? Because without considering tax, if I consider the cash flows can be more. If the cash flows are more, the project can be considered positive. The project seems to be positive. The project seems to be a positive NPV project. But you don't accept that project merely by taking what? Before tax cash flows. Because you are supposed to pay cash flows mandatory. That's a statutory obligation. Am I right or wrong? So because of this reason, they're telling you, please consider post-tax principle. Nothing but what? Deduct income tax whenever you are evaluating any project. That means you have to consider after-tax cash flows only. Is it clear? And those points are covered in this paragraph. You can read it. It's a common point actually. Okay. Now, let me go to the capital budgeting techniques. The important part of this chapter. This is what important. Your capital budgeting methods or techniques are classified into two parts. One is traditional methods or non-discounting methods. The other one is time adjusted techniques or modern methods or discounting methods. The first category will never consider time value of money, whereas the second category will consider time value of money. Am I right or wrong? So what are the non-discounting methods? Non-discounting methods means we are not going to discount cash flows or profits at any rate. Okay, we don't use discounting here. What are the concepts here? Average rate of return or annual rate of return or accounting rate of return. Simple, it's an ARR. Okay, the technique is what? And the second category is payback period. These two techniques we have to understand. Okay. Coming to discounting techniques. NPV, profitability index, IRR, discounted payback period, modified IRR. Even we have to understand one more method called modified NPV actually. You have to understand one more method called what? Modified NPV. Yes. Let me go with the capital budgeting techniques one by one. See, look at the traditional methods. The first technique out of traditional methods, the first technique is average rate of return or accounting rate of return or annual rate of return. Shortcut ARR, right? We have three methods to calculate ARR. Total investment method or initial investment method. Method number 1. Average investment method, method number 2. Annual investment method, method number 3. There is no specific formula for annual investment method. You can rarely find this particular method for calculating ARR. Mostly we have to apply the first and second methods only. Especially the second method, very important method. Is it clear? Should remember the second method very importantly. Can I read the first method? The total investment method. You know, ARR means the rate of return on your investment. See, whenever you want to calculate rate of return, income by investment. Incomes and gains divided by investment is a formula of a rate of return. The similar way, even for calculating ARR. ARR is the rate of return, the average rate of return per annum that can be earned by the company on their investments in the projects. Is it clear? See, that can be calculated by taking total investment which you are investing in year 0 or initial investment near 0. The formula is very simple. Which income or profit that we are going to get? Is it sales? No. Contribution? No. PBDT? No. Only after deducting revenue expenditure and capital expenditure I'll get profit, right? And in that case I'll get PBT. Because while arriving PBT, I'll deduct variable cost, I'll deduct fixed cost. Thereby my revenue expenditure is going to be deducted, recovered. And after that I'm going to deduct depreciation. Depreciation is recovery of capital expenditure. Only after recovering my investment and revenue expenditure, I'll get what? Profit. So PBT. Can I consider PBT? No, because you're supposed to pay income tax. So you have to consider PAT, but not CFAT or but not sales or contribution or PBDT. Are you getting my point? The only term which is having the eligibility of profit is PAT. Is what? PAT. And I should consider that profit for calculating rate of return. That's why ARR is equal to formula, the profit after tax. See, are you going to get equal profits every year? I'm not sure. So in that case, please take the average of future year's profits. That's why I have to take average profit after tax divided by my initial investment into 100. Okay, this is what? The ARR formula by taking initial investment or total investment. And also average profit after tax formula, total profit after tax by number of years. And we have second formula also, average investment method. There is no change in the numerator. I'll take average PAT only. But there is a change in the denominator. Instead of taking total investment which we are investing in year 0, I can take the average investment. There is a formula for average investment, which is a reflection of opening and closing investment divided by 2 actually. You know, but we should follow this formula strictly. Half of initial investment minus salvage value plus salvage value plus additional working capital. Half of initial investment minus salvage value. It should be considered within the brackets, okay? Plus salvage value. This is out of bracket. Plus additional working capital. This is the formula for average investment. Are you getting? Yes. You know, annual investment method that can be understood only by solving one problem. You can see in your study material, annual investment for every year they'll calculate separate rate of return. Then finally they'll take the average of all the years returns as average rate of return. Is it clear? Yes. Now tell me, what is the formula for ARR under the initial investment method? Average PAT divided by initial investment into 100. Okay. Then what about the formula for ARR under average investment method? Average PAT divided by average investment into 100. What is the formula for average investment? Half of initial investment minus salvage value plus additional working capital. Got it? You know, ARR is the rate of return that is generated from the project. Such ARR must be compared with cost of capital. Such ARR must be compared with cost of capital. You know one thing, ARR represents return, cost of capital represents cost. Cost of capital is a liability side expectation. ARR is the asset side return. Such return must be compared with cost of capital before taking any decision, because ultimately you should satisfy the investors, right? If ARR is greater than cost of capital, you can accept the project. Less than cost of capital, you should reject the project. Equal to cost of capital, may or may not accept the project. Is it clear? Because always return should be more than cost, right? On that principle only, we are taking this decision. Now go for the payback period technique. You know, payback period means it is a recovery period. Recovery of what, sir? My investment in year 0. In how many years I can recover my investment from the future? From the future. Future means future profits of cash flow, sir. Profits should not be considered for recovery of your investment. Only the cash flow should be considered. Why? Because profits are small numbers, whereas cash flows are big numbers. Cash flows includes what? Profit plus investment. Your investment can be recovered from cash inflows only, but not from profits. Is it clear? So in payback period, instead of taking profits, PAT, we have to consider CFAT. So in payback period, the appropriate term is CFAT, but not PAT. Is it clear? Yes. The payback period means it is a time period within which we can recover our investment. It is a time period by which I can recover my initial investment from the future cash inflows. What do you say? Yes. The payback period should be calculated by considering two situations. Your cash inflows can be equal or the cash inflows can be unequal. If the cash inflows are equal, then I can use the shortcut formula, initial investment by annual cash inflows. What is the formula for payback period? Initial investment by annual cash flows. If the cash flows are uniform cash flows. Sir, what is this uniform cash flows? Equal cash flows. In case if the cash flows are non-uniform cash flows, unequal cash flows, then I should calculate this payback period proportionately by accumulating the cash flows. Do you know that, right? I have to accumulate the cash flows. Year, cash flows, cumulative cash flows. Am I right? So I should see the recovery of investment. So I should see the investment. If my investment recovery is in between 4th and 5th year, what I should do? I should write the investment covered by the end of 4th year, and I should write the balance of investment to be covered for 5th year. So if it is in between 4th and 5th year, proportionately I have to calculate payback period. Am I right? There is no specific formula for calculating unequal cash flows. You should accumulate the cash flows and identify the recovery period. Proportionately, how to calculate it. Okay. So, non-uniform cash flows, proportionate calculation is required. Uniform cash flows, initial investment by annual cash flows. Always the objective of this technique is early recovery. I'll always select the project which is having least payback period. Why? Because I'm targeting what? Early recovery. Is it clear? And also I'll fix the standard payback period. I'm going to fix the standard payback period. That means, say for example, if I'm evaluating one project which is having a life of 15 years and the standard payback period which is being fixed by the management is 5 years. SPBP standard payback period is 5 years, whereas the payback period for that project is 4 years. See, we are expecting 5 years recovery. Within 5 years, I should be able to recover my investment. Whereas that particular project is recovering your investment within 4 years also. Within 4 years itself. Are you getting? Only within 4 years, you are recovering your investment from this new project. Can you accept this project? Yes. Why? Because your actual payback period, your PBP, is less than SPBP, right? In case if it is greater than SPBP, don't go with the project. Okay? Don't select the project. So that's what decision making project. So that's what decision making related to projects. PBP less than SPBP. What will you do? Accept the project because you're recovering your investment at the earliest when compared to the standards which are fixed by the management, right? PBP greater than SPBP, reject the project. Equal to SPBP, you may or may not accept the project. There exists another concept called payback period reciprocal. Payback period reciprocal is nothing but reciprocal of payback period. 1 by payback period. Are you getting? It is almost equal. It is approximately equal to your rate of return, IRR. Why? Because payback period means what? Reciprocal of payback period means what? Reciprocal of payback period, payback period. Payback period reciprocal means 1 by payback period actually. What is the formula for payback period reciprocal? What is payback period? Initial investment by annual cash flows. So what is the formula? Annual cash flows divided by initial investment. Here annual cash flows means average annual cash flows. Are you getting? So what is the formula for payback period reciprocal? Average annual cash flows divided by, and this is almost equal, this is approximately equal to your IRR. You don't get exact IRR. There is a lot of difference. It is an approximate IRR. It is an approximate IRR. Nowhere will use this formula, but it is just one of the concepts. It is helpful for quick estimation of rate of return of projects provided it is at least twice the payback period. That means your project life at least should be double of your payback period. In case if my payback period is 2 years, your your project life should be equal to 4 years. Then only you will get approximate IRR. Is it clear? Okay, this is just a formula. Now, payback period reciprocal is equal to formula plus Average annual cash flows divided by initial investment. With this, non-discounting techniques are over, right? I can go for discounting techniques. Please go through the formulas once. Yes, I'm moving to the next techniques, discounting methods. Right. The first important technique in discounting methods is NPV. In NPV, simple, estimate the future cash flows, operating and terminal cash flows, and discount such estimated cash flows at cost of capital rate. Then we'll get present value of cash inflows. From that, please deduct your investment. Look at the formula of NPV, present value of net cash inflows minus total net initial investment, or present value of cash inflows minus present value of cash outflows. This is a mathematical formula. First year ending cash inflow divided by 1 plus k whole to the power of 1. Second year ending cash inflow divided by 1 plus ke, 1 plus ko, it is ko, cost of capital, right? Whole to the power of 2. Like that. How many years cash flows should be discounted? N years cash flows. And from that you have to deduct your investment. Cash inflows of various years, discount rate, life of the project. N means life of the project, cost, K means discount rate. In fact, KO it is. KO means what? Cost of capital, which is used as appropriate discount rate. Life of the project, I is investment, right? Calculation of steps for calculating NPV. We'll follow 4 steps for calculating NPV, right? What are the 4 steps? Calculation of present value of cash outflows. Investment in the same steps will follow in this NPV, which we have followed in cash flows definition, right? We have defined the cash flows in the previous part. So the same steps we have to follow, but instead of general cash flows, we have to discount the future cash flows, right? Yes, calculation of present value of cash flows, investment in fixed assets and investment in working capital. Okay, we got present value of cash outflows. Calculation of depreciation either on SLM basis or on WDV basis. Calculation of present value of operating cash inflows. Get your CFAT. You know how to calculate CFAT. Sales, from sales to CFAT, you know how to calculate it, right? If the cash flows are equal, use the annuity factor. If the cash flows are unequal, please discount every year cash flow separately. Okay. Then I'll get present value of operating cash inflows. And also please calculate present value of terminal cash inflows. Do you know how to calculate net sale process? Yes. Please add realization of working capital to that to get terminal cash inflow, and such terminal cash inflow should be discounted at cost of capital by using a present value factor. Then I'll get present value of terminal cash inflows, right? So what is the specific formula of NPV? Present value of operating cash inflows plus present value of terminal cash inflows minus present value of cash outflows. You know, if you are following straight line method of depreciation, the gross sale process and net sale process are generally same. Capital gain from one asset can be adjusted against capital loss of other asset. This point is required when we have a capital loss. You know, if the transaction results in capital gain at the end of the project life, terminal year, then we have to pay capital gain tax. If it results in capital loss, we'll get tax shield, right? Hello? We'll get what? Tax shield. Capital gain tax should be deducted from gross sale process to get net sale process. Tax shield should be added to gross sale process to get what? Net sale process. What do you say? So this point is relevant for what? Tax shield. Tax shield on capital loss at the end of the terminal year, which is part and parcel of what? Terminal cash inflow, right? Yes. You see, my dear students, in NPV, the appropriate discount rate is cost of capital. Remember this point. The future cash flows should be discounted at cost of capital. Sir, why should I discount the future cash flows at cost of capital? Because cost of capital is long-term investors' expected rate of return. By discounting the future cash flows at cost of capital, I can recover the expected return of all the long-term investors. So discounting will deduct cost of capital from future cash flows. The present value of cash flows will be reduced to the extent of expected return of long-term investors, equity preference and debt holders. After arriving present value of cash inflows, your next job is to recover their investment, because already their expected profit is covered by discounting the future cash flows at cost of capital. Right or wrong? You know, cost of capital is the expected profit of equity preference and debt holders. Yes, that is the expected profit of equity preference and debt holders, the expected rate of return. You know, so by discounting the future cash flows, the expected profit is going to be deducted, and then I'll get present value of cash inflows, and from that I have to recover their investment, which is present value of cash outflows. After recovering their investment, any surplus which we are getting is technically known as NPV. Is that clear? So if such NPV, if such surplus NPV is a positive, that means that project is able to recover your investment along with cost of capital. Also, it is generating some extra return. Is it clear? Then in that case, I can accept the project. So if NPV is positive, greater than 0, greater than 0, it's not equal to 0, it's greater than 0. What you will do? What will you do? Accept the project. If it is less than 0, reject the proposal. If it is equal to 0, may or may not accept the project. What do you say? May or may not accept the project. Let me consolidate the NPV technique. The formula for NPV is present value of operating cash inflows plus present value of terminal cash inflow minus present value of cash outflows. And the appropriate discount rate is cost of capital. The relevant discount rate is cost of capital. That cost of capital can be given in different names. Required rate of return, cost of capital, opportunity cost of capital, targeted rate of return, hurdle rate of return. There will be different names in your examination problems. Okay. And every rate is a cost of capital. Is it clear? And then finally, if your NPV is greater than 0, accept the project. Less than 0, reject the project. Equal to 0, may or may not accept the project. Got it? Yes. Now the next capital budgeting technique is profitability index. You know, my dear students, profitability index is just similar to NPV. NPV is an absolute measure, whereas profitability index is a relative measure. That's what the difference. It is the ratio of present value of cash inflows to the present value of cash outflows, my dear students. What is the formula for profitability index? Present value of cash inflows divided by present value of cash outflow. What is the formula for NPV? Present value of cash inflows minus present value of cash outflows, right? You know, if you put 2 dots, then I'll get profitability index, right? It's a way to remember this formula. Okay. Which formula? Profitability index. Nothing new. Is it clear? Now look at the formula. This profitability index is also known as present value index, desirability factor, desirability index or factor, desirability index or factor, benefit cost ratio. These are all the new names for what? Profitability index. Present value index, desirability factor, benefit cost ratio. All these are what? Profitability index. What is the formula? Present value of cash inflows divided by present value of cash outflows. Sir, what is the appropriate discount rate here? What is the appropriate discount rate to NPV? Cost of capital. The same rate is applicable here also. NPV and profitability index both are brothers. One is a big brother, NPV, which will express the value in absolute terms. Other one is a small brother, profitability index, which will be expressed in relative terms. Are you getting? Yes. Both are same actually. Present value of cash inflows divided by present value of cash outflows. In both the techniques, the relevant discount rate is cost of capital. You know, opportunity cost. Yeah, the point is covered here. The opportunity cost can be given in before tax terms or after tax terms. If it is expressed in before tax terms, it should be deducted from sales for calculating CFAD. If it is expressed in after tax terms, it should be deducted from CFAD to calculate net CFAD. The point is covered here, okay? And what is the rule of profitability index? It should always be greater than 1. It should always be greater than 1, not equal to. Equal to symbol is not applicable here. If profitability index is greater than 1, what will you do? Accept the project. Less than 1, reject the project. Why? Because the numerator is benefit, the denominator is cost. The benefit should be more than cost. Then only I'll get more than 1, right? Are you getting my point? In case if you get profitability index less than 1, that means what? The present value of cash inflows are less than present value of cash outflows. Then that indicates what? Negative NPV. Profitability index greater than 1 indicates positive NPV. Profitability index less than 1 indicates what? Negative NPV. Profitability index is equal to 1 means what? May or may not accept the project. My dear students, you should remember one point here. You should remember one point here. Profitability index is not at all equal to 0. What do you say? Will you evaluate, are you going to evaluate a project which is having estimated 0 cash flows? Hello? Are you going to evaluate a project which is having 0 cash flows in the future? No. Then in that case, present value of cash flows divided by present value of cash outflows, if the numerator is 0, will you calculate the formula? Are you going to apply this methodology? No. So you don't get profitability index is equal to 0 in any way. Is it clear? Everywhere, either your profitability index can be greater than 1 or less than 1, or it can be equal to 1. And you cannot find negative terms also. Is it clear? Please go for the formulas and please go through the formulas NPV and profitability index once. Then I'll go for the next technique, IRR. The next capital busting technique is IRR. You know, my dear students, internal rate of return is a simple one. It indicates the profit which is included in your future cash flows. Okay, that's it. Say for example, if I invested 1 lakh rupees today in a project which is having a life of 1 year. How many years life? After 1 year, I'm going to get 1,15,000 cash inflow. That's it. The project is over. I don't get any salvage value. How much is your investment today? 1 lakh. After 1 year, how much money you are going to get? 1,15,000. Tell me, have you recovered your investment or not? How much? 1 lakh. What is the additional benefit you're getting? How much is the additional benefit you're getting? 15,000. Is it your profit or not? Hello? May I know the rate of your profit? 15%. Hello? So in your first year ending cash inflow 1,15,000, in your first year ending 1,15,000 cash inflow, you're getting your investment 1 lakh. Along with that, you're also getting your profit. And such 15,000 profit is technically known as IRR, internal rate of return. How much rate of return that is actually? 15%. If you discount 1,15,000 at 15% rate, then automatically the entire 15,000 is going to be deducted or recovered. You'll get present value of cash inflows of 1 lakh exactly. From that, if you deduct your investment 1 lakh or present value of cash outflows 1 lakh, you'll get NPV 0. Is it clear? So what is IRR? The rate of profit which is included in your future cash flow. Can I say like this? Hello? So what is IRR? The rate of return, the internal rate of return. What is this internal rate of return? The rate of return which is internally included in the future cash inflows. Internally included in the future cash inflows. You know, the future cash inflows are loaded with 2 components, prima facie. The first component is your investment part. And then the second component is your profit, which is technically known as what? IRR, internal rate of return. So if you remove such IRR from the future cash inflows, the profit element is going to be completely eliminated. Then I'll get present value of cash inflows, which is purely representing my 0 period investment. Are you getting? There your NPV should be equal to 0. Am I right or wrong? So what is IRR? Internal rate of return for an investment proposal is the discount rate that equates the present value of the expected cash flows with initial cash outflow. Nothing but present value of cash outflow. I can say present value of, I can say at that rate NPV is equal to 0. How I can get this? Present value of cash inflows minus present value of cash outflows should be equal to 0, right or wrong? So at IRR discount rate, if I discount the future cash flows at IRR rate, then automatically the present value of cash flows should be equal to my present value of cash outflows, or it should be equal to my investment. So there my NPV should be equal to 0. Am I right or wrong? So IRR is the discount rate at which NPV is equal to 0. IRR is the discount rate at which NPV is equal to 0. Yes. If I remove IRR, what I'll get? Principal only, my investment only. If I deduct the investment from present value of cash inflows, obviously the NPV should be equal to 0. So your ultimate target is calculation of IRR. How I can calculate IRR? It is based on the cash flows method. It is based on the nature of cash flows. If the cash flows are equal cash inflows, then I can use annuity method. If the cash flows are unequal cash flows, then I must use trial and error method, guess rates. Okay. What are those rates? Guess rates. Yes. Equal cash flows, annuity method. Unequal cash flows, trial and error method. Other names of IRR. What are the other names of IRR? Yield on investment, marginal efficiency on capital, rate of return over cost, time adjusted rate of internal return, productivity of capital, marginal rate of return. These are the other names of IRR. Mostly you can find IRR only. Generally, if you go for guess rates, if the IRR lies in between two rates, then automatically we will use interpolation method for calculating IRR. What is the formula for IRR by using interpolation when it lies in between two discount rates? L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. What do you say? Where L1 is lowest guess rate, L2 is highest guess rate. Is it clear? You know, my dear students, under annuity method, what I'm going to do, I'll calculate the IRR is the what is the equation under annuity method? IRR is the discount rate at which IRR is the discount rate. Yeah, it is the discount rate at which present value of cash inflows are equal to my investment or present value of cash outflows. You know, present value of cash inflows means cash inflows into equal cash inflows only. For equal cash inflows only, I can apply this method. I should multiply this equal cash flows with present value of annuity factor R, N, right? From this, I have to calculate what present value of annuity factor R, N. I'll get this factor. Once I get this factor, then what I'll do? You should trace this factor corresponding to the life of the project. Say if it is 10 years, you should refer this factor in the present value of annuity factor table. If it lies in between two discount rates, we must use a proportionate method, right? We should use proportionate method for calculating IRR. If it is corresponding to the exact rate, that itself is your IRR. This is what the annuity method. Is it clear? Yes. Whereas in case of trial and error method, I'll use the guess rates. I'll go with the first guess rate 10%. Then I'll go with the second guess rate 20%. In the first guess rate, if my NPV is positive, then I'll go with the second guess rate 20%. There also, if I get the same again positive NPV, then I'll go with the next guess rate 30%. If I get negative NPV at 30%, then I should use interpolation between 20 and 30 to get IRR. And that formula for such interpolation method is simply L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. You know, every capital budgeting technique must be useful for taking decisions. Here IRR. IRR should be compared with cost of capital. Just like ARR, here also IRR should be compared with cost of capital. IRR is the rate of return which is generated from the project, whereas cost of capital is the expected return of long-term investors. So IRR must be compared with cost of capital. If IRR greater than cost of capital, we should accept the project. If IRR less than cost of capital, we should reject the project. If IRR is equal to cost of capital, what will you do? May or may not accept the project. What do you say? May or may not accept the proposal or project. This is regarding IRR technique. Coming to discounted payback period method. You see, discounted payback period is just similar to payback period with some modification. What is that modification? In payback period, I'll accumulate the normal cash flows for every year. The columns will be year, CFAT, cumulative CFAT. In cumulative CFAT column, I'll refer my investment. I should check whether my investment is recovered. I should check my investment recovery period by seeing the cumulative cash flows column, right? Whereas in discounted payback period, you should not accumulate normal cash flows. You should accumulate present value of cash flows discounted at cost of capital. So first of all, in discounted payback period, discount your future cash flows at cost of capital. Then get the present value of cash flows for each year separately. While calculating discounted payback period, please never ever apply annuity factor, because I need present value of cash inflows discounted at cost of capital separately for each year, right or wrong? So after getting present value of cash inflows for every year separately, I'll accumulate the cash flows. So the columns will be year, present value of cash inflows, cumulative present value of cash flows, discounted at cost of capital. And then the same process which was applied to payback period concept, the same process is applicable here also. I should refer at what period between which years my investment was recovered. I have to check it, right? In case if it is recovering between third and fourth year, so I should calculate the proportionate discounted payback period. Is it clear? Just like investment covered by the end of third year, balance of investment to be covered, and then I have to check the present value of cash flows for the next year. Now proportionately, I have to calculate discounted payback period. You know that, right? Yes. You know what is the difference between payback period and discounted payback period? The only difference is you have to discount the future cash flows and accumulate such cash flows only. So it is the time period by which my initial investment should be recovered from present value of future cash flows, not the normal cash flows. Is it clear? Coming to modified IRR. See, it's just a modification of your IRR. There is a limitation with IRR, and to remove such limitation, we have to understand this concept called modified IRR. So what is this modified IRR? How I can calculate modified IRR? Simple. Convert every year ending cash inflow into terminal year by using cost of capital as a discount, reinvestment rate. See, convert all the interim cash flows into terminal year by using what? Cost of capital as a reinvestment rate to get the terminal value. If we are evaluating 5 years cash flows, 1, 2, 3, 4, 5. Every year I am getting some cash flow, say 100,000. Nothing but 1 lakh. Convert all the year's cash flows into terminal year. Which year? 5th year. Then you'll get terminal value. Sir, which date I have to use for calculating terminal value? Cost of capital. This is compounding, okay. This is compounding because you're converting the values into future. The terminal value should be loaded with 2 components. One is investment, other one is rate of return. Rate of return, which is known as modified IRR. It is known as what? Modified IRR. I don't know that rate of return, okay. Now modified IRR is the discount rate at which present value of this terminal value should be equal to my investment. So modified IRR is the discount rate. It is the discount rate which equates present value of terminal value with what? Investment. Is it clear? Hello? So I have to calculate that. Modified IRR is the discount rate at which present value of terminal value is equal to present value of cash outflows, also known as what? Investment. Also known as what? Investment. From this, I should get a factor. Okay. That factor is generally present value factor. And you should refer this present value factor table, present value factor and present value factor table to know your modified IRR. If your present value factor lies in between 2 discount rates, then automatically proportionately you have to calculate your modified IRR, and that was covered in your problems part. Okay. Hello. This is regarding modified IRR. What is how to calculate modified IRR? Please tell me. Convert all the year's cash flows into terminal year by using cost of capital as a reinvestment rate and the discount rate which equates present value of terminal value with my initial investment. Present value of cash outflows is nothing but modified IRR. Got it? So what is the relevant discount rate for reinvestment here? Cost of capital. What is the relevant discount rate for discounting the terminal value? Modified IRR. That's what you have to calculate, right? Yes. Same way, modified NPV, which is this is very simple. In modified NPV, just like in modified IRR, convert all the year's cash inflows into terminal year by doing compounding. Sir, which rate I have to use? It is not cost of capital. It is the reinvestment rate which is given in the problem itself. So identify the reinvestment rate in the problem. By using such reinvestment rate, convert all the year's cash inflows into terminal year by doing compounding. Get the terminal value. Then discount such terminal value at cost of capital rate and deduct your investment to get modified NPV. Look at the modified NPV. Present value of terminal value minus present value of cash outflows. First future cash flows are compounded at the expected rate of return, reinvestment rate, then we'll get what? Terminal value. Then after that you have to apply this formula. Modified NPV is equal to present value of terminal value minus present value of cash outflows. What to do, please? Please tell me. Modified NPV is also known as terminal value method. Convert all the year's inflows into terminal year by using which rate? Reinvestment rate. Get the value, terminal value. Modified NPV is equal to present value of terminal value minus present value of cash outflows. While arriving present value of terminal value, what is the appropriate discount rate? Cost of capital. At what rate I should discount the terminal value? Please tell me, my dear students. At what rate I should discount the terminal value? Cost of capital. Which method I am using? Modified NPV. What rate should be used for conversion? Reinvestment rate. Again repeating. In modified NPV, every year cash flow should be converted into terminal year by using which rate? Reinvestment rate. What is the relevant discount rate for converting terminal value into present value? Cost of capital. Now tell me, what is the relevant discount rate for converting every year inflow into terminal year? Reinvestment rate. What is the discount rate for converting terminal value into present value? Cost of capital. If I deduct investment, what I'll get? Modified NPV. Remember this, okay? So what is the assumption of normal NPV? This is not assumption of modified NPV. This is assumption of NPV, regular NPV. What is the assumption of NPV? Interim cash flows are assumed to be reinvested at cost of capital. If you cannot reinvest your cash flows again at cost of capital, then I'll use modified NPV. Simple. If the reinvestment rate is different from cost of capital, then you have to calculate modified NPV. That's what the reason. Okay. See, there are some limitations of IRR. It may result into multiple IRR. Cash flows are classified into two types: conventional cash flows and non-conventional cash flows. Conventional cash flows involves only single cash outflow in year 0. Whereas in case of non-conventional cash flows, you can find the cash flows like this. Say for example, if I am evaluating 1, 2, 3, 4, 5, 6 years project, 0 period investment, first year ending inflow, second year ending inflow, third year ending outflow, fourth year ending inflow, fifth year ending outflow, sixth year ending inflow. How many outflows we are finding here? 3. 3 outflows in the same project, right? These outflows are multiple cash outflows, right? If you can find multiple cash outflows in the problem, then that indicates non-conventional cash flows, involves multiple cash outflows. Multiple cash outflows results in multiple IRR. So what is the formula for multiple IRR, which is not there in your syllabus? Okay. It's a concept only. This is one of the limitation of IRR. IRR may result in multiple IRR. The other problem with IRR is interim cash flows are assumed to be reinvested at IRR rate. Practically that is not possible. That's why we are going to modify IRR and we'll calculate modified IRR. Is it clear? Yes. This is regarding IRR limitations. You know, my dear students, generally, sometimes when we are selecting two missions with different lives and we need to consider only expenses, we have to calculate present value of net cash outflows for every mission separately. I'm just selecting the mission. I'm in the process of selecting one mission out of two missions, two mutually exclusive missions. I know the information regarding the cash flows associated with the mission. We don't have any information regarding cash inflows. The related to such mission, if you have the cash outflow in year 0, that is nothing but cost of the mission, and repair expenses are maintenance expense in the future, and having salvage value at the end of the terminal year, and that's what the information which is given in the problem. You cannot calculate NPV in that case, right? So here the selection is not based on what benefits, it's based on what cost. So there are two missions, 5 years mission, 10 years mission, 5 years mission and 10 years mission with the relevant cash flows were given here, given in the problem. Say the 5 years mission is having 5 years cash flows, that 0 year cost of the mission, 5 years maintenance cost and repairs and maintenance cost, and 5th year ending salvage value. Whereas the 10 years mission, 0 year cost, and then what, for 10 years maintenance and repairs cost, and 10th year ending salvage value. Please convert the respective missions cash flows into present value. You'll get present value of net cash outflows. You cannot select the machine by merely by taking the present value of net cash outflows. See, in case of present value of net cash outflows, the selection should be based on cost. I'll choose the machine which is having least present value of net cash outflows, right? But when we have unequal cash flows, when we have unequal lives for the machines, you should not select merely by seeing the present value of net cash outflows. Then what I should do? I should annualize the cost, which is known as what? Equivalent annualized cost or equated. This is equated. This is equated annual cost. What is the formula for equated annual cost? Present value of net cash outflows divided by present value of annuity factor or comma n. Please calculate EAC. See, this is EAC, okay. This is EAC. For both the machines, select the machine which is having least equated annual cost. Is it clear? Yes. Sometimes you can face ranking conflicts between the projects because of several reasons. That means NPV may prefer one project, project A, IRR may prefer other project, project B. Have you observed it? Yes. In that case, this ranking conflict should be resolved. This ranking conflict arises because of three reasons. One is life disparity. Difference in life between the projects. The life of proposals are different. Second one is investment disparity, size disparity. Your investment amounts may be different for both the projects. The cash flows disparity, the pattern of cash flows. One may follow increasing trend of cash flows. The other project may follow decreasing trend of cash flows. Then, which project should be selected? See, in most of the cases, I'll go with NPV. NPV. See, in case of cash flows disparity, generally we'll prefer the project which is being preferred by NPV. In case of life disparity, I'll use two methods. Annualized NPV. I'll use two methods called annualized NPV or equated annual cost. These two methods are used for resolving the situation of life disparity. Is it clear? In case of size disparity, we don't have problems related to this concept actually in the study material, but still we have to use a method called incremental IRR. Incremental IRR method must be used for size disparity generally. Okay. Yes. The important case is capital rationing. Capital rationing. Yes, we'll understand this. Yes, the next concept is capital rationing. Capital rationing is short supply of capital situation. Rationing means short supply of capital. So, in case of capital rationing situation, how we can select the projects? First of all, capital rationing is classified into two types: single period capital rationing and multi-period capital rationing. Single period capital rationing means if short supply of capital situation is applicable only for 1 year, then that is a situation of single period capital rationing. If short supply of capital is applicable for more than 1 year, then that is a situation of multi-period capital rationing. My dear students, this point is not related to multi-period capital rationing. This is related to single period capital rationing only. Multi-period capital rationing, which is not there in your syllabus, okay? Which is not there in your syllabus. So we have only single period capital rationing. That means short supply of capital problem applicability for 1 year only. So in this, projects are classified into two types: divisible, indivisible. The divisible means, see, if the project cost is 100 crores, if we can invest a part of the project, say for example, if the available fund is 60 crores, if we can invest a part of the project, then such projects are divisible projects. That means part investment is possible. In case either you should invest 100 crores or you should reject it. There are only two options. Part investment is not possible. If part investment is not possible, then such projects are indivisible projects. In case of indivisible projects, you should calculate NPV of each project and we should determine the possible combination of projects and select the combination with maximum NPV. You should try to define as many combinations as possible within the capital spending limit and select the combination that gives you higher NPV. Okay. Whereas in case of divisible projects, calculate profitability index for every project. Assign ranking. In the order of ranking, invest your money till your money gets exhausted fully. See, you cannot find surplus fund in case of divisible projects because even part investment can be invested. Whereas in case of indivisible projects, some of the combinations may result in surplus funds. Got it? Yes. Replacement and modernization decisions. Sometimes we can go for replacement of existing machine, or we can go for modernization of the machinery. In that case, we'll go for replacement. Nothing but what? You'll replace the existing machine with a new automatic machine. Simply, you'll sell your existing machine and you'll buy a new machine and you'll install such new machine in the place of old machine. What is the objective of replacement and modernization decision? Simple. Either for getting additional cash flows by producing additional output with the new machine, or for cost reduction purpose. See, why would you go for replacement and modernization? Simple. Either to get extra output, to get extra cash inflows, or to reduce your existing expenditure, nothing but cost reduction. In both the cases, I'll go for replacement. Before replacing, we have to take a decision whether to replace or not on the basis of incremental cost benefit analysis by calculating incremental NPV. For replacement decision, we should do incremental cost benefit analysis, and nothing but we have to calculate incremental NPV. There is a process for calculating incremental NPV. Look at the process. Calculation of present value of incremental cash outflows. We are going to calculate NPV only, but by taking incremental cash flows. What are the incremental cash outflows? Present value of incremental cash outflows. Cost of the new machinery, including installation costs, minus NSP of the old machinery. Why? Because if you are installing new machine, then you'll sell your existing machine, right? NSP means after adjusting capital gain taxes. Okay. Then I'll get some net investment, and to that you should add investment in additional working capital. Whatever the outflows you're considering, such outflow must be an additional cash outflow. So I'll get present value of incremental cash outflows. Then after that, I'll calculate incremental depreciation. So what is this incremental? Incremental means additional. Additional investments, additional depreciation, additional operating cash inflows, additional terminal cash inflows should be considered by moving from old machine to new machine. Incremental depreciation means depreciation with the new machine minus depreciation with the old machine. I'll get incremental depreciation. Then I have to calculate present value of incremental operating cash inflows. Simple. CFAT with the new machinery minus CFAT with the old machinery for the remaining life of the old machinery. Simple. For example, if the old machine life is 10 years and I'm going to buy a new machine with a life of 10 years, then I should compare new machine cash flows with old machine cash flows. CFAT with the new machine minus CFAT with the old machine for the next year should be estimated, and such inflows are incremental operating cash inflows, and those incremental operating cash flows should be discounted at cost of capital to get present value of incremental operating cash inflows. Yes. In the similar way, I should also calculate present value of incremental terminal cash inflow. Simple. NSP of the new machine minus NSP of the old machine. Then I'll get additional NSP, and to that you should add realization of additional working capital. Finally, we'll get incremental terminal cash inflows, and such incremental terminal cash flow should be discounted at cost of capital to get present value of incremental terminal cash inflow. Am I right or wrong? So ultimately what we are trying to do here, we are trying to define present value of incremental operating cash inflows, present value of incremental terminal cash inflows. Always we are trying to calculate additional for replacement analysis. Is it clear? So finally, please calculate incremental NPV. Present value of incremental operating cash inflows plus present value of incremental terminal cash inflows minus present value of incremental cash outflows gives you incremental NPV. If this incremental NPV, also known as additional NPV, is positive, that means replacement results in extra surplus NPV, extra value that will maximize the wealth. Is it clear? Decision. If the incremental NPV is positive, then the company should go for replacement. If the incremental NPV is negative, then the company should not go for replacement. It is advisable to continue with the existing machinery. Got it? With this, the background of your capital budgeting is completed. Then I can go for what? Problems. Yes, related to investment decisions, capital budgeting, we have a problem. X Limited is considering purchasing of new plant worth 80 lakhs. The expected net cash flows after tax and before depreciation are as follows. After tax cash flows, net cash flows after tax but before depreciation. Which means what? Hello? See, after tax, net cash flows after tax but before depreciation is nothing but cash inflows only. Because after tax cash flows are always CFAT. Am I right or wrong? Yes. We have net cash inflows here 1 to 10 years. Equal or unequal cash flows? Unequal. Cost of capital is 10%. You're required to calculate payback period, NPV at 10% discount rate, profitability index at 10% discount rate, internal rate of return with help of 10%, 15% discounting factor. Have you observed one thing? They have given you the discount rate, right? For calculating IRR. And for 10% and 15%, we have present value factors here. Now look at the calculation. Payback period. How much is your cash outlay? 80 lakhs. How much is your cash inflow for the first 5 years? 70 lakhs. Balance of investment to be covered for 6th year? 10 lakhs. Cash inflow for 6th year? 16 lakhs. So I can calculate payback period which lies in between 5th year and 6th year. So 5 years plus proportionate computation. Simple. I need 10 lakhs but I am getting 16 lakhs. 10 lakhs into 1 divided by 16 lakhs. 5.625 years. So this is different. Actually we have to do accumulation. So why they have done like this? You can follow your own procedure. Is it clear? Hello. What is the process? Here, CFAT, cumulative CFAT. In that way, please try to refer your investment recovery period. If it is in between 5th and 6th year, and you have to write your description and calculate the payback period. Is it clear? Calculation of NPV. Discount the cash flows at 10% because that is your cost of capital. And deduct your investment. Look at the cash flows, present value of cash flows. All the cash flows discounted at what rate? 10%. I got some number and this is known as present value of cash inflows. And from that present value of cash inflows, I have to deduct what? Investment. So present value of cash inflows minus investment. How much is my cash inflow? 97,92,200. See, this is a reverse formula actually. What do you say? This is wrong. What is the formula? Present value of cash inflows minus present value of cash outflows. This is minus and this is plus. You'll get positive NPV 17,92,200. And then after that, profitability index is equal to present value of cash inflows divided by present value of cash outflows. We got 1.224 positive. Which is more than 1, right or wrong? NPV is positive, profitability index is more than 1. And IRR means I should use the guess rates. Already we have discounted the cash flows at 10% discount rate. And we got positive NPV, right? So I should use the next discount rate, 15%. And by using such 15% discount rate, how much NPV I got? Negative 1,16,000. So IRR lies in between 10 and 15. Use the interpolation method for calculating your IRR. L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. And they have used a formula like this: NPV L lower guess rate, NPV H higher guess rate. And this is also you can use. Okay. So IRR is equal to 10% plus. After substituting the numbers, I got 14.7% as your IRR. Is it clear? This is regarding problem number 1. Now look at problem number 2. This is a famous problem, very important problem for the examination. What is this? Following data has been available for a capital project. Annual cash inflows 1 lakh, useful life 4 years, salvage value 0. Internal rate of return 12%, profitability index 1.064. You are required to calculate the following for this project: cost of the project, cost of capital, NPV, payback period. Accept one thing, my dear students. First of all, you know the annual cash flows for the next 4 years, right? Such cash inflows should be loaded with 2 components. One is your investment, another one is IRR. You know the IRR rate, right? Hello. If you discount the future cash flows at IRR, the profit will be eliminated. You'll get investment, which is known as what? You'll get present value of cash inflows. That should be equal to investment. Your investment is nothing but cost of the project. Am I right or wrong? Yes. Look at the solution. Cost of the project. At 12% internal rate of return, sum of the total cash inflows. Present value of the sum of the total cash inflows should be equal to cost of the project. Annual cash inflows are 1 lakh for next 4 years. Discount these cash flows at 12% IRR. So, present value of cash inflows should be equal to present value of cash outflows. You know how much we got? 3,03,800. This is nothing but present value of cash outflows, right? Present value of cash outflows is nothing but cost of the project. At IRR, present value of cash inflows should be equal to cost of the project or investment or present value of cash outflows. You know the cash inflows and you know the IRR rate. By using IRR, I have considered present value of annuity factor, multiply the cash inflows with the annuity factor. I got present value of cash inflows, that is equal to present value of cash outflows, and this present value of cash outflows represents my cost of the project. Am I right or wrong? Yes. Now, what is the next task? I have to calculate cost of capital. By using cost of capital only, we have calculated profitability index. Profitability index should be calculated by using cost of capital, right? By using cost of capital, what I am going to calculate? Present value of cash inflows. Profitability index is equal to sum of the discounted cash inflows divided by cost of the project. Nothing but present value of cash inflows divided by present value of cash outflows. Which number you know? You know the number present value of cash outflows, right? How much it is? 3,03,800. Multiply this number with profitability index to get sum of the discounted cash inflows, also known as present value of cash inflows. You know, present value of cash inflows 3,23,243 as a number which is arrived from profitability index only, right? So whatever the present value of cash inflows which were arrived by using profitability index indicates what? The cash flows discounted at cost of capital. Am I right or wrong? So if you know the cash flows discounted at cost of capital, then immediately do one thing. You know, the annual cash flow is 1 lakh, right? Hello. See, these cash flows should be discounted at cost of capital to get this number. So I can use the formula. Cash inflows 1 lakh into present value of annuity factor, or I don't know the cost of capital rate, but I know the number of years. How many years? 4 years. Should be equal to my investment. How much is my investment? 3,23,000. Sorry. This one I know. This is present value of cash inflow. Do you know the number present value of cash inflow? Yes. Hello. 3,23,243 is the number which is discounted at what rate? I'm asking you people. Cost of capital. How do you know that? Because that number is arrived by taking profitability index. Am I right? So this 3,23,243 is nothing but present value of cash inflow. I don't know the discounted cost of capital, but I know the present value of cash inflows discounted at cost of capital. So from that, I should arrive this present value of annuity factor. So to look at this factor, how much is the factor? 3.239. This please calculate that. 3,23,243 divided by 1 lakh. 3. Trace this factor in the annuity factor table. Don't refer your table. Refer the table which is given in the problem itself. Add all the factors corresponding to 4th year. Add all the factors. Add the no, don't add these factors. Okay, try to add these factors, please. First of all, obviously your cost of capital may not be equal to IRR, right? 12% is IRR, so don't touch this IRR 12%. Try to touch this 11% rate first of all. 0.901 plus 0.812 plus 0.731 plus 0.659. 3.239. That's what the number we need, right? No. Yes, actually, right? Hello. The total of all the 4 years factor, please. At 11%. At what rate you have calculated actually? 9%, right? Hello. Then don't try this 11 and 10 because we got the number at 9%. How much is the total? 3.239. So that indicates your annuity factor is corresponding to which rate? 9%, which is known as what? Cost of capital. So in this way, we have calculated cost of capital. Hence, cost of capital is equal to 9%. What is the formula for NPV? Present value of cash inflows minus present value of cash outflows. Already you know the number present value of cash inflows discounted at cost of capital, which is arrived by using profitability index. From that, please deduct your investment to get your NPV. Am I right or wrong? So in this way, we have calculated NPV. What is the formula for payback period? Initial investment by annual cash flows if the cash flows are equal. Your initial investment is 3,03,000 divided by annual cash flows 1 lakh. So your payback period is 3.038 years, right? Okay. Yes, the next sum is Savli Limited has a machine which has been in operation for 3 years. The machine has a remaining estimated useful life of 5 years with no salvage value in the end. Its current market value is 2 lakhs. The company is considering a proposal to purchase a new model of machine to replace the existing machine. The relevant information is as follows. You know, already we have an existing machine with the current we have an existing machine which has been in operation for how many years? 3 years. How many years remaining life is available with the old machine? 5 years. Existing machine which was purchased at 3,30,000 3 years back has a life of 8 years. Already 3 years is over. Remaining years? It is not 8, it is 5 years. Am I right? And for new machine, the cost of new machine is 10 lakhs. The life is 5 years. Salvage value is nil after 5 years with respect to old machine. 40,000 with the new machine. Annual output 30,000, 75,000. Selling price per unit 15. Annual operating hours 3,000. Material cost per unit, labor cost per unit, indirect cash cost per annum. You know, this material, labor and indirect cash costs, all of your total expenses, okay, should be deducted from sales should be deducted from sales while calculating PBDT. Am I right or wrong? The company uses WDV method of return on value of depreciation at rate 20% and has several other machines in the block of assets. We have other machines also in the same block of assets. The income tax rate is 30% and Zavli Limited does not make any investment if it yields less than 12%. This is cost of capital. Advise Zavli Limited whether the existing machine should be replaced or not. You know, the present value factor at the rate 12%. The cost of capital rate is, the present value factors were given here for 1 to 5 years. You know, it's a case of replacement decision, right? Calculation of net initial cash outflows. Cost of the new machine, how much? Minus salvage value of old machine, 2 lakhs. Total net cash outflow, 8 lakhs. Now this is regarding net cash outflows. Base for depreciation. See, we are following what? Block of assets concept. Cost of the new machine, how much it is? Cost of the existing machine is 3,30,000. Depreciation for year 1, how much? Apply it. Apply the WDV depreciation. How much is the rate? 60. 20%. Deduct depreciation from for the past 3 years and get the book value today. How much is the return on value of existing machine today? 1,68,960, right? Now go for the depreciation base for new machine. Cost of the new machine, how much? 10 lakhs. Add WDV of existing machine, how much? 1,68,960. From that, please deduct sale value of existing machine. At what rate you are selling? 2 lakhs. And this becomes a depreciation base for new machine. This is what block of assets concept says. So what to do, please tell me? For your cost of the new machine, please add what? WDV of the existing machine. Then you'll get the total base. From that, deduct the sale process related to existing machine. Then you'll get the final base, depreciation base for new machine. On this only, we have to apply what? First of all, this is the depreciation base of new machine. And this depreciation base of new machine minus depreciation base of old machine. How much is our old machine depreciation base? 1,68,960. Deduct it. Then you'll get base for incremental depreciation. Got it? Base for incremental depreciation. Why? Because I don't need depreciation for new machine only. Why? Because I need incremental depreciation, right? How I can get incremental depreciation? If I go with the new machine, I'll sell my existing machine, then the base will be 9,68,960, right? On that I can claim depreciation. If I don't go with the new machine, what I'll do? I'll continue with the old machine. On 1,68,960, I can claim my depreciation, right? So you should take the difference between depreciation on depreciation base of new machine minus depreciation on depreciation base of old machine. The difference becomes your incremental depreciation because we are following block of assets concept. Is it clear? Yes. So look at the number. 8 lakhs. 8 lakhs is the base for incremental depreciation. On this only you have to apply how much rate? 20%. Now look at the number. Calculation of annual before tax and depreciation, PBDT. Existing machine, new machine, differential. I don't need differential actually. Actual output, 30,000, 75,000. That should be multiplied with your selling price to get sales value. From that, please deduct your expenses. Material at the rate 4 rupees per unit. Multiply with the volume 30,000 and 75,000 to get the material cost. And also labor cost. With the old machine, it is 40 rupees per hour. With the new machine, it is 70 rupees per hour. Number of hours remains same. So you'll get labor cost and indirect cash cost was directly given in the problem itself to get the total cost. Direct this total cost from sales to get PBDT. And from that PBDT, please deduct. From that PBDT, please take the difference. Incremental PBDT. I don't need these numbers actually, because I need only one number. What was that? Incremental PBDT. This is known as incremental PBDT. Do you know that? So what is incremental PBDT? PBDT with the new machine minus PBDT with the old machine. 5,50,000 minus 1,60,000. How much it is? 3,90,000. From that incremental PBDT, please deduct depreciation by following 20% depreciation on your base. Which base? Incremental base. How much is an incremental base? 8 lakhs. What is this incremental base? Depreciation base with the new machine minus depreciation base with the old machine by following block of assets concept. Am I right or wrong? Now, deduct this depreciation to get PBT. Deduct tax. Then PAD, add depreciation, CFAD, you see 4 minus 5 plus 3. Then discount these cash flows. Then I'll get present value of incremental cash inflows. Please add present value of incremental terminal cash inflows. Are you getting any salvage value with respect to old machine? 0. Whereas the new machine salvage value is 40,000, right? So the only terminal cash flow is your salvage value of new machine, because the salvage value of new machine after 5 years is 0. 0, 0. New machine salvage value after 5 years is 40,000. Old machine salvage value after 5 years is 0. So 40,000 minus 0. I'll get incremental terminal cash inflow of 40,000. Discount it. I got this number. So get the total. Deduct your investment of 1,000, nothing but 8 lakhs to get what? Incremental NPV. Is it positive or negative? Please calculate it. 11 lakh 6,284 plus 22,680 minus 8 lakhs. 3,28,964, right? Is that positive or negative? So since incremental NPV is positive, existing machine should be replaced. Am I right? So with this, capital budgeting, investment decisions is over, right? The next chapter, dividend decisions. You know, the decisions related to raising of financing is financing decision. The decisions related to investment of your funds is your investment decision. Whereas the decisions related to payment of dividend is dividend decisions. What do you say? You know, dividends can be given in two forms: cash dividend, stock dividend. Cash dividend means dividend which is given in the form of cash. Whereas if you issue bonus shares, then that is known as stock dividend. See, both of these numbers are given to equity shareholders only, right? Significance of dividend policy. Dividend policy of a firm is governed by long-term financing decisions. For equity, retained earnings are preferable because they do not involve any flotation cost. Yes, because always whenever we want to raise equity, which source will prefer? Retained earnings. Wealth maximization decision. Higher dividends increases the value of shares. Generally, if you pay more dividend, investors are very much interested to buy your company shares. Then automatically there will be huge demand will be created for your share. So your share value will be increased. Use of retained earnings increases future earnings per share. See, both are important actually. You should also retain the profits and also you should distribute the profits. Balance is required. Thus, for wealth maximization, a dividend policy which divides net earnings into dividends and retained earnings should be adopted. A balance is required. Paying dividend and retaining the profits, right? Determinants of dividend decisions. Important aspects. How much funds are available? Yes. While deciding the dividend payout, you should check whether sufficient cash is available. Cost of capital should be checked, because if I distribute the dividends, I cannot raise fresh capital at a higher cost. And then capital structure should be checked. Your capital structure should not be disturbed by paying your dividend. Stock price should be checked, because stock price should not be influenced. Stock price should be increased because of your decision. Investment opportunities in land or in new projects also. In case if new projects are available at high rate, then you should check how much dividend should be distributed. Internal rate of return. How much return you'll be able to generate by retaining the profit should be checked. Trend of the industry. See, in the same industry, other companies are paying how much dividend. You have to compare, and expectation of shareholders should be known, right? See, without knowing the expectation of equity shareholders, we cannot distribute the dividends. And also legal constraints. If there is a legal compliance or legal constraints, then we should follow such legal constraints accordingly. And the impact of taxation on your dividends should be considered. By considering all these factors, I have to decide the dividend policy. Okay. Yes, the major part. This is the important part. While taking dividend decision, we should check whether this dividend decision can affect the value of the equity share or not, or value of the firm or not. Yes, some theories said dividend decisions are relevant for value of the firm. Some theories said the dividend decisions are irrelevant for the value of the firm. So those theories said the dividend decisions are relevant for value of the firm, and those theories are known as theories of relevance. In case if the dividend decisions are irrelevant for value of the firm, then those theories are known as theories of irrelevance. You know, relevance theories are two: Walters model, Gordon model. Whereas irrelevant theories, there is only one irrelevant theory. What was that? Modigliani and Miller approach. Look at the Walters approach. What are the assumptions? These are the important assumptions in Walters model. All investment proposals are financed through retained earnings only. You cannot go for external financing like debt. You should finance a new project only out of retained earnings. And then R and KE are constant. Rate of return and then cost of equity KE are always constant. And Perfect capital markets exist. Nobody can influence the market. Nobody can influence the market, and no taxes or no tax discrimination. So either no taxes are applicable or no tax discrimination, and then no flotation costs, no flotation or transaction costs. Transaction costs are not applicable here, and then the life should be considered as perpetually years. So whenever you're buying any equity share, always investors should hold this equity share for how many years? Indefinite period. And these are the assumptions while calculating the value per share. Walter says if the company is having profit, it can go for two decisions. You see, if the company is earning profits which belongs to equity shareholders, either it can retain the profits or it can distribute the profits. When I can retain the profits, if R is greater than KE. If R is greater than KE, if the firm is able to generate a return which is more than cost of equity, then you better retain 100% profits. If R is less than KE, when the company is not able to generate a better return when compared to the expectation of equity shareholders, then you better do one thing. Distribute 100% profits. R greater than profit, retain profits. R less than KE, distribute the profits. Then only you can maximize the value per share. Sir, how much profit should be retained? 100%. How much profit should be distributed? 100%. Are you getting? Yes. There is a formula for MP0. There is a formula for MP0 under Walter's model. D by KE plus R into E minus D by KE whole divided by KE. This is a formula for MP0 under Walter's model. What is the formula? Please tell me. Please repeat it. MP0 is equal to D by KE plus R into E minus D by KE whole divided by KE. Where D is dividend per share, R is rate of return, KE is cost of equity, E is earnings per share, MP0 is current market price per share. Along with that, please remember this formula also. Cost of equity KE is equal to 1 by PE ratio. This can be useful. It can be used sometimes. Okay. Yes. Optimum payout ratio. You know, this Walter says if R greater than KE, 100% retention and 0% payout can maximize the value per share. Okay. If R is less than KE, don't distribute even a don't retain even a single rupee of profit, 0% retention. Distribute 100% profits to the equity shareholders, 100% payout can maximize the value per share. You know the logics, right? Yes. And then R is equal to KE. This is an important point. If R is equal to KE, the dividend policy cannot impact the value per share. That means any payout ratio, it can be 30%, 40%, 50%, 70% dividend payout ratio. Under all payout ratios, I'll get same market price per share as per Walter's model. If R is equal to KE. Now tell me, R greater than KE, what is the optimum payout ratio? 0%. What is the optimum payout ratio when R is less than KE? 100%. Equal to KE. There is no optimum payout ratio. Any payout ratio will give you same market price per share, right? Now Gordon model. The same assumptions more or less. Firm is an all equity firm. It will never go for debt. IRR remains constant. R is always constant. KE will remain constant. KE is always constant. Retention ratio is always constant. See, you know, retention ratio and dividend payout ratio, right? Say for example, if the company is earning 10 rupees profit and if the company is paying a dividend of 6 rupees, that means it is paying 60% of earnings which belongs to equity shareholders and it is retaining 40% profits. So dividend payout ratio and retention ratio both are interrelated, right? Yes. So that retention ratio is always constant, which is denoted with B, small b. Growth rate is always constant. Growth rate is a multiplier of B into R. That is also one of the assumptions. Where B is retention ratio, R is rate of return. K should always be greater than G. Nothing but K should always be greater than B into R. Okay. Otherwise, I cannot define the market price per share. All investment proposals are to be financed through retained earnings only. I don't go for fresh. I don't go for external financing like debt. Is it clear? And also, I don't raise the fresh equity. I don't raise the fresh equity. Yes, if you earn profits, you have two options. Either you can retain the profits or you can distribute the profits. Whatever the conclusions we have considered in Walter's model, the same conclusion should be considered here. If R greater than KE, what will you do? You better retain the profits. If R less than KE, what will you do? You better distribute the profits. Retention, distribution are having some advantages and disadvantages. You know, if you retain the profits, you can achieve more growth. Why? Because retained profits can be invested in the new projects. New projects will generate extra production, extra sales, extra profits in addition to the existing profits. So your profits will grow. So your growth will be increased, right? Along with that, you know, a bird in hand is much better than two in the bush. So current dividends are certain when compared to future capital gains. future growth rate. So I'm not interested in future growth because that is uncertain. So if the company retains profits, I'm going to face what? Risk. And that is a disadvantage, right? Yes. And then the same or reverse to distribution of profit. If you distribute the profit, then risk will be reduced, but growth will also reduce. Am I right or wrong? Yes. There is a formula as per Gordon's model. MP naught is equal to EPS 1 into 1 minus B by KE minus BR, which is also known as DPS 1 by KE minus C. It is just like dividend growth model, right? What is the formula for MP naught as per Gordon model? EPS 1 into 1 minus B divided by KE minus BR, where B is retention ratio. EPS 1 is expected earnings per share at the end of year 1. KE is cost of equity. This is R. Accept this. This is R. Okay. That's not an arrow mark. What do you say? That is rate of return. B into R is growth rate. B into R is a growth rate. B means what? Retention ratio. R means rate of return. G is equal to B into R. Yes, you know that. What is the formula for MP naught as per dividend growth model? DPS 1 by KE minus Z. Dividend growth model. Okay. What is the formula for MP naught? DPS 1 by KE minus Z. How I can get DPS 1? DPS naught into 1 plus Z. D naught is nothing but DPS naught. Is it clear? Yes. P naught is current market price per share. D naught is current dividend. Nothing but current last year dividend. G is constant annual growth rate of dividend. KE is cost of equity capital. Expected rate of return. Got it? Yes. Now, G is constant annual growth rate of dividends. KE is cost of equity capital. Expected rate of return. Dividend discount model. Already we have followed dividend discount models actually. Zero growth rates. In case if you are following zero growth rates, then that means all dividends, all the future rate dividends are constant. P naught is equal to D by KE. No growth is applicable. If growth rate is applicable, then the constant growth rate is applicable. What is the formula? P naught is equal to DPS 1 by KE minus G. This is not KE, KE minus G. Got it? That's what the constant growth rate situation. In case if the growth rate is variable, then the formula for market price per share is dependent on the process. Okay. So growth rate is deferred for every year. Most common forms are initial high growth rate, a transition to slower rate, a sustainable steady growth rate for the future years. Present value of each stage of dividend, present value of each stage are added together to derive the intrinsic value of the stock. Actually, non-constant growth rate situation it is. Under non-constant growth rate situation, how to calculate value per share, right? First, we should convert the constant growth rate situation formula, and then I'll convert all the years cash flows into all the years dividends into present value terms. There is a problem related to this concept, if you remember, for non-constant growth rate. Variable growth rate is nothing but what? Non-constant growth rate. See, these are all the models to calculate value per share. These two are very important. What are those two formulas? No growth, D by KE. If we have a growth, DPS 1 by KE minus G. Remember these formulas. Okay. Traditional model or Graham and Dodd model. There is another model, a traditional model, which will give more weightage to dividends and less weightage to retained earnings, right? Hello. Yes. What is the formula? P naught is equal to see, the stock market places considerable weight on dividends and than on retained earnings. The formula is MP naught is equal to D plus E by 3 into M, where D is dividend per share, E is earnings per share, M is a multiplier. It is not PE ratio. M is just a multiplier. No explanation for that particular term M. Okay. Traditional model. This is regarding traditional model. This is Lindner's model. Okay. Lindner's model never defines any market price, but they have defined DPS1. What is the formula for DPS1 under Lindner's model? DPS naught plus EPS1 into target payout ratio minus DPS naught into adjustment factor. Tell me, what is the formula for DPS1 under Lindner's model? DPS naught plus EPS1 into target payout ratio minus DPS naught into adjustment factor. The DPS naught is last year dividend, EPS1 is next year expected dividend, first year expected dividend, and here AF is adjustment factor. DPS1 is expected dividend per share at the end of year 1. Actually, this model will adjust the dividends, they'll never follow constant dividend payout ratio. They'll adjust the dividend based on the future sustainability of earnings actually. So that's what the conceptual background. You just remember this formula, you can easily solve the problem. Okay. Now the next model is Modigliani and Miller model. They'll always against to the world. They are saying dividend decisions are irrelevant for value of the firm or value of the equity share. Value of the firm actually. Assumptions. Perfect capital market exists. Nobody can influence the market. No taxes are applicable. Fixed investment policy. Always will invest. Always will follow fixed investment policy for accepting the new projects. No flotation or transaction cost. Risk of uncertainty doesn't exist. We don't consider uncertainty and risk here. Yes, as per M&M model. Under M&M model, the holding period should be considered for 1 year, not indefinite period. That's why we'll consider dividend at the end of first year, market price per share at the end of first year. These two are the cash flows, should be discounted at first year ending discount rate. I'll get current market price per share. 1 plus KE whole to the power of 1. If you remember, right or wrong? I'm discounting how many years cash flows for calculating market price per share under M&M model? 1 year. And what are the cash flows at the end of first year? I'll get dividend D1. I'll get market price per share sale process at the end of first year P1 divided by 1 plus KE whole to the power of 1. Actually, we don't need to write power 1 because anything is equal to anything power 1, right or wrong? So tell me what is the formula for P0? D1 plus P1 divided by 1 plus KE. But D1 is expected dividend per share at the end of year 1. P0 is current market price per share. P1 is expected market price per share at the end of year 1. Cost of equity KE, right? And M&M model proved that the present value, the current market value of the firm and the future market value of the firm remains unaffected by the dividend payout. Whether you pay dividend, whether you declare dividend or not, it doesn't matter. The current market value remains constant and the future market value remains constant. And they have derived one equation for calculating the current market value. Look at the formula. This NP0, where N is current number of shares outstanding, P0 is current market price per share, which indicates number of shares outstanding into current market price per share gives you current market value of equity, which is nothing but current market value of the firm. The formula is N plus M into P1 minus I plus C whole divided by 1 plus KE. What it indicates? This is current market value of the firm. Have you observed one thing? In this formula, we don't have any information regarding dividend term. That means the current market value of the firm is not going to be dependent on the dividend that you are paying. Is it clear? Sir, what are these terms? Where N is current number of shares outstanding, M means number of new shares to be issued, P1 means market price per share at the end of first year, I is investment, E is total earnings, K is cost of equity. Let me write the terms. M is equal to what? Number of new shares to be issued for financing the new project, right? And P1 is market price per share at the end of first year. N means current number of shares outstanding. Got it? Yes. There are some points here. Stock split. Stock split means, see, it's a theoretical concept. You can read it and understand it. This is related to investment decisions, right? This one, investment decisions. Yes, stock splits. Splitting of one share into many. Stock split means the face value of 10 rupees share will be split up into 2 shares with a face value of 5 rupees. That's what stock split. Do you know that? Yes, the stock split acts as a tool to maintain price range so that it does not move too high to become unaffordable for a wide range of investors. Generally, the companies will go for stock split to attract more investors in the stock market. Is it clear? Because if the share price is increased too high, then the normal investors may not afford that higher price. Then they'll go for stock split. In case if the share price reaches to 25,000 or 30,000 rupees, then they'll go for stock split in such a way that every investor can buy there at least one share. Is it clear? And because of that reason, companies will go for stock split. Is it clear? With this, the background of dividend decisions is over. Can you please tell me the page number for problematic part? 38. Yes. Look at the first problem. AB Engineering Limited belongs to a risk class for which the capitalization rate is 10%. This is KE, okay. It currently has an outstanding 10,000 shares selling at 100 rupees each. Nothing but this is N. This is P0, current market price per share. The firm is contemplating the declaration of 5 rupees dividend per share at the end of the current financial year. It expects to have a net income of 1 lakh rupees and has a proposal for making new investment of 2 lakh rupees. You know, the company is expecting 1 lakh rupees profit for the next year, and also it is planning to invest in the new project which costs 2 lakh rupees. Calculate the value of the firm when dividends are not paid, when dividends are paid. So we have to calculate value of the firm when dividends are not paid, when dividends are paid. First of all, you have to calculate P1 when dividends are paid and when dividends are not paid. Value of the firm when dividends are not paid. You know, KE 10%, P0 100, D1 0, because I'm not paying any dividend. So write the formula. P0 is equal to P1 plus D1 divided by, in fact, D1 plus P1 divided by 1 plus KE. Substitute the numbers except P1. I got P1 is equal to 110. That is your market price per share when dividends are not paid. Calculation of funds required for new investment. How much is your earnings? 1 lakh. Are you distributing any dividend? No. How much fund is available for investment? 1 lakh. How much total investment is required? 2 lakhs. So how much balance of fund is required to be issued through new equity? 1 lakh. At what price? 110. 1 lakh by 110. That will be the number of new shares to be issued. See, this is not sigma n. This is, okay. Actually, they have given you another new term actually. This is in fact small m, right? Hello. This is delta and this is not delta and actually this is small m, right? Hello. So number of new shares to be issued. How many number of shares to be issued? 1 lakh by 1 lakh, 110. 1 lakh by 110. 909. These 909 point. Even fractional shares can be issued in M&M theory. 09 shares, right? Consider this number. Now calculation of value of the firm. You know, these are the number of new shares to be issued actually. Calculation of current value of the firm. What is the formula for current value of the firm? NP0 is equal to N plus M. This delta N is nothing but what? M. Into P1 minus I plus C divided by 1 plus KE. Current number of shares are 110. Number of new shares 1 lakh by 110 into 110 a P1 minus 2 lakhs plus 1 lakh. I is 2 lakhs, right? And plus 1 lakhs is earnings divided by 1 plus 10%. 1 plus 0.10. How much is your current market value of the firm? 10 lakhs. So your current market value of the firm remains same, right or wrong? Now look at when the value of the firm when dividends are paid. So in the similar way, if you take the dividend of 5 rupees, which is given in the problem, then you'll get P1 is equal to 105. Consider this price for calculating number of new shares. Earnings 1 lakh, 50,000 dividend I'm paying. This is retained earnings, right? So new investment required is amount required for new investment 2 lakhs. Already we have a retained earnings of 50,000. Extra money to be raised to fresh equities to 1,50,000. So 1,50,000 should be issued at a price of 105 at the end of first year. And that is nothing but delta N, which is also known as small m, right? Current market value of the firm. NP0 is equal to N plus small m into P1 minus I plus C divided by 1 plus KE. 10,000 plus 1,50,000 divided by 105 into 105 minus 2 lakhs plus 1 lakh divided by 1 plus 0.10, right? How much? 10 lakhs. That's what the current market value of the firm. Got it? So, hence prove that the current market value of the firm remains same at 10 lakhs whether you declare dividend, whether you don't declare or you don't declare dividend. It doesn't matter. So, M&M proved that the market value of the firm remains unaffected by dividend payout. Are you getting? Yes. Now, the second problem. The following information pertains to Messrs XY Limited. Earnings of the company 5 lakhs, dividend payout 60%, number of shares outstanding 1 lakh, equity capitalization rate 12%, rate of return on investment 15%. You know, equity capitalization rate is KE, rate of return is R, right? Calculate market value per share as per Walters model. What is the formula for market value per share as per Walters model? D by KE plus R into E minus D by KE whole divided by KE. See, if you simplify that formula, you'll get this formula only. Okay. Yes. Then we know the numbers. Earnings per share 5. How I can get this? 5 lakhs by 1 lakh, 5 rupees, right? Then dividend per share 3, because I'm distributing, the company is distributing 60%. 5 into 60%, 3 rupees. R is 15%, KE is 12%. Substitute the numbers, you'll get market price of 45.83. What is the second question? Optimum dividend payout ratio according to Walters model and the market value of the company share at that payout ratio. Tell me one thing. How much is your R? The rate of return is 15%, whereas cost of equity is 12%. So R is greater than KE. So when R is greater than KE, the optimum payout ratio should be 0%, right? So look at the sentence. According to Walters model, when the return on investment is more than cost of equity capital, the price per share increases as the dividend payout ratio decreases. Nothing but you should not pay any kind of dividend. That's what he's saying. So the optimum dividend payout ratio in this case should be nil. So at this payout ratio 0, You have to calculate market value of company share. The formula by substituting the numbers. 0 dividend you are distributing, right? So substitute the numbers, you'll get 52.08. This is the maximum price you can achieve. Right now you're following 60% payout ratio. There your market price is 45.83, which is less than the market price which is achieved at optimum payout ratio, right? Now look at third problem. Taking an example of 3 different firms, growth, normal and declining. Calculate the share price using Gordon model. R greater than KE, 15% greater than 10%. 10 R equal to KE, 10% is equal to 10%. R less than KE, 8% is less than 10%, or KE, right? We have earnings per share, retained earnings, nothing but retention ratio. This is retention ratio, okay? And 1 minus B dividend payout ratio. We have these ratios. Now, you have to calculate market price per share by using Gordon model. What is the formula for market price per share by using Gordon model? E1 into 1 minus B by KE minus BR. E1 is 10. I know that, right? For growth firm, E1 is 10 into 1 minus 0.6 divided by KE minus 0.6 into 0.15. How much is the share price? 100, right? 400 rupees, right? This is growth firm. R is equal to KE. Please see it. 10 into 1 minus 0.6 divided by 0.10 minus 0.10 into 0.6. This is B. This is B. This is R, right? Hello. The rate of return is 10%. For growth firm, the rate of return is more. And for normal firm, the rate of return is equal to cost of equity. How much is your market price? 100. And for this is not normal firm, right? This is declining firm. Hello. This is declining firm. Yes, for declining firm, R less than K. By substituting the numbers, how much we got? 76.92. If the retention ratio B is changed from 0.6 to 0.4, then the new share price will be as follows. Previously, we have taken 60% payout ratio. Now we are 60% retention ratio. Now we are taking how much retention ratio? 40%. Then the share price will be changed. For growth firm, how much we got? 150. Normal firm, 100. Declining firm, 88.24. From the above analysis, it can be concluded that R greater than K, the market value increases with the retention ratio. Obviously, if R is greater than KE, I will always go for more retention. That's why, in the previous part, the first part, I've distributed 40% and I've distributed 40% and retained how much percentage? 60%. I got 400 rupees market price for a growth firm. But if you look at the second situation, I'm going with a 40% retention. That means I'm distributing 60%. If I increase the payout ratio, what could happen? The share price will decrease. Previously for growth from the market price is 400. Now it is 150. Is it favorable? No. Why? Because you have increased the dividend payout, right? Yes. And like that, you have to observe the normal firm market price and then for declining firm market price. Have you observed one thing? The normal firm market price is 100 when I'm paying 60% dividend, when I'm paying 40% dividend, and when I'm paying 60% dividend, then also my market price is 100. No change in it, right? And look at the declining firm. In the similar way, compare it. If R is less than K, always you should pay more dividend. Then only you can achieve higher price. Previously I'm distributing 40% dividend. Now I'm distributing 60% dividend. My market price has been increased, right? Previously it is 76.92. Now it is 88.24. R less than K, the market value per share stands to decrease. Yes, obviously. R less than K, the market value of share stands to decrease. In fact, it is increased, right? Hello. The market value of share is increased. Please change it. If R is equal to KE, the market value is not affected by dividend policy. The conclusions of Gordon's model is similar to that of Walter's model, more or less. Got it? With this, the dividend decisions are completed. Good evening, all of you, dear students. Yeah. New chapter, working capital management. It's a big chapter actually. In working capital management, we should handle these areas. Introduction to working capital, cash management, management of inventory I don't cover because that is already covered in materials chapter of your costing subject, right? Management of debtors, management of creditors, and financing of working capital. So first of all, introduction to working capital management. Working capital means it is the difference between current assets and current liabilities, right? Your working capital is classified on the basis of value and on the basis of time. On the basis of value, which is classified into gross working capital and net working capital. Gross working capital means current assets. Net working capital means current assets minus current liabilities. On the basis of time, working capital is classified into two types: permanent working capital and temporary working capital. You know, permanent working capital means that is a level of working capital which is maintained throughout the year. Whereas temporary working capital is maintained on the basis of seasonal fluctuations. You know, this temporary working capital is not going to be maintained throughout the year. It will be maintained based on requirement. Okay. So it's an additional working capital in addition to permanent working capital. Scope of working capital management. You know, see, we'll cover these areas in the middle of this chapter. First of all, let me go for working capital estimates. That's the most important area. You know, while estimating the working capital requirement, you should use several methods. Current assets holding period, which is essentially based on operating cycle concept. Ratios of sales, ratios of fixed investments, nothing but fixed assets actually. Okay. You know, in the examination, they'll ask you to calculate working capital estimate based on this current assets holding period, raw material holding period, work in progress holding period, finished goods holding period. You know, based on the inventory norms, we'll estimate the working capital requirement. This is much important method. And there exists another method. By applying a constant percentage on sales, I can estimate the working capital requirement. And by applying some constant percentage on fixed assets, I can estimate the working capital requirement. These are two theoretical concepts applicable to small industries. But for large scale industries, always will follow the first method only, right? So how I can estimate the working capital requirement? First of all, you have to prepare cost statement. This is step number 1. Okay. Yes. How I can estimate the working capital requirement for a manufacturing concern? That's what our discussion is all about. You know, cost statement, raw material, labor, overheads, per unit cost statement should be prepared. I'll get total cost per unit. Then to that total cost per unit, we should add profit to get selling price per unit. Got it? Then I'll estimate the working capital requirement. While estimating the working capital requirement, these are the components must be considered. Investment in stock of raw material, investment in stock of work in progress, investment in stock of finished goods, investment in debtors, investment in cash and bank balances. Will get gross working capital minus creditors for raw material, outstanding wages, outstanding overheads, short-term bank loans like bank overdraft or cash credit. These are the items we have to consider. Along with that, in current liabilities, we can also find the provision for taxation. Is it clear? And in current assets, we can find advance expenses. Nothing but prepaid expenses. Now look at the estimation of working capital requirement. This is a format. Investment in stock of raw material. How I can estimate the working capital requirement? First of all, estimated production units into estimated raw material cost per unit into raw material holding period divided by 365 days or 12 months. Actually, what we'll do? Raw material consumption units into raw material cost per unit into raw material holding period divided by 365 days. That's what the calculation is all about, right? See, the production units and consumption units, every units are same. If you remember, what do you say? Generally, in the examination, they'll give you like this. The production units are equal to 60,000. See, the same units are considered as raw material consumption units by taking input-output ratio as 1:1. And the same production units are considered as sales units by taking opening and closing stock of finished goods as one and the same. Raw material consumption units should be considered as raw material purchases by considering opening and closing stock of raw material as one and the same. The entire purchase should be considered as credit purchase. Entire sales are considered as credit sales unless otherwise specifically stated. In most of the cases, always production units are raw material purchase units, credit purchase units, raw material consumption units, and production units, sales units, credit sales units. There will be only one exception. In some problems, they'll test you in one area called credit sales. They won't give you credit sales directly. They'll say 3/4 of the total sales is credit sales, 1/4 is cash sales. Like that, they'll give you one sentence. And by considering such sentence, separate your credit sales. In most of the cases for other areas, always I'm going to use production units only. For that reason only, I'm using estimated production units here. Is it clear? So, estimated production units, investment in stock of raw material. Estimated production units into raw material cost per unit into raw material holding period divided by 365 days or 12 months. Investment in stock of work in progress. We have to consider which cost? Material, wages, overheads. Whereas the formula is estimated production units into work in progress holding period divided by 365 days into estimated work in progress cost per unit. I don't calculate estimated work in progress cost per unit. I'll take the bifurcation, right? What is the bifurcation? Raw material cost, wages cost, overhead cost. If you remember, for raw material, I'll take 100% cost, right? And for wages, I'll take 50% cost. And for overheads, I'll take 50% cost. What is the formula? Estimated production units into raw material cost per unit into work in progress holding period divided by 365 days. That's raw material cost component in work in progress. Coming to labor cost. Hello. Say investment in stock of work in progress. How we will calculate that? This is the formula. We'll use the method, right? Estimated production units. First of all, we have to identify the raw material cost which is blocked in work in progress. Estimated production units into work in progress holding period divided by 365 into raw material cost per unit, right? When it comes to wages, the same formula, but estimated production units into work in progress holding period divided by 365 days into labor cost per unit into 50%, right? We should apply 50%. The same way for overheads also, the same formula, right? But instead of that, I should use overhead cost per unit into 50%. This is a way to calculate each cost component, material, wages, and then overheads, and the total should be arrived to get investment in stock of work in progress. What do you say? Investment in stock of finished goods. Estimated production units into estimated cost of production per unit divided into 3 finished goods holding period divided by 12 months or 365 days. So, investment in stock of finished goods. Production units into finished goods holding period into raw material cost per unit. Actually, the formula is what? Production units into finished goods holding period divided by 365 days into estimated production costs of production per unit. Got it? Generally, we will take total cost if overhead bifurcation is not given in the problem. Is it clear? Yes. Investment in debtors. How I can get? Estimated credit sales into debtors collection period divided by 365 days into estimated selling price per unit. Estimated selling price per unit excluding what? Depreciation. Sometimes I can take estimated total cost per unit also. What was that? Total cost per unit also. So estimated credit sales units into debtors collection period divided by 365 days into estimated cost of sales. Actually, this is cost of sales, my dear students, not sales. Estimated cost of sales excluding depreciation. Sometimes for calculating investment in debtors, I can also consider selling price instead of taking what? Cost of sales. Mostly in this cost of sales, please exclude depreciation. Even in every cost component, please exclude depreciation while estimating the working capital requirement. Then I'll get investing cost, but not only investing cost only, but not profits. Investment in cash and bank balance, I'll get gross working capital minus current liabilities. What are the current liabilities? Estimated credit purchase into creditors payment period divided by 365 days into raw material cost per unit. Outstanding wages, estimated labor hours into wage rate per hour. This is estimated wages cost, right? Wages cost into time lag, average time lag in payment of wages divided by 365 days. This is wages cost. Right away they have given wages cost. So in that case I can take time lag by 365. In case if you have written production units, then you have to multiply this number with wages cost per unit. What do you say? You can also write this formula: outstanding wages, production units into time lag divided by 365 days into wages cost per unit, right? Instead of that, they have taken directly the wages cost, estimated labor hours into wage rate per hour, and then estimated overheads, outstanding overheads, estimated overheads into, this is total overhead cost, into average time lag in payment of overheads divided by 12 months or 365 days. Instead of that, I can also calculate like this. How I can calculate this? Production units into time lag for overheads divided by 365 days into overhead cost per unit. Did you remember that? Yes. What is the formula for outstanding wages? Production units into time lag for wages divided by 365 days into wages cost per unit. Got it? Yes, bank overdraft. Then I'll get net working capital A minus B. Yes. Generally, number of days in a year should be taken as 365 days or 360 days. See, in the absence of information, please consider 365. If it is given specifically in the problem like 364 or 360, please consider that number only. Is it clear? Yes. These are the formulas for estimating the working capital requirement. Got it? Yes. What to do? First, we have to prepare cost statement. Then we have to estimate the working capital requirement. One important point you should remember while estimating the working capital requirement is, please exclude depreciation from overhead. What was that? Exclude depreciation from overhead while preparing the cost statement. Always remember that point. It's a star mark point. Okay. Always exclude depreciation from overheads while preparing the cost statement, and that cost statement becomes your cash cost statement. And if you can estimate the working capital requirement by using cash cost statement, then that will be working capital requirement on the basis of cash cost statement. Is it clear? Yes. Now we understood how to estimate the working capital requirement. Look at the working capital approaches. You can maintain your working capital based on the approach that you are following. We have several approaches here: aggressive, moderate, and conservative approach. My dear students, working capital represents your liquidity. If liquidity is more, then risk will be low. Why? Because when you maintain high working capital, you'll be able to pay off your current liabilities very easily. Am I right or wrong? So look at the conservative approach. You can understand very easily. Liquidity, I'm maintaining high liquidity. The risk will be low because I can pay my current liabilities very easily. But since you're maintaining huge working capital under asset side, you should maintain huge fund under liability side. On that, you have to pay high finance cost, right? So the cost will be high. When finance cost is more, the profits will be low. Nothing but return will be low. Got it? So under conservative approach. Under aggressive approach, the liquidity will be low because I'll maintain under aggressive approach. I'll always maintain low working capital. That represents low liquidity. Because I'm maintaining low liquidity, the risk will be high. High risk. That means I may not be able to meet my current liabilities as and when they become due because I'm maintaining insufficient liquidity, right? And then the cost will be low. But since you're maintaining low working capital, your finance cost will be low. So you can increase your profitability, right? And the moderate approach, all the terms liquidity, risk, cost, and return will be moderate. So, sir, which working capital I should maintain? Can I maintain high working capital or low working capital or moderate working capital? It is based on the risk perception. That is what balancing of risk and return. If you maintain high working capital, the risk will be low, return will be low. If you maintain low working capital, the risk will be high, return will be high. That's it. High risk, high return, low risk, low return, which is known as balancing of risk and return, which is known as risk return trade-off in working capital approaches. Is it clear? So which approach I should follow? It is based on the risk perception of the management. I cannot simply say this is what the best approach. I cannot simply say moderate approach is the best approach. You can follow any approach. If you want more return, you'll follow aggressive approach. If you don't want to accept risk, you'll follow conservative approach. If you want to balance these two things, then you'll follow moderate approach. Got it? Yes. Cash cost statement. Already I've told you, this is the way to prepare cash cost statement. Raw material consumed, direct wages, factory overhead. Factory overhead means what? Cash factory overhead. That means I should exclude depreciation. Exclude depreciation from it. Then I'll get cash cost of production. What is this? Cash cost of production. Add admin overhead. This is cash admin overhead. And this is cash selling and distribution overhead. I'll get cash cost of sales. Got it? So please tell me how to prepare cash cost statement. Raw material consumed, direct wages, cash factory overhead. Then I'll get cash cost of production. To that you should add admin overhead, selling and distribution overhead, which are cash expenses. Then I'll get cash cost of sales. By using this cash cost statement, you have to estimate the working capital requirement. Got it? Yes. Listen, if the cost statement is directly given in the problem, for investment in stock of raw material, I should use raw material consumption. Is it clear? For investment in stock of work in progress, I should use raw material consumption, direct wages and factory overhead only. Don't touch admin and selling and distribution overhead. For investment in stock of finished goods, please use cost of production. Full cost of production. For investment in debtors, please use cost of sales. For creditors for raw material, please use raw material consumption subject to opening and closing stock of raw material adjustments. Hello. In case if your opening and closing stock of raw materials are different, please calculate raw material purchases separately. What is the formula for raw material consumption? Opening stock of raw material plus purchases minus closing stock of raw material. Purchases is equal to raw material consumption plus closing stock of raw material minus opening stock of raw material. By using that formula, please arrive raw material consumption. The entire purchase or credit purchase. Please consider such credit purchase for calculating creditors or raw material. Is it clear? For outstanding wages, use direct wages, total direct wages. And for outstanding factory overhead, please use factory overhead. And for outstanding admin overhead, please use admin overhead. And then outstanding selling and distribution overhead, selling and distribution overhead. You see, always whenever you are estimating the working capital requirement, please refer this cost statement. Is it clear? Yes. With this, we understood how to estimate the working capital requirement. Now I am moving to operating cycle. You know, my dear students, operating cycle means conversion of cash to cash. I'll buy the stock of raw material, right? I'll buy the stock of raw material. Then this raw material will be converted to, if you input the raw material, you see, this is your raw material. This is your raw material. The intention is simple. If you buy the raw material, you'll hold this raw material for a while, right? And then you'll incur labor and overhead expenses. Gradually, it will be a work in progress. And you are going to hold this work in progress for a certain period. Then that is work in progress holding period. It will be converted to stock of finished goods. And you should hold this finished goods stock for a certain period. That is finished goods holding period. Then after that, it will be sold. Then that particular data will take some time. Will take some time to collect the data, right? That is known as data collection period. Then finally, it will be converted into cash. So I can say raw material holding period plus work in progress holding period plus finished goods holding period plus data's collection period becomes my gross operating cycle period. You know, conversion of cash to cash cycle is nothing but operating cycle, which is also known as cash cycle. There is a format for calculating net operating cycle period. How to calculate net operating cycle period? Raw material holding period is equal to, you see the formula set, average stock of raw material divided by total raw material consumption to 365 days, period in days. Don't consider round off. I mean, don't make it round off. Okay. Write the exact numbers. Then because we'll go for round off of numbers only at the end of the statement, like in net operating cycle period. Only the net operating cycle period should be rounded off, but not this raw material holding period or work in progress holding period or finished goods holding period. Is it clear? Yes. If you get 44.24, write it exactly. Don't write 45 or 44. Is it clear? Yes. Raw material holding period formula. Average stock of raw material divided by total raw material consumption to 365 days. Work in progress holding period. Average stock of work in progress divided by total cost of production to 365 days. Finished goods holding period. Average stock of finished goods divided by total cost of goods sold into 365 days. Data's collection period. Average data's divided by total credit sales into 365 days. Then I'll get gross operating cycle period. Please deduct minus creditors payment period. Formula. Average creditors divided by total credit purchase into 365 days. Then I'll get net operating cycle period. So this is the way to calculate net operating cycle period. You should try to identify the numerator terms and denominator terms and the problem to calculate net operating cycle period. Once you calculate net operating cycle period, you have to calculate these terms also. What is the formula for number of operating cycles? 365 days or 12 months or 52 weeks divided by net operating cycle period. Sometimes this net operating cycle, number of operating cycles, sometimes this number of operating cycles can be asked in this way also. Cash cycle. What was that? Cash cycle. Wait, not cash cycle. Cash turnover. What was that? Cash turnover. Okay. Now working capital requirement. How I can estimate the working capital requirement? Simple. Cost of sales by number of operating cycles. Cost of sales by number of operating cycles. So, in case, in the problem, if they have asked you to calculate working capital requirement by giving this information, first of all, you have to calculate net operating cycle period. Then you should calculate number of operating cycles. And then you have to calculate working capital requirement. What do you say? Yes, this is regarding operating cycle. You know, my dear students, we should also consider the effect of double shift working on working capital requirement. There is one problem in your study material. There is effect of double shift on working capital requirement. You know, double shift leads to stock levels and data levels and every component will be changed, right? All of your production units are going to be doubled, but not your working capital. Working capital is going to be increased, but it is not going to be doubled because Because of this reason, I have to calculate the working capital requirement. One important point which you should remember while estimating the working capital requirement of a double shift concern, nothing but when we are shifting from single shift to double shift. When we are shifting from single shift to double shift, the cost sheet is going to be changed. Remember that point. Then second point, when we are shifting from single shift to double shift, every inventory norm is same. Raw material holding period, raw material holding period, work in progress, raw material holding period, finished goods holding period, debtors collection period, creditors payment period, time lag, everything is same except work in progress holding period. Your work in progress holding period under double shift will be half of the work in progress holding period under single shift. Because of that reason, your units under single shift and double shift remain same, but the value will change. Okay, is it clear? So one important point you have to remember is the processing period under double shift and the processing period under single shift, both are not same. The processing period under double shift will be half of the processing period under single shift. Say for example, if the processing period under single shift is 30 days, then the processing period under double shift will be 15 days, 0.5, half month, right? So you should be very careful. The cost sheet is going to be changed, and then every inventory norm is same except work in progress holding period. Please consider those factors while estimating the working capital requirement under double shift working when you're shifting from double shift, single shift to double shift. Got it? Yes. Yes. Cash management. It is concerned with management of cash flows into and out of the firm, cash flows within the firm, and cash balance is held by the firm at a point of time by financing deficit or investing surplus cash. It's all about actually the cash budgets. Generally, we'll estimate the cash flows for the future period for the respect for different months in based on our estimations. If you find any surplus cash, then we'll plan the investments. If you find any deficit cash in the future months, then we'll plan our short-term borrowings. Is it clear? Yes. Cash management. The need for cash, transaction need, speculative need, precautionary need. And then the cash planning and controlling the use of cash. Cash budget represents cash requirement of business during the budgeted period. And this is all about theoretical area. Now look at the format. This is related to problematic area. Format of cash budget. Look at the cash budget format. Opening balance plus receipts. Short-term loan. In case of deficit, the minimum, in order to maintain minimum cash balance, sometimes we'll go for what? Short-term bank loan. See, in case of deficit, then minimum cash balance should be maintained by adjusting the receipts with short-term loan. This point is covered in the classes actually. Okay. So this short-term loan minus payments that gives me closing balance minus investment in short-term securities. If we have surplus cash, we'll go for what? Investment in short-term securities. Then we'll get closing balance to be maintained. Yes. This is a simplified format of cash budget. What is the format? Opening balance plus receipts minus payments. I'll get what? Closing balance. And whenever we face the surplus, whenever we get the surplus, that should be invested in short-term securities. Whenever we face the deficit for every month, for any month, if we face the deficit, then we should plan short-term loan. Okay. To maintain minimum balance. Methods of cash flow budgeting. Yeah, we have, this is a theoretical area. We don't have any problems related to this. Receipts and payments method, adjusted income method, adjusted balance sheet method. Okay. Yeah, under receipts and payments method, all expected receipts and payments for the budgeted period are considered. The cash inflows and outflows of all functional budgets, including capital expenditure budgets, are considered. Just now we understood the format, right? And then adjusted income method. Annual cash flows are calculated by adjusting the sales revenue and cost figures, nothing but cash flow statement. Okay. And then adjusted balance sheet method. By comparing the balance sheets also, I can prepare the cash flow budget actually. Yes, cash budgets for long period. Take the cash at the beginning of the year, add trading profit before tax expected to be earned, depreciation and other development expenses, sale process of assets, process of fresh issue of equity shares and debentures, reduction in working capital, that is current assets less current liabilities, deduct dividends to be paid, cost of assets to be purchased, taxes to be paid, debentures or preference shares to be redeemed, increase in working capital, that is current assets less current liabilities. It is just a simple format actually for estimating the cash budget, for preparing the cash budget. Just follow this format also. Yes, I'm moving to the next area, float. Float means delay. This is related to cash management. See, delay happens because of several reasons. One is billing float. It is a time gap between it is a time gap between the sale and the mailing of the invoice. The company will prepare an invoice, and that should be mailed, or that should be sent to whom? The buyer of the products from our company. So it will take some time, which is known as what? Billing float. We are taking some time to prepare the bill invoice and send it to the same to the customer to collect the respective dues. Is it clear? And it's a delay in the hands of whom? The company, our company hands, right? Mailing float. This is billing float, and the second one is mailing float. Mailing float means after receiving the bill, the customer will prepare a check to honor our payment related to the bill. So he will take some time to prepare the check which is being carried by post office, messenger service, or other means of delivery. Ultimately, that should be delivered to whom? Our company. There is a chart we'll prepare, if you remember. Our company is located in Hyderabad, and our customer is located in Chennai. He is located in Chennai. See, we are preparing an invoice and we are taking some delay. What was that? Billing float. To send that bill to the respective customer who is located in Chennai, we are taking some time, right? And that is what? Billing float. Then the customer will prepare a check. He will prepare a check and send it to our company, which is located in Hyderabad. Our company name is XYZ Limited. He is taking some time to mail the same bill, same check, right or wrong? See, after receiving the invoice, the customer will prepare a check to make the payment, right? And the same check will be delivered to the supplier who is located in Hyderabad. He will take some time. This is known as what? Mailing float. After receiving the check, this particular company XYZ Limited will take some time to sort, because we have to separate so many checks which were received from several companies, right or wrong? And then we have to record such check in the books of accounts. Then we'll deposit such check in our bank account, right? XYZ Limited is having some bank account with ICICI Bank. It is deposited. Deposit of check is not equal to deposit of cash, because that's an account pay check, right? He will prepare an account pay check actually. This is an account pay check which worth 1 crore. So now our company is taking some time to sort out and to record and to deposit such check in our bank account. This is a delay in the hands of the company, which is known as check processing float. What is this? Then after depositing the check, you don't get the money. Again, our banker will reach the customer's banker, say SBI, for collecting the money which is specified in the check. It will take some time in the hands of the ICICI Bank, our banker, and that is known as bank processing float. What was that? All these are delays. All these are delays in the hands of the company, in the hands of the customer, in the hands of the banker, right or wrong? So these delays will increase the opportunity cost. Billing float, mailing float, check processing float, and then what? Bank processing float. You should try to reduce these float periods by applying the methods called concentration banking, or the systems called concentration banking or logbox system. In concentration banking, I'll do one thing. I'll try to identify the locations where our majority customers are located. I'll open one collection center. I'll direct the customers to deposit the respective checks in the collection center. Our collection center will deposit checks on daily basis to our local bank. Actually, you see, listen, our company will identify the major locations where our majority customers are located. There we'll open one local bank account. Okay, we'll open what? One local bank account. And also we'll direct the customers to deposit our checks in the collection center, which we will open. And then the collection center will deposit such checks on daily basis in our local bank account. Our local banker will collect the money immediately in the same area. Then the money, after receiving the money in the local bank account, that particular local banker will maintain minimum balance, and the balance will be transferred to our main bank, which is located in our area. Is it clear? See, look at this system here. We are opening one local bank account in our customer's place, and we are opening one collection center, and we are trying to reduce so many float periods here. Mailing float, check processing float and bank processing float will be reduced to major extent. Is it clear? So that we can reduce our opportunity cost. Say for example, generally if we take 20 days for a collection, because by applying this concentration banking system, such 20 days can be reduced to 8 days or 7 days also. So that because of the reduction in number of days in the collection period, I can reduce my opportunity cost, because early collection results in a reduction in opportunity cost, right or wrong? Yes, this is regarding concentration banking system. Identifying the locations where majority customers are located, open a local bank account in that particular location, open a collection center in that location, and then we'll direct the customers to deposit checks, and then such checks will be deposited by collection center in the local bank account, and the money will be transferred immediately to our bank our main bank account upon collection, right or wrong? Now local box system. Logbox system. Under logbox system, instead of opening collection center, our company will install one local post box. It will hire one local post box, and it will install one local post box in the places where our majority customers are located. And also we'll open a local bank account, and we'll instruct the customers to deposit the checks directly in the post box, and also we will authorize the banker to pick up the checks on daily basis on the post box and deposit the same checks in our local bank account. And then the local banker will immediately transfer the money to our main bank account upon collection. Is it clear? Yeah, right. This is regarding logbox system. Even this system also can reduce your float period. So the objective of concentration banking system or logbox system is to reduce the float period, like mailing float, check processing float, and bank processing float, so that we can reduce our opportunity cost to major extent, right? See, this is not a cancelled item. This is an important item. Unfortunately, this was cancelled actually. This is an important item. Hello, this is an important area you have to understand. RBI introduced several norms for maximum permissible bank finance. RBI introduced Tandon Committee, which allowed and fixed certain maximum permissible bank finance from all banks, implementing 3 methods. There are three methods for calculating the maximum permissible bank finance. Generally, companies will borrow money from several banks without any limit. But RBI released a few norms by forming a Tandon Committee. With the help of Tandon Committee, they have released several norms for maximum permissible bank finance. This is completely related to short-term bank finance, to finance the working capital requirement, because our chapter is working capital, right? Yes. There are 3 methods for estimating the maximum permissible bank finance. MPBF is equal to, method 1 says 75% of current assets minus current liabilities. Method 2 says 75% of current assets minus current liabilities. Method 3 says 75% of current assets minus core current assets minus current liabilities. My dear students, core current assets are nothing but permanent working capital. Okay. So I'm not digging the concept. Simply remember the formulas. MPBF under method 1. MPBF is equal to 75% of current assets minus current liabilities. I can say 75% of net working capital, right? Method 2, 75% of gross working capital, nothing but current assets, minus current liabilities. And method 3, 75% of current assets minus core current assets, minus current liabilities. There are some ideal ratios which were fixed by Tandon Committee. The ideal ratio under method 1 should be 1:1, method 2 1.33:1, method 3 1.75:1. Generally, if our ratios are more than these ratios, we are in a better position. If our ratios are less than these ratios, our position is not good, right? Yes. For maintaining minimum cash balance, generally every company will maintain their cash in short-term securities. And whenever they need cash for the respective requirements, like for regular expenses, they'll sell their securities and they'll meet their expenses. To earn minimum interest in the securities, always the companies will invest in short-term securities, money market instruments like Indian treasury bills, certificate of deposits, intercorporate deposits. There are so many money market instruments in India. So every company will invest the cash in the short-term securities, okay, to earn some interest. So whenever the money is required for meeting expenses, they'll sell the securities. The question is, how much cash should be maintained? So in which lot size how to sell the securities? That's what the question. And there comes the importance of these models. Cash management models. How much cash how to maintain? Okay. There are 2 models here. One is the case of if the demand for cash is certain. The second one is if the demand for cash is uncertain. So if you're sure about the future cash flows, if the cash flows are even, say for example, if the estimated cash flows are 365 crores for the next year. The expenses are 365 crores for the next year. If I'm sure, very much sure about that, about this 365 crores expenditure, like every day 1 crore. Surely I'm going to incur every day 1 crore. Then that is a case of even cash outflows. If I'm not sure about 365 crores, in some months I'll incur 60 crores, and in other months I don't incur any expenditure, and in other months I'm going to incur 90 crores. Like that, the outflows are random. Then that is a case of the demand for cash is uncertain, random cash outflows. In both the cases, we'll use two models, different models. In case of even cash outflows, I'll use Baumel's model. Very important model, my dear students. Which model? Baumel's model, which is also known as inventory model. Sir, what is the formula for Baumel's model for maintaining optimum cash balance? Square root of 2FT by R. What is the formula? Where C is equal to optimum lot size. What was that? T is cost per transaction. R is opportunity cost of capital, also known as interest rate per period. What is this? Yeah, actual interest rate per annum. Tell me, what is the formula for optimum lot size? C is equal to square root of 2FT by R, where C is optimum lot size, F is annual cash disbursements, T is cost per transaction, R is interest rate per annum or opportunity cost of capital. Nothing but this interest rate is interest rate on my short-term securities. Is it clear? What is the formula for transaction cost? Number of transactions into cost per transaction. What is the formula for number of transactions? Annual cash disbursement divided by lot size. You got it right? And also, you should calculate two other transactions. Yes. Average cash balance is equal to, please write it. Average cash balance is equal to lot size divided by 2. Opportunity cost is equal to average cash balance into interest rate per annum. Interest rate per annum. This is the formula for opportunity cost. The total of opportunity cost and transaction cost represents your total cost. I'll always choose the lot size where my total cost is minimum. I can achieve least total cost by following the formula square root of 2FT by R. In case if the lot sizes were given in the problem itself, then you have to calculate total cost by calculating number of transactions, transaction cost, average cash balance, and then what? Opportunity cost. You have to add transaction cost with opportunity cost to get total cost, and you have to choose the lot size where your total cost is least. Is it clear? Yes, tell me now. Under Baumel's model, what is the formula for C? Square root of 2FT by R. And what is the formula for transaction cost? Number of transactions into cost per transaction. Number of transactions formula. Annual cash disbursement divided by lot size. Average cash balance formula. Lot size divided by 2. What is the formula for total opportunity cost per annum? Average cash balance into interest rate per annum. What is the formula for total cost? Total cost is equal to transaction cost plus opportunity cost. See, in case if the if there is no information about formula, like in case if they have given lot sizes, you have to calculate total cost for each lot size separately and choose the lot size where your total cost is least. And such lot size becomes your optimum lot size. Is it clear? Yes. Now we have another method called stochastic model or Miller-Orr model. You know, in stochastic model or Miller-Orr model, we'll fix the limits like upper limit, return limit and lower limit. Always we'll try to maintain the cash balance at return level. In case if the cash balance reaches higher level, what we'll do? We'll sell and we'll buy 2Z worth of securities. In case if your return level reaches, if your cash balance reaches to lower level, then immediately we'll sell Z worth of securities. What do you say? There is a graph if you remember right. The formula for Z is cube root of 3TB by 4A. 3 is missing there. Please write it. Cube root of 3TB by 4A. But T is cost per transaction. V is variance of daily cash flows. Variance of daily cash flows. Also known as standard deviation square. Because if you, in case if the standard deviation is given in the problem, you should apply square to that to get variance of daily cash flows. Right? I is interest rate per day. L is lower limit. R is return point L plus Z. H is upper point L plus Z plus 2Z. Totally 3Z. Got it? Yes. Average cash balance formula. The average of lower return and H, higher point, upper point. Nothing but L plus R plus H by 3. And then if you simplify the formula, you'll get L plus 4 by 3. This is also the formula for what? Average cash balance. Got it? Inventory management is covered in materials chapter, right? Okay, dear students, management of data, right? Three aspects are involved in management of data: defining the credit policy, credit analysis, and control of what? Receivables. Yes, decision of credit standards, credit terms, and collection efforts is included in credit policy. The credit period is generally stated in net terms. It can be expressed in 2/10 net 30, which means 2% cash discount if payment is made within 10 days. Normal credit period is 30 days. Or it can be expressed like this, net 30, or it can be expressed like this, net 60. These are your credit periods. You can follow, right? Credit discount policy specifies the rate of cash discount, the cash discount period, and the net credit period. See, these are all forming part of your credit policy. Credit analysis should be done before selecting the customers, because selection of the customer plays a crucial role in data's management. I don't choose the credit, the customers randomly. Always I'll choose the customers with lot of credit worthiness, right? See, those customers which are maintaining better financial viability, and always I'll try to choose the customers with great credibility and good name and goodwill. I'll choose the customers like that, right or wrong? I don't choose the customers who are not able to pay their respective dues. And always I'll check the past track record, financial track record, right or wrong? By seeing the financial statements, I can test their financial ability to pay off their respective liabilities. I'll see their liquidity position, everything I'll check. And that's what credit analysis, right? And after sanctioning the credit, I'll control the receivables. Cost of maintaining data are to be controlled. Why? Because we should maintain collection team, right? And also we should maintain some credit department for reducing the bad debts, for reducing the collection period. And these are all part and parcel of your data management. Got it? Yeah, this is all theoretical description. You should focus on this format. Evaluation of alternative credit policies. This is important for solving what? Problems. Theory and all you can read it, right? Now look at the problems. You can look at the credit policies here. This is the format. Existing policy net 30, proposed policy net 60, proposed policy 2 net 90. This is what the format. Credit sales A, B, total cost other than bad debts and cash discount. We have variable cost here, fixed cost here. Deduct this total cost from sales to get profit before adjustment of bad debts and cash discount. From that, please deduct bad debts and cash discount to get what? PBT. Then deduct the tax to get what? PAT. Less opportunity cost of investment in data to get what? Net benefit. Then please calculate incremental net benefit by comparing policy 1 benefit with existing benefit, by comparing policy 2 benefit with existing benefit. 1 minus existing, 2 minus existing is nothing but what? Incremental net benefit. I'll choose a policy, I'll select the policy, I'll adopt the policy where my incremental net benefit is higher. Now tell me the format. Evaluation of alternative credit policies. Columns, particulars, existing policy, proposed policy 1, proposed policy 2. A, credit sales. B, total cost other than bad debts and cash discount. Write the expenses, variable cost, fixed cost. Then I'll get total cost. Then if you deduct the total cost other than bad debts and cash discount from credit sales, I'll get what? Profit before adjustment of bad debts and cash discount. Deduct bad debts and cash discount. I'll get PBT, less tax, PAT, less opportunity cost of investment in data. Then I'll get net benefit and calculate incremental net benefit by comparing with the new policies. And then investment in data can be calculated on the basis of sales value, on the basis of total cost, or on the basis of variable cost. Generally, in most of the times, I'll follow total cost method. See, on the basis of sales value, the formula, credit sales into data's collection period divided by 365 days. I'm talking about investment in data's only, okay? And if you calculate investment in data's based on cost of sales, total cost of sales into data's collection period divided by 365 days. On the basis of variable cost of sales into data's collection period divided by 365 days. So then we'll get investment in data's. After calculating investment in data's, you have to calculate opportunity cost of investment in data's. Formula, credit sales into data's collection period divided by 365 days into required rate of return, which is also known as cost of capital, right? That is for on the basis of credit sales. On the basis of total cost, tell me, opportunity cost of investment in debtors is equal to total cost of sales into debtors collection period divided by 365 days into required rate of return. On the basis of variable cost of sales into debtors collection period divided by 365 days into required rate of return. All these methods are applicable for what? Calculating opportunity cost of investment in debtors. Which method I'll apply? This is the most important method on the basis of total cost. Unless otherwise specifically stated, I always follow total cost for calculating opportunity cost of investment in debtors, which is supposed to be deducted from profit after tax to get what? Net benefit. Get it? Financing of receivables. My dear students, financing of receivables means I can get finance by pledge of my receivables. Pledging of receivables means your debtors can be pledged to your banker, and then you can raise some money and you can use that money in the working capital for your working capital requirement. The other method is factoring. This is the most important method. In this regard, we have some problems also, right or wrong. In case of factoring, what we'll do? The client company is having some customers, and that means it is having some debtors. They can collect the debtors, but it is taking much time for them to maintain huge staff, and then they have to invest lot of time on their receivables management. And for that reason, they are unable to focus on their research and development. They are unable to focus on much sales. So to increase their revenue, to increase the quality of output, they'll outsource this collection service to an external person called factor. Factor is a person, entity. Factor is an entity that will provide collection services. They'll also give advances to the client company, okay, by charging some interest. The question is, can we enter into a factoring agreement? For that, we have to do cost benefit analysis. The benefit should be calculated and then cost should be calculated. My dear students, factoring will result in so many benefits. That will also result in some expenses. Is it clear? Sir, what are the benefits? The first benefit is your administration cost is going to be saved. Why? Because you don't need to manage your data, right? And then the budgets are going to be reduced. Why? Because the factors will reduce budgets. Sometimes they'll accept the bad debts also based on the nature of the contract. Okay, savings in bad debts. And then your collection period is going to be reduced. So it will reduce your opportunity cost. Savings in opportunity cost. What else we can save? Any other saving we can get? Savings in admin, savings in bad debts, savings in opportunity cost of investment in debtors. Then the additional cost you have to incur is you have to pay the factor's commission. And also if you are taking advance on the factor, then interest on advance should be paid. So those are the two costs. What are the two costs? Factor's commission, interest on advance. At the time of transfer itself, the factor by retaining some percentage as reserve and pay the remaining as factor's advance even before the collection charge of interest on it. Okay, this is a paragraph related to some, cost benefit analysis. Please look at the cost benefit analysis. This is very important. Savings in administration cost as a benefit, savings in bad debts, savings in opportunity cost by reducing the investment in debtors. Are you getting? Say for example, if you are taking 90 days for collection of debtors, but after transferring debtors to your factor, the factor is just taking 60 days. That means previously you are taking 90 days for collection. They are taking now 60 days. So previously 90 days debtors are blocked. Now only 60 days debtors are blocked. Your investment in debtors gets reduced, right or wrong? That will save your opportunity cost. Factor's commission and interest on advance becomes a cost. Net benefit means benefits minus cost. If this net benefit is positive, I can enter into factoring agreement. If this net benefit is negative, I may not enter into factoring agreement. If I'm ready to face this net benefit if I'm ready to face this net loss, that means I'm ready to incur some extra expenditure to maintain this factor service. Is it clear? And that is also available here. Factoring agreements are of different types. Non-recourse factoring and recourse factoring. In case of non-recourse factoring, the factor will assume bad debts. Who will bear bad debts under non-recourse factoring? The factor has no option to recourse. Hence, he can't transfer bad debts to the client company. Who will assume bad debts? The factor will assume bad debts. Okay. In case of non-recourse factoring. In case of recourse factoring, the factor has the recourse option. That means who will assume bad debts? Yes. Now, bad debts losses to client company. Who will assume bad debts? Client company will assume bad debts. Now tell me, under non-recourse factoring, who will assume bad debts? Factor. Under recourse factoring, the company. Advance factoring. In case if the factor is giving advance at the time of transfer, then that is known as advance factoring. In case if the client is, if the factor is giving if the factor is giving the entire money only after collecting the receivables, then that is known as what? Maturity factor. Factor giving advance at the time of transfer, advance factoring. Factor giving money upon collection of receivables on maturity, then that is maturity factoring. Are you getting? Yes, these are the four types of independent separation is non-recourse, recourse, and then based on factoring agreement, advance factoring, maturity factoring. There is a formula for effective cost of factoring. What is the formula? Net cost of factoring divided by net advance amount receivable. Remember this formula. Net cost of factoring divided by net advance amount receivable. What is the formula for net advance amount receivable? Debtors minus factors reserve minus factors commission minus interest on advance. This reserve should be applied on debtors. This factors commission should be applied on debtors. Interest on advance should be calculated after deducting reserve and commission. Are you getting? There is a problem. There are some problems related to this concept. Please go through such formulas. Go through such problems. Is it clear? Management of creditors. Costs and benefits of trade credit. Costs of availing trade credit. The price. The loss of goodwill. The cost of managing. Conditions. These are all what? The costs associated with trade credit. If you take the credit from the supplier, these are the points you have to consider. Price. The price will be increased, right? Goodwill will lose the goodwill. Why? Because we are buying the material on credit basis instead of cash basis. Cost of managing. Creditor should be managed because we have to follow up so many calls from them, right or wrong. And then conditions. The conditions they impose. All these are costs. And then what? Cost of not availing discount. Inflation impact will be eliminated. Interest. Inconvenience. Sorry. You see, cost of not availing trade credit. If we don't avail the trade credit, then the inflation impact we have to face. If we don't get the trade credit, then we will face what? Inflation. And then what? Interest component. And then what? Inconvenience. These are all what? Cost of not availing trade credit. If maximum rate of interest payable, see, my dear students, this is regarding 2/10 net 30 cost of not availing cash discount formula. There is a formula. Benefit of availing cash discount or cost of not availing cash discount. What is the formula? D by 100 minus D into 365 by N minus P into 100. Did you remember that formula? Only after revision you can understand this actually. D is discount. N is normal credit period. P is discount period. By using this formula, I can get cost of not availing cash discount or benefit of availing cash discount. If you avail the cash discount, this becomes a benefit. If you don't avail the cash discount, this becomes a cost. Cost of not availing cash discount. These are the situations. This is related to problem actually. You don't have any information regarding problem. If you're borrowing the money, then interest rate on loan funds should be compared with benefit of availing cash discount. If you are getting 23.23% benefit by availing the cash discount, then you can borrow the money and can avail the cash discount. What do you say? Yes. Own fund. In case if you have own funds, then the opportunity cost must be compared with benefit of availing cash discount. If maximum rate, this rate 37.23% is greater than opportunity cost of funds if invested in other investments by not availing cash discount. If I avail the cash discount, I'll get 37.23%. If I get 20% return from outside securities, don't invest your money outside. Please avail the cash discount because you can get 37.23% benefit. The benefit should be compared with opportunity cost. Are you getting? Availing cash discount means you should compare benefit of availing cash discount. BACD means what? Benefit of availing cash discount. Should be if it is greater than opportunity cost of funds. If we invest in other investments by not availing cash discount, then avail the cash discount because that will give you more benefit. Avail option of investing in other securities. In case if benefit of availing cash discount is less than opportunity cost of funds, that means you are not getting much benefit from availing cash discount. Then you better do one thing. Don't avail the cash discount. Invest your money in outside securities. And this is a very typical concept actually. You need some revisions to understand this concept. This is very difficult actually. Please go through it. What is the formula for benefit of availing cash discount? D by 100 minus D into 365 by n minus P into 100. You know, if you consider the compounding impact, the benefit of availing cash discount or cost of not availing cash discount can be calculated by using this formula. 100 by 100 minus D whole to the power of 365 by n minus P minus 1, where D is discount, n is normal credit period, P is discount period. The same logic. In the same sentences here, if benefit of availing cash discount is more than interest rate on bank borrowing, it is advisable to avail cash discount. If the benefit of availing cash discount is more than opportunity cost of own funds, then it is advisable to avail the cash discount. The same points we have covered, right? Yes. Financing of working capital. These are the possible sources of financing of working capital. This is a theoretical part. You can go through it. Okay. Working capital finance from banks. This is given separately. At last they have given actually. Just, you know. What do you say? Yeah, I can go through this. Same ratios they have given, right? Nothing new. Formulas are right actually. Yes. Okay, this is the theoretical concepts. This is, what are the sources we can use for financing the working capital? Yes. Yes. Please look at the problems. Problem number 1. As a part of the strategy to increase sales and profits, the sales manager of a company proposed to sell goods to a group of new customers with 10% risk of non-payment. So we are ready to sell our goods to the customers with 10% risk of non-payment. This is bad debts, probable bad debts percentage. Okay. This group would require 1.5 months credit and is likely to increase our sales by 1 lakh rupees per annum. Production selling expense amounts to 80% of sales. Income tax rate is 50%. The company's minimum required rate of return after tax is 25%. So first of all, we have to evaluate the proposal. Net sales 1 lakh. You know, you should follow the format. Evaluation of alternative credit policies. Did you remember that? Minus cost, production selling expense 80%, 80,000. Profit before deducting bad debts 20,000. Less bad debts 10%. 1 lakh in 10%, 10,000. Profit before tax, less tax. Profit after tax, less opportunity cost of investment in data. How we can get opportunity cost of investment in data? Look at the number here. 80,000 cost of sales into 1.5 month credit divided by 12 into how much percentage? Required rate of return 25%. So how much is our opportunity cost? 2,500. Deduct 2,500 from PAT, then I'll get net benefit. We got positive net benefit. So the sales manager proposal should be accepted. Got it? Now look at the second question. This is a new area. Also compute the degree of risk of non-payment that the company should be willing to assume if the required rate of return of tax were 30%, 40% and 60%. We have to calculate degree of risk of non-payment. The acceptable percentage of bad debts that can be accepted by the company. That is what the question. The percentage of bad debts that can be accepted by the company, which is nothing but degree of risk of non-payment. Risk of non-payment means bad debts. Degree of risk of non-payment means percentage of bad debts. You know, under 3 situations. Statement showing acceptable degree of risk of non-payment. Required rate of return 30, 40, 60. The same sales, the same production sales expenses, and then profit before providing bad debts, less bad debts. I don't know the bad debts amount. That's why I've taken this number as X, right? I'll get PBT in X terms, less tax in X terms. I'll get PAT, required rate of return. How I can calculate required rate of return? You know, I've calculated average debtors. Cost of sales into 1.5 month by 12 months, 10,000 into rate of return 30%. How much it is? 3,000 for first policy, 40,000 for 4,000 for second situation, and 6,000 for third situation. Right or wrong? Yes. Then see, these are the numbers. If you deduct this opportunity cost of investment in debtors from profit after tax, I'll get what? Net benefit. I'll get what? Net benefit. See, the possible net benefit, the acceptable net benefit is 0, right? They've done like this. Computation of value of percentage of X in each case is as follows. Case 1. 10,000 minus 0.5x. What is this 0.5x? Profit after tax. Should be equal to what? 3,000. Nothing but this is PAT, right? Hello. Minus 3,000 should be equal to 0. That's what they're doing actually. Hello. 10,000 minus 0.5x is PAT. Minus 3,000. I should get what? 0. This 0 is what? Net benefit. What is the acceptable net benefit I'm accepting? How much is the acceptable net benefit I'm accepting? 0. So if the net benefit is 0, you know, we have solved this sum in a different way in our classroom. What do you say? Yeah, through backward computation we have done this sum. Still I'm explaining this part. The 0 is the acceptable net benefit. By using this, I've calculated X. How much is your X? 14,000. So the acceptable bad debts for first situation is 14,000. The percentage of acceptable bad debts is 14,000 by 1 lakh says 14%. You see, the same methodology. Either you can take X or you can take the balancing figure through backward calculation. Anything you can follow. Is it clear? Ultimately, you should consider how much net benefit? 0. The point is, I can accept such an amount of bad debts, a maximum of bad debts, where my net benefit should be equal to 0. It should not be less than 0. Is it clear? That's why I've taken a net benefit is equal to 0. Accordingly, if I solve the sum, I got a bad debts of 14,000 for case 1. And for case 2, we got 12,000. And for case 3, we got 8,000. So the percentage of acceptable percentage of bad debts are 14%, 12%, 8%. That's it, right? Now look at the second problem. Following information is forecasted by R Limited for the year ended 31st March 2021. Raw material, work in progress, extra columns not required. Don't think that we have to fill such columns, okay? We have to fill with these symbols. Good morning. Raw material, inventory, opening and closing, work in progress, inventory, opening and closing, finished goods, debtors, payables. We know the opening and closing inventory items along with debtors and creditors, right? Annual purchase of raw material, annual cost of production, annual cost of goods sold, annual operating cost is also known as annual cost of sales. Do you know that? Yes. And annual sales all on credit basis. You may take 1 year is equal to 365 days. You are required to calculate net operating cycle period, number of operating cycles in the year, amount of working capital requirement. I told you, if you remember, we should follow the format for calculating net operating cycle period, right? What is the formula for raw material holding period? Average stock of raw material divided by annual raw material consumption into 365 days. They have calculated like this, right? They got how much? How many days? 53 days. And for that, they have calculated annual raw material consumption by using the formula opening stock of raw material plus purchases minus closing stock of raw material. They have calculated every component separately, and then finally they have prepared one statement. Is it clear? Then work in progress holding period formula. Average stock of work in progress divided by annual cost of production into 365 days. Average stock of work in progress means opening plus closing divided by 2, right? Divided by annual cost of production, that is given in the problem itself, and we got 35 days. Every time they're using, they're rounding off the figure, right? They're not following our rule. What do you say? You better follow that rule, you'll get the accurate number. Finished goods holding period. Average stock of finished goods by cost of goods sold into 365. Opening plus closing divided by 2, divided by cost of goods sold. Every number is available in your material, right? Debtors collection period, average debtors divided by total credit sales into 365 days. Annual credit sales or total credit sales. Opening debtors plus closing debtors divided by 2. That is what average debtors. Creditors payment period, average payables or average creditors for materials divided by annual credit purchase into 365 days. Opening plus closing divided by 2. Lakhs, rupees in lakhs. Remember that, okay? And we got 64 days. Net operating cycle period. Raw material holding period plus work in progress holding period plus finished goods holding period plus debtors collection period minus creditors payment period. How many days we got? Sir, can I follow this method? No. You better do one thing. Follow the format and get the answer. Is it clear? Number of operating cycles. 365 by operating cycle period. Amount of working capital. Net annual operating cost divided by number of operating cycles. How much is your annual operating cost? 325 lakhs, right? Number of operating cycles? 2.48 times. Actually, that is 2.48. They have rounded off, right? How much it is? 325 lakhs divided by 2.48. Approximately it is 130 lakhs. Got it? Now look at the third problem. This is related to factoring. A factoring firm has credit sales of 360 lakhs and its average collection period is 30 days. The financial controller estimates bad debts losses are around 2% of credit sales. The firm spends 1,40,000 annually on debtors administration. This is administration cost right now the company is incurring, right? And this cost comprises of telephonic and fax billing along with the salaries of staff members. These are the avoidable expenses. The factoring firm has offered to buy the firm's receivables. One of the factoring firm is ready to buy the firm's receivables. The factor will charge 1% commission and will pay advance against these receivables by charging an interest rate of 15% per annum after withholding 10% reserve. Analyze what should the firm do. That means we have to calculate benefits and costs. They're not asking you to calculate effective cost of factoring. They're asking you to evaluate the factoring agreement. Then that means you have to define benefits and then you have to define cost. Benefit should be compared with cost to calculate net benefit. If net benefit is positive, then we can enter into factoring agreement, right? Working notes. Average level of receivables, nothing but average debtors. 360 lakhs into 330 by 360. How much is your debtors? 30 lakhs. Apply commission, factors commission 1%. How much it is? 30,000. Calculate reserve, 3 lakhs. Totally 3,30,000. That should be deducted from 30 lakhs. Nothing but 30 lakhs minus debtors minus your commission and your reserve should be deducted. This is what 26 lakhs 70,000. This is what the money which we are ready to get. See, the company should get this money, but on that money, they'll charge interest. How much? 15% per annum. Actually, that is 15% per annum, but which should be calculated for 30 days to get what? Net advance amount receivable after transferring debtors, right? Yes. Then we have to evaluate the factoring proposal. Savings to the firm. Savings in administration costs. Per annum, how much? 1,40,000. Savings in bad debts. 360 lakhs is your annual sales. Am I right? Hello? Into bad debts percentage? 2%. So your bad debt saving is 7,20,000. Totally, how much is the saving? 8,60,000. Cost to the firm. What are the costs we have to incur? Factoring commission. How much commission we are paying? 30,000. For how much debtors? 30 days debtors. For 360 days debtors into 360 by 30. How much it is? You don't like this. How much is your credit sales? How much is your credit sales? Annual credit sales. Annual credit sales 360 lakhs into 1%. 360 lakhs into 1%. 3,60,000. In that way also you can calculate it. Okay. And then interest charge. We have calculated interest for 30 days. Annualize it into 360 by 30. I got interest cost also. So get the total cost and then total cost should be deducted from total benefit to get net benefit. We got positive net benefit since the savings to the firm exceeds the cost to the firm on account of factoring. Therefore the proposal is acceptable because it results in net benefit, right? Yes, go for the fourth problem. A company is presently having a credit sales of 12 lakhs. The existing credit terms are 1/10 net 45 and average collection period is 30 days. Right now the collection period is 30 days, right? The current bad debts loss are 1.5%. In order to accelerate the collection process further or also to increase the sales, the company is contemplating liberalization of existing credit terms to 2/10 net 45. Previously it is 1/10 net 45. Now we are planning for 2/10 net 45. It is expected that sales are likely to increase by 1/3 of existing sales. Bad debts will increase to 2% and average collection period will decline to 20 days. These are the terms you have to remember. Contribution to sales ratio of the company is 22%. When contribution to sales ratio is 22%, then 78% will be your variable cost ratio, right? An opportunity cost of investment in debtors is 15% pre-tax. You should not consider pre-tax for evaluating the proposals. You should consider after-tax cost of debt. 15% into 1 minus tax rate. You see the tax rate here. You'll get some rate. That rate should be used for evaluating the proposal. 50% and 80% of the customers in terms of sales revenue are expected to avail cash discount under existing and liberalization scheme respectively. Advise the company. Advise should the company change its credit terms. You see, first of all, please calculate cash discount. How much is your total credit sales? 12 lakhs. How much is the cash discount? The percentage of cash discount. You know, under existing policy, we are offering 1% cash discount, right? Only 50% customers are availing this cash discount, right? So I can say 12 lakhs into 50% into 1% cash discount. I got 6,000. Under proposal policy, 80% customers are availing this cash discount. And also my sales has been increased by 1/3. 12 lakhs plus 12 lakhs into 1/3. It will be 16 lakhs, right or wrong? Into 80%. How much cash discount this time we are offering? 2%. 2/10 net 30, net 45 means 2% cash discount if payment is made within 10 days. Normal credit period is 45 days. Yes. And also, so this is what the cash discount offer. Cash discount payment for proposal policy. Opportunity cost of investment in debtors. How many days we are taking under present policy and how many days we are taking under proposal policy? You know, under present policy, the average collection period is how many days? And in proposal policy, 20 days. Right? Look at this. The present policy Sales is how much? 12 lakhs. How much is a variable cost ratio? 78%. 12 lakhs and 78%. Please apply it. Nine lakh 36,000 into 30 by 360. 78,000 into opportunity cost. You know, I told you already, your opportunity cost is 15% into 1 minus 0.3. How much it is? Please tell me the rate. 10.5%. This is after tax required rate of return, right? After tax cost of capital. Please use after tax cost of capital for evaluating the proposal. 78,000 into 10.5%. I got 8,190. This is what opportunity cost of investment in debtors under present policy. Proposed policy. Same calculation. But instead of taking 30 days, please consider 20 days. That's it. Instead of taking 12 lakh sales, you have to consider 16 lakh sales. 16 lakhs into 78% into 20 by 360 into 10.5% after tax cost of capital, right? Statement showing evaluation of credit policies. Credit sales, deduct variable cost, you'll get profit before adjustment of bad debts. Deduct bad debts 1.5%, 2% of the sales, then you'll get profit before, then and also you should deduct cash discount that we have calculated in the working note. Then you'll get profit before tax, less tax, profit of tax, deduct the opportunity cost of investment in debtors, just now we have calculated, then you'll get net benefit. So which proposal is giving higher net benefit? Tell me. Existing or proposed? Proposed. So it results in incremental net benefit, right? How much is our incremental net benefit? 38,990. So the proposed policy can be adopted. Sir, can I follow this format? Already we have solved this problem in our own format. Follow that format. Is it clear? Yes. See, this fifth problem is all about estimation of working capital requirement. It's a direct question. Okay. It's a direct question. Follow the format of what? Estimation of working capital requirement and apply it. Then you'll get the answer. It's a direct question. Nothing new here. No complications are involved here. You can handle this problem in our own way. Please solve it. Okay. So you should get an answer of 1,66,250. With this, working capital management is completed. Yes, the next chapter is ratio analysis. You know, the objective of this ratio analysis is to assess the financial performance of any company. Merely by seeing the financial statements of any company, we cannot assess the financial performance of the any financial performance. So in order to assess the financial strengths and weaknesses of the company, you should try to analyze the financial ratios of the respective company. How I can analyze the financial ratios? By defining it, right or wrong. See, those ratios are classified into, here the ratio means financial ratio. Those ratios are classified into different types. Liquidity ratios or short-term solvency ratios. Leverage ratios or long-term solvency ratios, also known as capital structure ratios, which will cover coverage ratios also. Activity ratios or efficiency ratios or performance ratios or turnover ratios. The famous name is activity ratios or turnover ratios. Profitability ratios related to sales, related to overall return on investment, and related to owner's point of view, and then market or valuation point of view also. Yes. Let me start with the first category of ratios, liquidity ratios. The first ratio is current ratio. All these liquidity ratios are testing the liquidity position of the company. So what is the meaning of liquidity position? Liquidity position means it is the ability of the firm to meet its current liabilities out of its current assets. If you maintain more current assets to meet the current liabilities, then that represents better liquidity position. Is it clear? Nothing but working capital. Am I right or wrong? So your liquidity position can be tested by defining the liquidity ratios. The famous ratio is current ratio. The formula is current assets by current liabilities. And the ideal ratio is 2:1. The ability to pay off current liabilities out of current assets as and when they become due represents what? Current ratio. Simple. Tell me the formula for current ratio. Current assets by current liabilities. Ideal ratio 2:1. Quick ratio or acid test ratio. Quick assets by current liabilities. Remember one thing. I always try to change the numerator, but the denominator is always same. Yes, quick assets by current liabilities. Ideal ratio is 1:1. You need to define the formula for quick assets or liquid assets. What is the formula for quick assets or liquid assets? Current assets minus stock minus prepaid expenses or debtors plus cash and bank. These are two alternative formulas. This is first alternative formula and this is second alternative formula. So your quick assess never includes stock or pre-bid expenses. Is it clear? Tell me the formula for quick ratio or asset test ratio. Quick assess by current liabilities. It's an absolute measure for liquidity position of the company because we are taking only liquid assets or quick assets. Absolute liquidity ratio or cash reservoir ratio, also known as absolute cash ratio. What is the formula? Cash and bank balances plus marketable securities divided by current liabilities. This is the ability of the firm to meet its current liabilities out of absolute cash. Absolute cash here includes cash plus bank plus marketable securities. Got it? Yes. The ideal ratio is generally 0.5:1. Defensive interval ratio or interval measure ratio. Liquid assets divided by projected daily cash expenses. This particular defensive interval ratio indicates ability of the firm to meet its day-to-day operating expenses for how many days? See, if I can meet 30 days expenses continuously without resorting to further sales, then such 30 days is simply known as defensive interval ratio or interval measure ratio. The formula is liquid assets divided by projected daily cash expenses. Net working capital current assets minus current liabilities. Sir, out of liquidity ratios, which ratios have to remember? Very importantly, these two. One is current ratio, other one is quick ratio. Remember these formulas very importantly for solving the problems. Is it clear? Yes, now tell me what is the formula for current ratio? Current assets by current liabilities. Quick ratio, quick assets by current liabilities. What is the formula for quick assets? Current assets minus stock minus prepaid expenses or debtors plus cash and bank balances. Clear? Yes. We have some formulas for current assets and current liabilities here. You can read it and understand it. Long-term solvency or leverage ratios, capital structure ratios and coverage ratios. The solvency position. There is a difference between short-term solvency and long-term solvency. Short-term solvency means liquidity position. It is the ability of the firm to meet its current liabilities. That's what short-term solvency. If you test the ability of the firm to meet its long-term obligations related to debt, the repayment of principal and payment of interest obligations. So that is known as solvency position. So what is the meaning of solvency position? Solvency position indicates the ability of the firm to meet its long-term obligations like payment of interest and repayment of principal as and when they become due. And that's what solvency position. So such solvency position is known as long-term solvency position. Long-term solvency position can be tested by defining several ratios, capital structure ratios and coverage ratios. These two ratios we have to define. First of all, capital structure ratios. Before going for the capital structure ratios, I need to explain few formulas. Capital employed or long-term fund formula. Equity share capital plus reserves and surplus plus preference share capital plus long-term debt minus miscellaneous expenses not written off. From asset side it is fixed assets plus current assets minus current liabilities. What about equity or proprietors fund or shareholders fund? See, in ratio analysis, equity means which includes preference share capital also. Proprietors fund or shareholders fund formula. Equity share capital plus preference share capital plus reserves and surplus minus miscellaneous expenses not written off, and don't consider debt here, right? And from asset side, fixed assets plus current assets minus current liabilities minus long-term debt, right or wrong? And then these are the formulas. And also, please try to define one more formula. What was that? Equity shareholders fund. What is the formula for equity shareholders fund? Equity share capital plus reserves and surplus minus miscellaneous expenses not written off. Okay. Or fixed assets plus current assets minus current liabilities minus long-term debt minus preference share capital. Got it? Yes. These are the several formulas, and by using these formulas we can define capital structure ratios. Equity ratio. Equity by capital employed. This represents percentage of equity on your total long-term fund. Debt ratio. Debt by capital employed. This is percentage of debt. This is percentage of equity. This is percentage of debt on the total capital employed. Got it? Now, you see, look at the formula, debt equity ratio. Debt by equity or total debt by equity. Generally, mostly we'll use this formula. Here, debt means long-term debt. It is the ratio of long-term debt to equity. So, your capital employed generally includes long-term debt and equity. See, this debt to equity ratio is a ratio, it is not a percentage actually. Whereas debt ratio is also known as debt equity ratio actually, that's a percentage actually. debt by total capital employed. Is it clear? Sometimes I can use total debt also. Sir, what is the difference between total debt and long-term debt? Total debt means long-term debt plus current liabilities. Is it clear? Yes. Now, look at the next formula. Capital gearing ratio. Funds bearing fixed financial commitments divided by equity shareholders fund. I can say long-term debt. See, this is a one formula. Capital gearing ratio. What is the formula? Long-term debt plus preference share capital divided by equity share capital plus reserves and surplus minus miscellaneous expenses. Not written off. See, what is the difference between capital gearing ratio and debt equity ratio? In debt equity ratio, I'll consider long-term debt divided by equity means what? Equity share capital plus preference share capital plus reserves and surplus, right? If you consider preference share capital in the denominator, then that is debt equity ratio. If you consider the same preference share capital in the numerator, then that will be capital gearing ratio. Long-term debt plus preference share capital divided by equity share capital plus reserves and surplus. Obviously, I'll deduct miscellaneous expenses not written off also, right or wrong? Hello? That is the difference between capital gearing ratio and debt equity ratio. If there is no preference share capital in the capital structure, both capital gearing ratio and debt equity ratio are one and the same. Are you getting my point? Yes. Now, debt to total assets ratio, my dear students. This is debt to total assets ratio. Total debt by total assets. This is percentage of debt on your total assets. Okay. Now, this is fixed assets to capital employed ratio. FA to CE means fixed assets to capital employed ratio. Formula, fixed assets divided by capital employed. So, the percentage of fixed assets on your capital employed. Working capital to capital employed ratio. Working capital divided by capital employed. These two are interrelated ratios. Okay. You know, there exists one more ratio called proprietary or shareholders equity ratio. The formula is proprietors fund or equity divided by total assets. Let me show you. You know, balance sheet, capital employed. Under liability side, say 1000 crores is your capital employed. In that, I've invested 700 crores in fixed assets. And I've invested current assets minus current liabilities. See, 500 it is. And 200 it is. Net working capital is how much? 300 crores. So, how much money is invested in fixed assets? 700 crores. How much money is invested in working capital? 300 crores. Now, fixed assets to capital employed. How much percentage? 70%. Right or wrong? Working capital to capital employed. How much percentage? 30%. So that indicates 70% of money is applied towards fixed assets. 30% of money is applied towards working capital. And that's what fixed assets to capital employed ratio, working capital to capital employed ratio. Now, listen. There are some total assets here. We have total assets of 1000 crores. Out of that, this is your total assets portion. Out of that, your equity plus long-term debt and also current liabilities. We have current liabilities. 400 crores equity, 400 crores long-term debt, 200 crores current liabilities. Total 1000 crores. Now look at this. Total debt is how much? 600 crores, right? Equity is how much? 400 crores. Now out of total assets, how much money is taken from total debt? 600 crores. That means 60% of total assets are financed out of which fund? Total debt. Am I right or wrong? What about balance 40% fund? Equity. Balance 40% total assets are financed from equity. Now there are two ratios here. Total debt by total assets. That is debt to total assets ratio. Percentage of total assets financed out of debt. Right or wrong? And then percentage of assets which are financed out of equity is equity ratio. Equity ratio means, that is known as proprietary ratio or shareholders equity ratio. Look at this formula. Proprietary or shareholders equity ratio is equal to proprietors fund or equity divided by total assets. What about debt to total assets ratio? Total debt by total assets. This is what the relationship between debt to total assets ratio and proprietary or shareholders equity ratio. We have coverage ratios also. You know, we have to cover interest, preference dividend and equity dividend. Interest coverage ratio, EBIT by interest. Preference dividend coverage ratio, PAT by preference dividend. Equity dividend coverage ratio, EAESH by equity dividend. Remember one thing in coverage ratios, you should write the commitment in the denominator and the available profit to pay such commitment in the numerator. To pay interest, I need EBIT. To pay preference dividend, I need PAT. To pay equity dividend, I need what? EA, ESH. So that's why interest coverage ratio is EBIT by interest. Preference dividend coverage ratio is PAT by preference dividend. Equity dividend coverage ratio is EA, ESH by equity dividend. Am I right or wrong? And then debt service coverage ratio. This is very important, my dear students. Debt service coverage ratio formula is, it is nothing but servicing of debt. Servicing of debt means you have to cover, you have to service interest payment. You have to service for payment of principal, nothing but interest, right? So how I can cover interest and installment? The formula for debt service coverage ratio is earnings available for debt service divided by interest plus installment. Is it clear to all of you? You see, my dear students, here earnings available for debt service is not EAESH or it is not EBID. You have to calculate it separately by adjusting some non-cash expenses and non-operating losses. You see, the formula for earnings available for debt services, PAT plus interest plus non-operating losses plus non-cash expenses. I don't explain the logic behind this formula. I'll explain what are these items. PAT means profit after tax. Interest, you know, interest on debt. That's what you need to cover. Non-operating losses means loss on sale of fixed assets and loss on sale of investments. Is it clear? And then non-cash expenses means depreciation and amortization of intangible assets and amortization of fictitious assets. Amortization of intangible assets means amortization of goodwill, patents and copyrights. Amortization of fictitious assets means amortization of preliminary expenses debit balances, discount on issue of debentures debit balances, miscellaneous expenditure debit balances. So many expenses debit balances should be written off in P&L account, and that will cover under what? Amortization of fictitious assets. All these are non-cash expenses. Please add it whenever you find these items. Is it clear? Yes. So this is a way to calculate debt service coverage ratio. Generally, this debt service coverage ratio should be equal to 2. If it is 2, it is acceptable because we will be able to cover interest and installment by using our available earnings to cover interest and installment. Is it clear? Yes. Now, this is regarding solvency ratios or capital structure ratios. Now we can move for activity ratios. The next set of ratios are activity ratios or turnover ratios. Activity ratios or turnover ratios are related to sales. It indicates the productivity of utilization of your resources to generate sales generally. In majority of your activity ratios, you can find sales in the numerator and the respective factor in the denominator. So the first turnover ratio is fixed assets turnover ratio formula, sales by fixed assets. Total assets turnover ratio formula, sales by total assets. Working capital turnover ratio formula, sales by working capital, right? The first ratio indicates, and then capital turnover ratio formula, sales by capital employed. Got it? Stock turnover ratio. Okay. Up to this, please remember, this is a second set of ratios in your turnover ratios. Now tell me, fixed assets turnover ratio, sales by fixed assets. Working capital turnover ratio, sales by working capital. Total assets turnover ratio, sales by total assets. Capital assets turnover ratio, capital turnover ratio, sales by capital employed. Remember these formulas. Okay. Now these formulas, stock turnover ratio, debtors turnover ratio, accounts receivables, accounts payables turnover ratio, all these ratios are taken or can be defined by using net operating cycle period. Okay. Yes. First of all, stock turnover ratio or inventory turnover ratio formula, total cost of goods sold divided by average inventory. Accounts receivables turnover ratio or debtors turnover ratio formula, total credit sales by average debtors. Accounts payables turnover ratio or creditors turnover ratio. Accounts receivables means debtors. Okay. Sorry, accounts payables. Accounts payables turnover ratio or creditors turnover ratio. That indicates what? Creditors. Okay. Is equal to total credit purchase divided by average creditors. These are the three important formulas. Tell me, what is the formula for stock turnover ratio? Total COGS by average stock. What is the formula for debtors turnover ratio? Total credit sales by average debtors. What is the formula for creditors turnover ratio? Total credit purchase divided by average creditors. Now stock velocity, 365 days or 12 months or 52 weeks divided by inventory turnover ratio. Debtors velocity, 365 days or 12 months or 52 weeks divided by debtors turnover ratio. Stock creditors velocity, 365 days or 12 months or 52 weeks divided by creditors turnover ratio. These are all dependent on the previous set of ratios. Got it? Stock velocity indicates speed of payment of, speed of movement of stock from your godown. Debtors velocity indicates speed of collection of your receivables. Creditors velocity indicates speed of payment of your payables. Got it? The stock turnover ratio indicates how many times you are rotating the stock within the firm. And then, how many times you are rotating the stock. Nothing but selling and buying, other selling and producing, selling and producing. Debtors turnover ratio indicates how many times you are retaining the debtors. Nothing but collection and credit sale, collection and credit sale. And then creditors turnover ratio indicates what? How many times you are retaining creditors. That means payment and purchase. Payment and purchase. Is it clear? Yes. High working capital turnover ratio means maintenance of low working capital. This is not law. This is low. This is FM. Right? Yes. Low working capital turnover ratio means maintenance of high working capital. Because if your low working capital turnover ratio is low, it indicates high working capital maintenance. Okay, those sentences are not relevant actually. You just remember the formulas, that's enough. Profitability ratios. I'm moving for the next set of ratios. Profitability ratios. Hope you have covered activity ratios. Tell me the formula for fixed assets turnover ratio. Sales by fixed assets. Total assets turnover ratio. Sales by total assets. Working capital turnover ratio. Sales by working capital. Capital turnover ratio. Sales by capital employed. Stock turnover ratio. Cost of goods sold by average stock. Debtors turnover ratio. Total credit sales by average debtors. And creditors turnover ratio. Total credit purchase divided by average creditors. Stock velocity 365 days or 12 months or 52 weeks divided by inventory turnover ratio. Debtors velocity 365 days or 12 months or 52 weeks divided by debtors turnover ratio. Creditors velocity is equal to 365 days or 12 months or 52 weeks divided by creditors turnover ratio. With this, activity ratios are completed, right? Now we can move to the last set of ratios, profitability. With that, this chapter is going to be over. Yes, the next set of ratios are profitability ratios. Yes, tell me the formula for EPS. EAES by number of equity shares, right? DPS, proposed dividend or equity dividend paid divided by number of equity shares. Dividend payout ratio, DPS by EPS. Retention ratio, 1 minus dividend payout ratio. Got it? Yes, these are all regular formulas. Return on equity from equity shareholders point of view. Formula, EAESH by equity shareholders fund. Return on equity from total shareholders point of view. PAT by shareholders fund. This shareholders fund means both equity shareholders and preference shareholders should be considered, right? Okay. This is what the formula for return on equity from equity shareholders point of view and from total shareholders point of view. Two perceptions actually here. Now return on investment, which is nothing but return on capital employed. Before tax formula, EBIT by average capital employed. After tax formula, EBIT into 1 minus tax rate by average capital employed. And we can also use this formula, PAT plus interest divided by average capital employed. The most famous formula which is used in the examination is this one. Got it? Average capital employed means opening capital employed plus closing capital employed divided by 2. So we have three formulas here. 1, 2, 3. The most famous formula is second one. Got it? Return on assets. The rate of return that can be earned on assets. Formula PAT by average total assets. This is also very, very important formula. What is the formula for return on assets? PAT by average total assets. From whose point of view? Shareholders point of view. Got it? And this return on assets can be calculated like this. EBIT into 1 minus tax rate by average total assets. This is from long-term investors point of view. EBIT into 1 minus tax rate by average total assets. This is what the formula for return on assets. This is second formula. Rarely will apply this formula. Return on assets by considering tax saving on interest. Formula PAT plus interest divided by average total assets. See, these are the three formulas for related to return on assets. The most famous formula is the first formula. What was that? PAT by average shareholders fund. We can also use EBIT into 1 minus tax rate by average total assets or PAT plus interest divided by average total assets. Now sales based ratios. Gross profit ratio, gross profit by sales. Net profit ratio, net profit by sales. Operating profit ratio, operating profit by sales. Operating profit means EBIT. Is it clear? And also expenses ratios. COGS to sales ratio. COGS by sales. Percentage of COGS on sales. The balance will be gross profit, right? Operating expenses ratio. Operating expenses by sales. May I know the operating expenses, my dear students? Operating expenses are admin expense and selling and distribution expenses in P&L account. What are the operating expenses in P&L account? Admin and selling and distribution expenses. That is what operating expenses ratio. Operating ratio. COGS plus operating expense divided by sales. This is operating ratio is an overall ratio. It is an overall ratio. Overall ratio means by taking trading account and P&L account. In trading account, all the expenses are operating expenses. In P&L account, all expenses are not operating expenses. Only admin and selling and distribution expenses are operating. Okay. So operating ratio means COGS plus operating expense divided by sales. Financial expenses ratio is financial expenses divided by sales. Got it? Yes. And also we should define P ratio. It is the ratio of MPS to EPS. Formula is MPS by EPS. From that we can calculate MPS also. MPS is equal to EPS into P ratio. Tell me what is the formula for earnings yield? EPS by MPS. Dividend yield. DPS by MPS. This is percentage of earnings per share on MPS. Percentage of dividend per share on MPS. Earnings yield and dividend yield. Now look at the formula. Market response ratio or market value to book value per share. Market value to book value per share means market value per share divided by book value per share. Are you getting my point? Yes. And then Q ratio. Q ratio, it is a formula. Generally, we don't find this formula in the examination problems or regular problems. But there is a scope you can find one problem in the examination if the examination paper is very difficult. But so for that reason, please remember this formula also. What is the formula for Q ratio? Market value of equity and liabilities divided by estimated replacement cost of assets. Got it? Yes. That's it. With this, the chapter ratio analysis is over. We don't need to solve any kind of problems. Please solve it. Okay. Thank you. Yes. The new chapter is risk analysis in capital budgeting. What is the new chapter? Risk analysis in capital budgeting. Generally, in investment decisions, we don't consider risk. We'll always follow benefits. Like if NPV is positive, I'll accept the project. If IRR is more than cost of capital, I'll accept the project. Like that, I'll always go with benefits only. I'll ignore what? Risk. If you incorporate risk in your investment decision analysis, then that will be a complete different situation. So we have to incorporate risk whenever we are taking investment decisions. So for incorporating risk in our investment decisions, we have to understand several capital budgeting techniques. Okay, those techniques. You have to understand capital budgeting techniques. But these techniques will consider what? The risk. What do you say? We have conventional methods. We have conventional methods. And we have statistical methods also. We have conventional methods and statistical methods. Under conventional methods, we have to understand two important areas: risk adjusted discount rate and then certainty equivalent approach. Certainty equivalent approach, and we'll also understand sensitivity analysis. What is that? Sensitivity analysis. Under statistical methods, we should follow what? The probability distribution approach. What was that? The probability distribution approaches. You know, the probability, under probability distribution approach, we should understand standard deviation, coefficient of variation. We'll understand what? Standard deviation and coefficient of variation, and also we'll do scenario analysis. Scenario analysis. These are the concepts we need to understand, right? Okay. So we have to understand these concepts. The first one is RADR. RADR is risk adjusted discount rate. You know, this RADR says discount the high risk projects by using higher discount rate and discount the low risk projects by using lower discount rate. So we don't adjust the cash flows, we'll adjust the discount rate. So we are not going to evaluate all projects by using same cost of capital rate. The high risk project should be discounted at higher discount rate and low risk project should be discounted at lower discount rate. The risk of the project should be calculated separately. Is it clear? The formula for RADR is, there are two formulas: cost of capital plus risk premium, cost of capital plus risk premium, or risk-free rate of return plus risk premium. These are the two formulas we'll generally use for calculating RADR. So for different projects, we'll use different RADRs and accordingly we'll evaluate the projects. Is it clear? Yes. And then the second approach is certainty equivalent approach, right? Under certainty equivalent approach, instead of adjusting the discount rate, we are going to adjust the cash flows. We'll identify the certain portion of the cash flow. Under this approach, we'll calculate certainty equivalent factors, a certainty equivalent coefficient. The formula is riskless cash flows divided by risky cash flows, or we can use other names also. Certain cash flows divided by risky cash flows. We can use different names based on the situation. You have to apply the formula. Okay. Calculate the riskless cash flows or certain cash flows simply by multiplying risky cash flows with what? Certainty equivalent factors, and get this certain cash flows and discount these certain cash flows at risk-free rate of return to calculate your NPV. So NPV means present value of certain cash flows discounted at risk-free rate of return. From that, you please deduct your investment. So formula will be NPV is equal to present value of certain cash flows minus investment. If your NPV is positive, we can accept the project. If your NPV is negative, we don't accept the project. This is what the formula for what? NPV. By discounting your cash flows at risk-free rate of return. Got it? Yes. Now, my dear students, with this RADR and certainty equivalent approach is over. Now, sensitivity analysis. NPV is being influenced by so many factors, right? Your investment. Your NPV will change because of the change in investment, because of the change in life, because of the change in discount rate, because of the change in selling price, because of the change in variable cost per unit, because of the change in fixed cost, because of the change in sales volume. Almost every factor will influence your NPV. If there is a change in any of these factors independently, your NPV will be changed. So, which factor is more sensitive, you have to identify it. That's what sensitivity analysis. We should take better control over such factor actually. Okay. So, in your problems, there are some problems which will take all the variables with some deviation, and they'll test how the NPV is moving, how the NPV is changing because of the percentage change in all these variables. Independently, they have evaluated. So, if you can go through the problem, you can understand the sensitivity analysis. The percentage change in NPV because of the percentage change in other variables should be calculated in sensitivity analysis. Is it clear? Yes. And that's what sensitivity analysis is all about. Whereas in probability distribution approach, we'll assign probabilities for the probable cash flows. We'll assign probabilities to the probable cash flows. Say for example, if the cash flows are like this, 1 lakh cash flows for year 1. These are the cash flows for year 1. Just like this. Cash flows, probability. The probable cash flows are 1 lakh cash flows with a probability of 50% chance. 60,000 cash flows with a probability of 0.3 chance. And 30,000 cash flows with a probability of 0.2 chance. 20% chance of occurrence. And like that, you have to identify the probability distribution. Multiply the probabilities with the cash flows to get the expected cash flows. How I can get expected cash flows? Cash flows into probability. I'll get expected cash flows. So define expected cash flows for every year. Discount such expected cash flows at cost of capital. Then you'll get present value of expected cash flows. Deduct your investment. You'll get expected NPV. Is it clear? Yes. So under probability distribution approach, we'll multiply the respective probabilities. We'll multiply the respective probabilities with the cash flows, and by discounting such cash flows, expected cash flows at cost of capital, will get expected NPV. And also we should calculate standard deviation, coefficient of variation. There are some formulas for calculating standard deviation. Standard deviation, coefficient of variation. Standard deviation of cash flows or standard deviation of NPV is equal to square root of 1 by n into summation x minus x bar whole square, right? Or square root of summation p into x minus x bar whole square, where x is NPV, cash flows or NPV. X bar is mean, I mean, the expected, X bar is the expected cash flows. You know how to calculate expected cash flows. Cash flows into probability total is expected cash flows, right? Expected NPV. X bar is expected cash flows or expected NPV. Then I'll get X bar. So this is a way to calculate standard deviation. Standard deviation represents the deviation from your expected cash flows or the deviation from your expected NPV. If the probability distribution is given for NPVs, then I'll get expected NPV, and from that I'll calculate standard deviation. I'll get standard deviation of cash flows or standard deviation of NPV. In case of the probability distribution is given for cash flows, then I can calculate standard deviation of cash flows. So finally, the term standard deviation indicates deviation from expected cash flows. For example, if I get standard deviation of 1000 rupees and my expected NPV, and my expected cash flows are 10,000 rupees. What is my standard deviation of cash flows? 1000. That means from 10,000 expected cash flows, either I may get 1000 rupees extra cash flow or I'll get 1000 rupees low cash flow. So either upward potential or downward risk. That's what standard deviation of cash flows. Got it? Yes. Now, and also I should calculate coefficient of variation. Coefficient of variation. What is the formula for coefficient of variation? Coefficient of variation is equal to standard deviation divided by expected cash flows if it is cash flows or expected NPV if it is NPV. And standard deviation of cash flows or NPV. It is based on the situation. Is it clear? Yeah. This is a way to calculate coefficient of variation. Coefficient of variation indicates risk per unit of return. Risk per unit of return. Nothing but, say for example, if your standard deviation is 1000 and your expected cash flows are 10,000, then it will be 0.10. Right or wrong? That means 0.10 standard deviation for every 1 rupee of expected cash flows. If it is NPV, I have to consider NPV. Got it? In case of scenario analysis, we'll try to estimate different cases. Best case, worst case, optimum case. And for every case, you have to calculate the NPV separately. You'll get the cash flows information for best case and for worst case and for moderate case. For every case, please consider the cash flows and consider your investment and calculate NPV. You'll get best case NPV, you'll get worst case NPV, you'll get what? Moderate case NPV. And the discount rate is always constant. Is it clear? And that's what scenario analysis. So under different scenarios, how much NPV we are getting? Even in worst case scenario, how much NPVs we are getting? That's what we need to calculate under scenario analysis. Got it? Yes. We have few problems related to this risk analysis. Look at the problems. Problem number 1. Determine the risk adjusted net present value of the following projects. There are 3 projects here, X, Y, Z, net cash outlays, project life, annual cash inflows, and coefficient of variations are given, right? The company selects the risk adjusted rate of discount on the basis of coefficient of variation. Look at the project X, the coefficient of variation is 1.2 and the corresponding discount rate is 16%, right or wrong? And the annuity factor corresponding to that particular discount rate is 3.274. What do you say? And for project Y, the coefficient of variation is 0.8. So for 0.8 coefficient of variation, the discount rate is 14% and annuity factor is 3.433. And then for project Z, the coefficient of variation is 0.4. And then for 0.4, the discount rate is 12%. Annuity factor is 3.605. So for project X, it is 3.274. Project Y, 3.433. Project Z, 3.605. These are the annuity factors I have to use for calculating NPV. Statement showing the determination of risk adjusted net present value. Project XYZ, net cash outlays, coefficient of variation, risk adjusted discount rate, annual cash flows, present value of annuity factor from 1 to 5 years. You know, these annuity factors should be multiplied with annual cash flows to get present value of cash flows, right? From that, if you deduct investment, you'll get what? Risk adjusted NPV. Because I'm not taking same discount rate for all the projects, right? Different projects are discounted at different discount rates by considering the risk, and the risk measure is coefficient of variation here, right or wrong? Yes. Look at the second problem. Shivam Limited is considering 2 mutually exclusive projects A and B. Project A costs 12,000 and project B costs 11,000. You have been given below the net cash flows probability distribution for each project, right? Project A cash flow, NPVs, net cash flows and probabilities, and project B net cash flows and probabilities were given here, right? Compute the expected net cash flows of project A and B. Can you calculate expected net cash flows? Simple. Cash flows should be multiplied with what? Probability. The sum will be expected net cash flows. Compute the risk attached to each project, that is standard deviation of each probability distribution. Yes, we can get that. Profitability index of each project. Identify the project do you recommend. Which do you recommend? Which project do you recommend? And state with reasons. First of all, let me calculate expected net cash flows of project A and B. Listen. Estimated net cash flows, probability. I got expected net cash flows. The total 12,400 for project A. For project B, it is 12,300. Simple. Multiply the cash flows with probabilities. The sum will be expected net cash flows. Computation of standard deviation. These are the standard columns, my dear students. After getting expected net cash flows for project A, write the probability. You don't need to write this column actually. Okay. Write the net cash flows column. NCF, net cash flows minus expected net cash flow, becomes your deviation. This is known as X minus X bar. What do you say? X is cash flow. X bar is expected net cash flow. Got it? How much is your expected net cash flow? 12,400. Net cash flow is 15,000. 15,000 minus 12,400, 2,600. 12,000 minus 12,400 minus 400. Like that, you have to calculate deviations. Apply square to the deviation. Apply square to the deviation. You'll get D square. Multiply such deviation square with PD square, P probability. They have calculated directly. Instead of that, you can do one thing. What you can do? Calculate deviation square. That means NCF minus ENCF whole to the power of 2. Then multiply with probability. Then you'll get PD square. This is PD square. Are you getting? Or else I can say P into X minus X bar whole square. Where X is NCF, X bar is ENCF. I got this number. This is summation probability into X minus X bar whole square. If I apply square root to this, this is variance actually. Okay. This is variance. If I apply square root to this, then I'll get what? Standard deviation. How much I got? 2,416. You know, this 2,416 indicates deviation from my expected net cash flows of 12,400. Am I right or wrong? Now look at the problem number 3. The textile manufacturing company limited is considering two mutually exclusive proposals, project M and N, which requires cash outlays of 8,50,000 and 8,25,000 respectively. The certainty equivalent factors approach is used in incorporating risk in capital budgeting decisions. The current yield on government bonds is 6%. You know that under certainty equivalent factor, we should use risk-free rate of return, right or wrong? And this is used as a risk-free rate. Yes, the expected net cash flows and the certainty equivalent factors are given here. For project M and N, the 3 years cash flows were given with their respective certainty equivalent coefficients, right or wrong? If you multiply this cash flows with certainty equivalent factor, I'll get what? Certain cash flows. Discount such certain cash flows by using 6% rate. Then I'll get present value of cash flows. If I deduct my investment, I'll get NPV, right or wrong? Present value factors of 1 to be discounted at 6%. For 1, 2, 3, we have factors here respectively and required. Analyze which project should be accepted. If risk adjusted discounted method is used. Okay, second point, I'll come to that point later. First of all, which project should be accepted? Let me calculate NPV. Statement showing net present value of project M. Year 1, 2, 3. Cash flow, certainty equivalent factors. I got adjusted cash flow. My dear students, this adjusted cash flows are also known as what? Certain cash flows are riskless cash flows. Discount these cash flows by using 6% discounted. I got present value of certain cash flows. If you deduct investment from it, I'll get NPV. This is regarding project M, right? Similarly, you have to calculate NPV for project N also. I got 1,71,315, right or wrong? Same computation. So which project is giving more NPV? Project N. So since the net present value of project N is higher, it should be accepted. Now go for the problem. Which project is having more certainty equivalent factors? Is it project M or N? More certainty equivalent factors. M or N? N, my dear students. Comparatively, this is N, this is M. Okay. Comparatively, N is having more certainty equivalent factors. That means the numbers are high. See, look at the first year ending. We got 90% chance, 90% certainty for project N. Only 80% certainty for project M. So which project is having more certainty? N. So N is low risk project when compared to project M. Now look at the second question. If risk adjusted discount rate method is used, identify which project would be appraised with a higher rate and why. Which project you are going to appraise with a higher rate? Is it M or N? It is M. Why? Because for M, the certainty equivalent factors are low. The risk is high. So when the risk is high, the discount rate will be high. What do you say? So if RATR discount rate is used, certainty equivalent factors of project M is, that is 0.8 plus 0.7 plus 0.5. They have added all the factors. Is lower than that of project N, that is 0.9 plus 0.8 plus 0.7, 2.4. This means the project M is riskier than project N. As higher the riskiness of cash flows, the lower will be the certainty equivalent factors. So if risk adjusted discount rate method is used, project M would be appraised with a higher rate because of high What do you say? With this, risk analysis and capital investing is over. So other concepts, I mean, all the concepts are almost over. If you can cover the problems, you can understand it. Thank you so much. Bye.